Thank you all for joining us. I'm David Dworkin. I'm President and CEO of the National Housing Conference. We are the oldest and broadest housing coalition in America. We were founded in 1931, and one of the things I like to brag about is Eleanor Roosevelt held our first fundraiser. So the story of the collaborative is that, like many people, we were just standing up a working group to look at Black homeownership, because the experience of the Black homeowner during the mortgage crisis was really distinctly different from all of the other racial and ethnic groups in several ways. We'll explore some of that later, but we also recognize that we're all very passionate and somewhat competitive, and it would be easy for us to evolve into work streams that might not be leveraging each other. And so we brought everybody together and we said, we're going to move our initiative out of NHC, create a collaborative effort. Everybody's going to still be doing all the things they would otherwise be doing and come to do, but we're also going to work together on some common things. And the first thing is going to be, we're going to have a shared goal. And so we work together to develop a shared goal of 3 million net new Black homeowners by the end of 2030. And that's why it's called 3 by 30. And the groups we put together were the Mortgage Bankers Association, the NAACP, the National Association of Real Estate Brokers, the National Urban League, NAR, the National Fair Housing Alliance, us, and then we had research by Urban Institute. And then later we added Hope Enterprise Communities, and they have been really important because they also have so many boots on the ground and experience in rural areas and throughout the Black Belt of the South, and that's where we're also likely to find mortgage-ready Black consumers, which is the first critical addition to Black homeownership. People who are ready now, that I think collectively we have not done as good a job marketing to and understanding as a market. And so we have gotten together. We've had incredibly generous support from JP Morgan Chase, Wells Fargo, Bank of America, Rocket Mortgage, Federal Home Loan Bank of San Francisco, and Airbnb, and today, Habitat for Humanity and Fannie Mae. So we really appreciate their engagement, and many, many others, many groups. Many of you are here today, I can't name you all, who've participated in all of our different work streams. And one of the things about the Black Homeownership Collaborative is that we have a 7-point plan, which you can see depicted here, pieces of a puzzle that all fit together. It includes things like homeownership counseling, down payment assistance, civil rights, fair housing, and also marketing, and I'm gonna not mention them all because I never get all of them and I always leave one out. They're all important. Because this is a multifaceted issue, and these are multifaceted problems. One of the narratives of the mortgage crisis and the subprime crisis was, well, this is about people who shouldn't have been homeowners, who got mortgages that they didn't deserve for homes they weren't ready for, and then they failed. And that's housing goals that meant to, of all kinds, that were meant to increase Black homeownership was one of the reasons this happened. That is a false narrative. That is not true. There were certainly people who became homeowners who weren't ready, but there were many, many complex factors that went into this crisis, and there are going to need to be many different complex factors to unwind all of the long-term lasting impacts. The Black community, it was distinctly different from all the other groups because it was overwhelmingly about current homeowners who had good mortgages and were serial refinanced and equity stripped into bad mortgages. So people who had an FHA mortgage, who had a Fannie or Freddie mortgage, were then targeted for refinancing into predatory loans with repeated refinancings required for those loans to be payable. And over time, the equity was stripped out of their homes. And then when the recession cratered, you see this precipitous drop in Black homeownership. And it was the longest lasting drop for a lot of reasons, many of which are historical, involve historical discrimination and other causes. And so we have to really address those root causes and create a new playing field so that we can have an honest conversation with consumers to say, this is going to be different and this is why. Because their first reaction is often, yeah, I know it's going to be different. They always tell us that. I know what happened to my uncle, I know what happened to my grandfather, it's not happening to me. And that is not an unreasonable position for them to take. So we have to, one, be sure that it is different, then we have to explain how it's different, then we have to do something that I don't think any of us did well before the crisis, during the run-up, is we were really good at teaching people that they could build wealth through homeownership, but we never really talked about wealth management. And that's where I think one of the key factors in the sustainability question is we need to talk about wealth management. And so we're going to hear a lot of different perspectives today of different ways that we are working towards this, solving this problem and creating real opportunity. We're going to hear about the local perspective from folks here in Washington, D.C. who are working on that. We're going to talk about efforts in the field. We're going to have Julia Gordon here, Commissioner Gordon, who runs FHA, and what she's been doing. We're going to hear from Urban Institute about the data that drives this. And we're going to talk about the gap not happening by mistake. There is historical roots to this. We're going to talk about civil rights. And then we're going to have a conversation about the cost of homeownership and wealth maintenance and what that means, wealth management, insurance and what's happening with that, taxes and how that plays in, and its disparities in both taxes and appraisals, and then heirs property, which I never really was aware of at all before I started looking at this issue, and it's a key part of helping people and generations sustain that multi-generational wealth. And that's what we're trying to build here, is multi-generational wealth. And what does that mean? And which market segments are, is that important to? So, you know, for many of us, we have struggled with understanding the complexity of the black market. Nobody markets to white people. There's thousands of segments of the white market. That's true of every market, especially the black market, the Latino market. And if you don't understand the market, you're not marketing. And one of the people who I know understands the market better than anyone is Renee Wilson. She is the executive director of NAREB, the National Association of Real Estate Brokers, and they represent realtors all over the country who are embedded in the black market and the black community and increasing black home ownership. And so she's going to speak next. And thank you for joining us, Renee.
Good morning. A little more. Good morning. Okay, awesome. I need energy. I am not Dr. Courtney Johnson Rose as much as I would like to be. She is doing amazing work for the organization. First, I want to thank the Black Collaborative for this opportunity. We are always excited to share the work that NAREB is doing and to talk about what's happening in black home ownership, which is what we do every single day. I want to bring you greetings from the National Association of Real Estate Brokers, and on behalf of Dr. Courtney Johnson Rose, the current president of NAREB. She sends her heartfelt apologies for not being able to be here, and so I get to be her for a moment. My name is C. Renee Wilson. As David said, I am the current Executive Director of the National Association of Real Estate Brokers. I'm very proud to do so. If there are any realtors in the room, I want to thank you for being here, and I specifically want to acknowledge the person who tells me what to do, when to do it, how to do it, and make me look good, and that's my staff, Sharita Jones from the National Association of Real Estate Brokers. You guys can give her a hand. They say we don't do things by ourselves, and that is so true. First, I want to share a little information about who we are. NARAB is the premier network of Black real estate professionals. That includes brokers, agents, developers, counselors, appraisals, property managers. Our network is the oldest minority trade association in the country. Our members, in 1947, when our organization was formed, Blacks could not become realtors due to discrimination. Therefore, the term realtist, we've been called realists, realtist is what we are referred to. And that just means that you are a member of the National Association of Real Estate Brokers, and we welcome everyone to become members of the organization. Since 1947, we've been the voice of Black real estate and the stewards of the real estate Black community, and a very much so trusted advisor. A couple of NARAB highlights I want to share if you're not familiar with the organization. In 1968, NARAB worked with Congress to push for the establishment of the Fair Housing Act. In 1977, NARAB was instrumental to the creation of the Community Reinvestment Act. In 1988, NARAB was active in the amendment of the Fair Housing Act. In 1960, one we're proud of, Dr. Martin Luther King Jr. came to the NARAB conference and met with our leaders several times to gain insight and counsel on issues important to housing for Black America. Our program is driven by our state of housing in Black America. The first Sheba report was released on this campus in the Crampton Auditorium. The Sheba report was the first report to chronicle the unique challenges Black Americans face when becoming homeowners. From boots on the ground perspective from our members who as practitioners work every single day in our communities across the country to help Black Americans become homeowners. A couple of highlights from the Sheba report. If you haven't read it, our 2024 Sheba report is entitled Home Ownership is an Achievable Dream. Say that with me. Home ownership is an achievable dream. A couple of highlights from the Sheba report. There's an inadequate supply of new homes, which we're all familiar with, to the growing housing crisis. We also focused on affordability. And it's a really good reading at night if you want to get through about 100 pages. So I encourage you on your next night reading to do this. And of course, there's a new term that we've used. We talk about, over 50 years, the gap is about the same. We have a new term in our report that references, that kind of puts it in perspective. The Black-white gap is today so massive that the 400 wealthiest Americans control the same amount of wealth as 48 million Black Americans. The last point that I will make in our Sheba report is about climate change. There's a large proportion of home mortgages to Black borrowers continue to be made in census tracts vulnerable to the effects of climate change. Severe weather increases in the coming decades. Homeowners and renters in vulnerable areas will be the hardest hit and face billions of dollars of losses. So the focus of NARAB, as I wrap up, two things that we're very proud of that we're doing to address some of the things that I just talked about is our Developers Academy that focuses on creating inventory. We had about 389 Black Realtors members that are doing some form of development in communities with our faith-based partners, so we're able to create affordable housing, so we're very proud of that program. 50 of those individuals will be graduating this year at our national convention in August. And then David, to your point on Harris Properties, we have a 100-city tour and we have a partnership with the National Black Lawyers Association where they donate their time at our conferences, at our community days. And we did that in 100 cities April 13th of this year, and they will meet one-on-one with a borrower to help walk them through what they need to do to identify if they're in ownership or if there are challenges with the title and things of that nature. The quick story I'll tell is one gentleman came with his stack of papers. He wasn't sure if he had the deed. He was a grandson. His grandmother passed. There were some other brothers and sisters involved, but we were able to determine that he did have full ownership of the home. The value of the home, was about to lose it. The value of the home was about $650,000. And we were able to help him save that home and get complete ownership. And lastly, I would just like to close by saying, we appreciate the support that we get from everyone. I see quite a few of our partners. Thank you guys for continuing to show up in all places where homeownership is a focus. Our members get up every single day to support Black homeowners potential homeowners who want to own, don't think that they can. And we continue to say to them that it is achievable. So thank you all today for giving me this opportunity to share with you a little bit about the National Association of Real Estate Brokers and my opportunity as Executive Director and the work that we do every single day. And I look forward to, if anyone has any questions, I will be here for the entire day. David, thank you for this opportunity.
So what I'm taking away from that is realtists are realists, but realists are not all realtists. I want to now introduce my friend Bryan Greene. Bryan is with the National Association of Realtors, and I just want to say that NAR has been a critical component of this initiative, and the reason for that, and the reason that NAR has been such an important part of the solution recently, is the work that Bryan has done since he's gotten there. He's really turned this organization in many ways into the right direction and continues to be a leading advocate for Black homeownership and for really recognizing the incredible value and importance of this market. So Bryan?
Thank you, David. Well, the National Association of Realtors has been engaged in this effort from the very beginning, recognizing that the legacy of housing discrimination, mortgage discrimination, and the discrimination in all the related industries have created a deficit which cannot be overcome without aggressive, intentional action. We heard from NAREB and how NAREB was formed. The flip side of that is the National Association of Realtors did not admit African Americans in its ranks when it was formed and for decades. Not only that, the National Association of Realtors supported discrimination against African Americans, explicitly stating in its code of ethics that it is ethical to discriminate against African Americans and that real estate agents shall not introduce African Americans into communities where whites live. So that was considered not only standard practice, but ethical practice for decades of the National Association of Realtors. Beyond that, the Realtors had also worked with others to promote and support government redlining, racially restrictive covenants, and appraisal discrimination. You heard Renee talk about NAREB support for the 1968 Fair Housing Act. By contrast, the National Association of Realtors lobbied against the Fair Housing Act. I tell you all this not because I woke up and was feeling bad about myself and the Realtors, but to just really underscore that the problems that we're seeking to overcome are systemic, and the mere passage of a law and even 55 years of federal enforcement don't necessarily overcome that disadvantage when that was how we organized our society. And so the Black Homeownership Collaborative recognizes that, and that we're seeing today really the legacy of that. When you talk about this 30 percentage point home ownership gap between African Americans and whites, you recognize that you cannot close that by simply saying, the law prohibits discrimination and we shall not discriminate anymore. There's a wealth differential. You all have heard about the wealth gap. There's a great book out now by Louise Story and Ebony Reed, New York Times and Wall Street Journal reporters, that's really zeroing in on how this wealth gap cannot be overcome for decades by doing nothing. If we do nothing, it will take many, many decades to overcome it, even if everything is fair. Their book's called 15 Cents on the Dollar. And they, when they got into this work, really became sort of religious converts when they recognized just how the systemic disadvantage compounds itself without active work. When you look at the recent homeowners, the percentage of African Americans in that group are just about 5%, even though African Americans represent 13% of the country. And when you look at the typical home buyer, typical African American home buyer, you find that person has significantly more education than the typical white home buyer. Why is that? Because as an African American, in order to earn the salary to buy a home, you need additional education, and to pay for that home and find the money for that down payment from your own salary, not from the sale of a previous home or from a gift from a relative. And we find that white home buyers are twice as likely to find their down payment from a gift from a relative or from the sale of a previous home. And so African Americans are making all of that up in this present generation through their own salaries and going into significant student loan debt. And so you'll find that African Americans, to attain those additional degrees, also are twice as likely to have student loan debt and tens of thousands of dollars more of that debt. African Americans are also more likely to be tapping into their retirement, 3 times as likely as whites to tap into their retirement to find the money for that home down payment. And if you already had a home, you may have been in an area where there was appraisal discrimination, where you don't have as much equity if you sell that home in order to find the down payment. So there's a whole raft of things. I've even gotten into not having the equity to send your children to college because you were excluded from home ownership. But all of these things, even if we eliminate discrimination today, have cascading effects and cannot easily be overcome. So when we talk about down payment assistance, when we talk about special purpose credit programs, when we talk about other proactive steps, it is in recognition that we need to do more to close the gap, that the gap is not going to close itself by just saying, hear no evil, see no evil, speak no evil. So that is the central purpose of this 3x30 initiative, to recognize that we need to pay special attention, that we need to be proactive, we need to be aggressive, and we need not to waste another day. So I want to commend the Black Homeownership Collaborative, all of you who are here and who support the Black Homeownership Collaborative, for taking all of these steps to make sure that we are intentional, aggressive, and forward-thinking when it comes to home ownership in America. Thank you.
So I'd now like to introduce Charles Lowry, our Senior Director of Policy, who's going to introduce the next panel and serve as our moderator for the day.
Good morning. Thank you, David. Thank you all for being here. So important. We wanted to have this 3rd anniversary here in D.C., and especially on a historic campus like Howard University and here in the Blackburn Center. And I hope that you guys will enjoy presentations and panels, and then also the 2 exhibits we have from Fannie Mae and from Habitat for Humanity. So our first panel I'm going to call up now, and that will be our DC's Blueprint for Bridging the Gap, and our moderator, Sasha-Gaye Angus, who's president and CEO of MANNA. Come on up, guys. Come on. Colleen Greene, who's our director of DC Department of Housing and Community Development. Harvey Yancey, who's a principal member of H2 Design Build. And Ms. Lisa Williams, who's the director of mortgage programs for City First Enterprises, City First Homes. We hope that you'll enjoy this first panel.
Well, good morning again, and welcome to the Black Homeownership Collaborative's 3rd anniversary, DC's Blueprint for Bridging the Gap. My name is Sasha-Gaye Angus, as Charles mentioned, and I lead MANNA Inc., which is an organization whose mission it has been for the last 42 years to address solutions to intergenerational poverty through homeownership. And we do that by advocating for policy solutions, through providing home buyer education and counseling, and we're proud to have delivered over 2,000 units of homeownership units that are offered to first-time home buyers. So it is with great joy that I join you today to moderate this panel with our esteemed panelists, many of whom are partners, on this very important discussion. So today, the objective for us this morning is really to incorporate the local perspectives from Washington, D.C. as the Black Homeownership Collaborative explores national strategies to enhance and sustain Black homeownership in the United States through its 30 by 30 plan. There is no more fitting location, we believe, to have this conversation than Washington, D.C., where the Black homeownership rate has declined 12 percentage points over the last 12 years, reaching 34.8% in 2022. But here, right here in Washington, D.C., we have policymakers, practitioners, advocates that are actively working to close the homeownership gap. So let's start by setting the stage. I do, before I actually get into that, I do want to again let you know who's to my left. We do have Director Colleen Greene, who was appointed the Director of DC's Department of Housing and Community Development on January 3rd, 2023. Prior to her appointment, Ms. Greene was the Vice President of Business Development and Strategic Initiatives at Core DC and Managing Partner for Ashley Builders. Ms. Greene has extensive experience in finance, real estate advisory services, operations, strategic planning, and business development. Welcome. We also have Harvey Yancey. For over 20 years, Harvey has worked with H2 Design Build. He's a principal of H2 Design Build and has been engaged in high-end, modern, contemporary construction and real estate development, while also establishing a strong footprint in affordable housing with the intent on creating livable communities. His vision is to stay on the cutting edge of real estate design and development while delivering a product that can be raised by the masses. Harvey was raised in the suburbs of Washington, D.C. and grew up in Alexandria, Virginia, and he is also a Howard University graduate. Lisa Williams' diverse skill set is leveraged at Homes by CFE through her varied role. Lisa manages CFE's corporate and organizational compliance. She serves as a staff liaison to CFE's board of directors. She oversees key operational functions and also directs the relaunch of City First Homes. Previously, Lisa worked in business administration, managing compliance with federal contracts for both corporations and nonprofits. She also owned and operated an online retail shop for more than 10 years. So let's start by setting the stage around this very important issue. We know that the homeownership ecosystem has many prongs, and each of our panelists bring a unique perspective as practitioners in the affordable housing industry. We have a developer, a lender, and a leader of a government housing agency at the table. So can each of you start by outlining what the homeownership crisis looks like for the constituents you serve? Briefly describe the problem from your vantage point. We'll start with Director Greene.
Well, first, before I start, I just want to say good morning. I see so many serious faces out there. Like, I feel like I'm on the firing squad. I don't have all the solutions. I'll let you know now. But I also wanted to say it's really great to be at Howard. I don't know how many of you are connected to Howard. I hear Harvey's a Howard graduate, but I was born at Howard. I was born in the hospital at Howard. And my parents were married at Rankin Chapel. So although I didn't graduate from Howard, I feel like Howard's home, right? That's where I first took my breath. So happy to be here. It's challenging to buy a home in DC for any working class person. And the challenges are getting harder. In preparing for this, I asked my team, I said, well, how much is the average cost of a house right now today in DC? The average cost of a home is $695,000 in DC. So the median income in DC today is approximately $154,000. So the median income person can't buy that $695,000 home today in DC. And on top of that, 20% of that would be like, what, $130,000 in cash for 20% down payment. So that is a challenge. And as you know, there's a lot of tools that we're putting in place, and we can get into it. We have HPAP, which is our Home Purchase Assistance Program, and our Mayor Bowser, has raised that cap twice in her tenure, one to like $84,000, and then in 2022, I think, to $202,000. I don't know if you recognize 202, the area code. I do think that's how it came up, but because I'm not sure like why it was 202, but I think it matched the area code. But it was very helpful and a big help to purchasing homes. I think in 2023 we must have helped and assisted 654 home buyers. That took probably close to $70 million in that year. Right now, the budget for the Home Purchase Assistance Program is about $31 million for 2025. It was about the same last year, and we still helped a fair number of people, but again, that is the challenge. Is that what you want me to say?
Yes,
it's challenging.
Harvey, let's hear it from your perspective.
Well, first of all, it's an honor to be back at the Mecca, and it's a privilege to speak about home ownership coming up through Alexandria, Virginia, watching the dynamics of the home buying change. I grew up in Delray, went to T.C. Williams High School. Actually, I played football at Norfolk State and got injured and transferred to Howard because I wanted to change my education, and I was in the School of Business. Then from there, I got into doing multiple businesses because that's what Howard teaches you, to be a leader. And then I got into the homing market of buying houses and fixing them up and selling them. And it was interesting because when I got into it, I started seeing the same thing that happened in Alexandria happening in the DC area. As I started doing these cutting edges, I felt they were cutting edges because they were a dream for me of building these beautiful houses that I wish I had owned when I was growing up. And watching the neighborhoods change rapidly, and this is in early 2000s, when a lot of the homeowners that own homes and had a stakehold in the city for years start transferring ownership to either kids or just selling to move out. And my goal was to build these beautiful, or renovate these homes and have people stay in them and figure out how to stay in them. Fast forward 2017, I partnered with HFA with the HIP program, which was a program that did kind of geared towards like the missing middle, as we call it, to have government workers, EMS, the police, nurses, to be able to afford to live in the city. We did our study, and out of all of the city workers, the average pay was roughly just under $100,000, which they couldn't afford to live in the city. And that's Todd Lee, who kind of started the program, was like, we want to target and make sure that we have some type of assistance. The same thing from Ms. Greene, what she was saying is down payment assistance, because a lot of folks that live in the city, or as they're transferring ownership to the homes that live in the city, that want to live in the city, the down payment became problematic. And I started understanding, stacking the different programs that they have: EHAP, HPAP, tax incentives for police officers to stay in the city. And fast forward from there, we've probably delivered over 100 homes to what I call the missing middle, either graduates, DC government workers, or folks that just want to, have a stakehold and continue to stay in the city. The challenges now is the interest rates. As the interest rates goes up, that monthly payment goes up, and it becomes non-obtainable for that person who normally would pay, $2,500 for rent. Now it's $3,500 or $4,500, and the challenge now is trying to find different ways to solve for that in the market. And one of the ways that we've looked at, and even as a builder, we're giving incentives, because that's how it's important for us to make sure that on top of the programs is that we're going to take a little bit less on the back end, because we want to make sure that we keep an opportunity for people to buy homes in the city. So that's the biggest challenge right now. All right.
Lisa?
Sure. Thanks for having me this morning. My name is Lisa Williams, and I am the Director of Mortgage Programs for City First Enterprises and City First Homes. We are a down payment assistance provider that operates in Washington, D.C. and select counties in Maryland. We're formed as a special purpose credit program. So in the process of developing our program, City First Homes had a previous version of its program, and we took a look at our program and what we were offering and who that program was benefiting. And since our organization is a CDFI, we prioritize economic justice and equality, and we determined that we needed to make some changes in how we were operating our program. And we relaunched in 2023 as a special purpose credit program dedicated to serving African American and Hispanic borrowers who are purchasing properties in the District of Columbia and, again, select counties in Maryland. How we did that is we did a lot of research. And part of that research was determining that there are significant systemic barriers that preclude African American and Hispanic borrowers, specifically in this area, from purchasing properties. Whether that stems from, as was mentioned earlier, student loan issues, whether that's issues concerning DTI. Those are the most significant issues that we see with our borrowers in terms of how that process works and the reason for declination for many of those borrowers. One of the things that we've tried to overcome specifically is making sure that we are creating a program that provides opportunity and also has some flexibility in terms of its underwriting guidelines that's respectful to those systemic barriers. Those things were not created overnight, and we're not going to be able to change them overnight, and the only thing that we can do is be respectful of how borrowers were put in these specific situations and what we can do to try to overcome them by being sensitive to the research that exists everywhere that tells you that these are not more risky borrowers. These are borrowers that need a little bit of a foot up to get through the door to homeownership, and that in order for us to be able to provide these opportunities, we need to look at this program or these problems holistically all the way around. We don't underwrite borrowers looking at this problem as numbers. We like to look deeper into, how's their repayment history over the last 2 years? Do they have a stable job history? Will they be able to carry these payments later on down the line? And that's how we go about providing our down payment assistance loans. We also are supportive of our homeowners because this is not just about getting a borrower in the door to homeownership. This is about supporting a borrower once they've purchased that property as well. Whether that means they hit a couple of bumps in the road later on down the road and they need some assistance in order to make sure that they're able to meet their financial obligations. We want to be there to be able to provide that assistance and direct them to the appropriate services to support that homeownership journey throughout this process, not just getting them in the door. I think a lot of this focuses on how to expand homeownership, and sometimes we don't take into account what we need to make sure that they're able to keep it. And issues like heirs property, financial assistance, all of those things come into play when we're thinking about issues like this.
Thank you, Lisa. So you've heard from our panelists that the demographics of homeowners or people who are trying to become homeowners look very different, right? They're not all low income, right? And this is a historical and systemic issue that stems decades and that many people need that assistance. Let's dig a little bit deeper and really sort of talk about what are some of the ongoing products, policy interventions, and practices to address these disparities. So I want to start with Director Greene.
So I'm going to talk about the policies. I did talk about the HPAP program, which is the Home Purchase Assistance Program, and it's a down payment assistance. It's not a grant, it's a loan, but it's a very low interest loan, up to you can get it for 0% depending on your income level and other factors. So it could be as low as 0, and it has gone up to 202. We tried to stretch it because there's limited resources by bringing that 202 to make sense. We were at some point, we were in the first trust position, but we weren't a first trust in many of the home loans that we were involved in, and so that didn't make sense, meaning that we were more than 51% loan to value in the loan, and then if the first trust would go away, our position, which was larger, would be extinguished. So we were trying to make sense of that. But I do feel like the 202 is something that's here to stay if we're going to have people that need more assistance and to achieve deeper affordability. But that also means that the resource will not stretch as far. So there's that. We also have the heirs property program, which came out of the Black Homeownership Strike Force, and that is to make sure that we are providing an opportunity to people that own their homes to transfer property to and wealth to generations of theirs. So those are the sort of two major home purchase programs. And we have obviously the Housing Production Trust Fund, where we're looking for developers to use that to develop affordable home ownership opportunities. So the homes would be sold at affordability of 80% of MFI and below. So we do that in sort of producing homes that are affordable, where there's opportunities. And we also have our property acquisition disposition division program. And so we'll acquire properties that are in distress primarily, or blighted, vacant and blighted, and repurpose them for home ownership. And when we dispose of them for little to nothing, and so that provides a subsidy within itself. Where we have structured the Property Acquisition Disposition Division program, we are now working on some product that are 3 and 4 family homes, where the income from the rental property can be used to buttress the income of your job, or however you are is your primary source of income. So you'll become a landlord, but you'll also be able to afford a home, maybe more expensive than you would normally with just your income alone. So we have some product that's coming out like that. So I think we're always trying to find new and innovative ways to create home ownership opportunities. In this fiscal year, we'll be looking at maybe trying to create the 40-year mortgage, where we'll try to do a tail onto 30-year mortgages so that we can stretch those. So obviously, if your amortization goes out 40 years, maybe that's sort of a support to the higher interest rate, so that'll create affordability if you're amortizing over 40 instead of the normal 30. So we're trying to work on that product now to see if there's a way for us to do that. Some of the challenges with that is that we're not really, we're not in the business of tending to mortgages like that. So we do have to figure out a way to do that, but I think that is another product that hopefully we'll be seeing come out soon. I'm trying to think so IZ is another way that we create affordable homes, and that if there are new constructions, a portion of it does have to be IZ, or IZ eligible, so that we create affordability in those homes. So those are just, I'm trying to think if I caught everything, but if I didn't, I'll come back to it, I'm sure. But those are some of the products that I can think of off the top of my head that we do for homeownership.
And that was at least 5 products that Director Greene just mentioned that clearly the district is offering to help address the issue of access to homeownership. Let's hear from the private sector. Let's hear from Lisa. Lisa, if you could talk a little bit more about your special purpose credit program and what that's about, how you are supporting Black homeownership in the region.
Sure, and to answer your previous question, whether we've seen that our borrowers are all low income, they're not. I'm in a nonprofit and a CDFI fund specifically. And typically for CDFI funds, the goalpost is always homeownership for borrowers under 120%. And what we've seen is that we've had applications from borrowers who are well over 120%, specifically in the District of Columbia. I think it takes some very strategic thinking about how we are determining when those barriers end, because we're not seeing them cut off at 120% AMI. We've found that they tend to extend, and while borrowers at the lower end of the AMI scale, of course, are feeling those effects more significantly than borrowers at the higher end, it doesn't mean that there's any less of a gap when it comes to savings, the ability to put down enough to get into an affordable mortgage. Again, those numbers we were talking about earlier, that 20% down payment to avoid mortgage insurance is something that we always need to keep in mind. And while, yes, there are lovely federal programs, FHA is highly recommended. If you can get into the door with 3%, I think that's a great program for most borrowers. But truth be told, some of our borrowers are not going to fit the necessary guidelines for FHA or need a little bit more flexibility in terms of what that looks like. So we work primarily with conventional mortgage loans. That has a minimum credit score of 620. Now, have we seen a lot of borrowers with 620 credit scores actually be able to get into the door for a property? No. And the reason for that largely is due to bank overlays. So the minimum credit score that we typically see is somewhere in the neighborhood of 640. Our current credit score average for our portfolio currently is about a 700. One of the things that we've set out to kind of prove with this program is that these borrowers, even though they need down payment assistance, are not more risky than regular borrowers. And how our program works is that we will provide up to 20% of the purchase price of a property as down payment payment assistance. We do that in the form of a loan. Our interest rate is -2 from the First Trust lender's interest rate, because we know that borrowers need to be sensitive to that price. And in high-cost markets like DC, it's especially important for us to make sure that in the end, when a borrower has to actually start making these active repayments, that they will be able to afford those payments. And how our program works is we offer a 5-year deferred interest period, which means for the first 5 years, the borrower has the opportunity to settle into their First Trust mortgage loan. They can use that additional savings they can use that additional monthly savings to put towards their First Trust mortgage. They can use that to put towards our deferred interest payment. We do have a deferred interest balloon payment that comes due at the end of the program. We like to make sure that our borrowers are able to succeed, not just in their First Trust, but also with our program as well. And we've done a lot of great work with HPAP as well to further extend that. I think our borrowers at the lower end of the AMI scale were definitely able to utilize HPAP and our program to get to a point where they had a more flexible mortgage. And a more affordable mortgage payment, so they were able to stay in their properties. They would potentially be able to stay in their properties for longer. Borrowers at that lower end of the AMI scale, when you're talking anything under 80%, that's where the biggest struggle is. But those are also the communities that we most want to help. Those are typically people who have lived in the DC area for many generations and have deep roots in this community. And we want to make sure that we're able to provide them with the opportunity to live in the neighborhoods that they have been participating in for their entire lives. It's been very, very, very important for us to acknowledge the level of commitment borrowers have to remaining in this city. And it's how we actually find the opportunities to provide the assistance and the step up that they need in order to get into actual home ownership.
How are you ensuring, I mean, these are just amazing products and policy solutions to address this complex, multi-pronged issue and just address all the barriers from end to end. But how are you ensuring that the needs of buyers are really reflected in your work? Harvey, I'll start with you.
It's interesting because you have a lot of buyers that come in that don't understand the avenues of purchasing a home. And what we've done is we've emphasized with our lending partners on educating buyers on the process of buying homes, getting that credit score from a 620 to a 700, just because understanding the processes of going through and finding the programs and helping them and partnering with MANNA to go through a home buyers program so they know exactly what they're getting. And also we're implementing more of like when people buy homes, because a lot of folks come from renting, is understanding the importances of maintaining your home and your taxes and making sure that your bills and things are paid like that, because later on you may want to refinance, put your kids to school or start a business. And that is one of our biggest things that we're working on, and making sure that they understand the programs that are out there and taking advantage of everything. So that's key for us because of the difference between 5 years ago and now with the interest rates and how they're going. It's up to us as a company to educate them.
Absolutely, absolutely. Well, you mentioned interest rates, so let's talk about the economic impacts. And we know the term housing affordability is all the buzz right now. It's a major issue across the country, and especially in this region where housing prices continue to soar, where interest rates are rising, insurance costs are also increasing, and thus more capital is needed to create and purchase homes. Can you share a little bit more about specific tools that your organizations are utilizing to address the specific economic challenges?
So I think I shared with you about, again, our major homeownership entry point is HPAP. with HPAP, you can use it for down payment assistance, but you could also use it to buy down your interest rate. And I think a lot of people don't know that, but that is an opportunity so that your interest rate can be bought down. You have longer term affordability. So we're allowing that, we're promoting that. In addition, we have, there are opportunities depending on the situation where you can get tax abatement if you're a first-time homeowner, so that tax payment comes down. I also think that, going through housing counseling, we pay for a number of partners and support a number of community-based organizations that provide financial counseling and housing counseling around what to do, how to do it, and we hope that they're out there in the communities that they serve and educating people on how to do that. But those are sort of the major things that we can do in terms of going against the crosswinds of the economy and just trying to figure out, again, locking in an interest rate that works for you, making sure that you get all the down payment assistance that you can. And one of the things that I see happening is that a number of people are just relying on HPAP. There are other down payment assistance programs out there, so HPAP is not the only one, and even some of the lenders that you're working with, and Harvey, some of the home builders that you may be working with also have incentives and programs that you can, in addition to HPAP, help to sort of buy down. The more that you can put towards a home, obviously, the greater help that it is to sort of deal with the economic upturns. And again, we'll continue to try to make sure that HPAP is going with the winds and that we're using that to make sure affordability is maintained. I do, hopefully there are more products that come out as a result of this. I think about purchase money mortgages, right? Are there things that we can do to incentivize people to do purchase money mortgages, so that if there's in terms of even heirs properties, right? Like if I'm selling my house, maybe I could do a purchase money mortgage so someone can annuitize their payment to me, and it's not capital gains, maybe it's a retirement. So think about things like, that are different. I think this is a transformative time, and we have to think about those kind of policies. And I encourage, developers to come up with their own mortgage products, right? I know that's hard. It's hard on the balance sheet, but again, if these folks can underwrite, that's another way to come with their own product. And I encourage lenders, right, to make that 40-year mortgage possible, and work with the government to figure out how we can do that. And that is another product that would help sort of go against the economic crosswinds that are there today.
Harvey, any tools, economic tools you want to mention?
I'm glad you brought that up because Colleen, you're directly on point in reference to developers, because right now we do have to come up with different avenues to help with down payment assistance outside of making sure that they go through the home buyers programs and not counting on the city or the municipalities that people are trying to purchase homes. We've looked at targeting our prices to our audience to make sure that they can afford it. Yes, does it help your balance sheet? No, not really. But if you're doing volume, you make it up over time. Does it help that we do incentives such as pay downs of the interest rate? No, not really right at that time. But if we're looking at it over a 10 or 15-year time, you're looking at it helps you there. Other things that we can do is make sure that our lenders are coming up with programs with them and also adding credits to the buyers as well. Our title companies, we're going back to them and asking them, making sure that they're given incentives as well. So we don't want to put it all on the municipalities of them, trying to solve the problem. We have to be part of the solving the problem as well.
Absolutely, absolutely. It takes a public-private partnership to really address this issue. And I'll also add that MANNA is one of the CBOs partnered with DHCD to deliver these services. And we've also fundraised privately to corporations to provide extra closing cost assistance that's granted to buyers to help them get over that last hump. So every little bit counts, and it's very important to be able to layer on these different opportunities for first-time home buyers. So I'm going to go into sort of the mortgage lending issues. There's evidence that there's bias in mortgage lending where Black applicants are denied mortgages at a higher rate than their white counterparts. So I'd like to understand what are the primary factors that are contributing to this and what steps can be taken to address these issues. Lisa?
Yeah, one of the statistics that I recently stumbled upon while I was doing some reading, in 2022, the CFPB reported that HDMA data revealed that DTI had become more likely to be reported as a mortgage denial reason. What is DTI? Debt to income ratio. So that's essentially where you take how much the borrower makes on a monthly basis and you add up all their debts, including mortgage payments. And when you're in the mortgage process, typically what happens is they're going to calculate your DTI based on your debts and your projected mortgage payments. So typically, as that's calculated, most conventional mortgages hang somewhere around 45% as the typical DTI. What we've seen in our program is that specifically for borrowers of color, it is getting more and more difficult due to the increasing interest rates to get a mortgage payment that's going to put them under that 45%. And when you're taking into account the fact that a lot of these borrowers have significant student loan debts, they make salaries that are on average significantly lower than their white counterparts. When you're looking at these issues holistically, what you're coming to is a picture where that 45% DTI is placing them outside of the ability to actually obtain a mortgage. And our organization looks at this in two ways. So if you're going through the mortgage underwriting process, you come into that door, you start that process 30, 45 days before you're coming up to closing. You have a good and stable job. Everything looks great on paper, right? Anything can happen to you at any point in time after you close on that loan. So additional scrutiny being put on factors like DTI for borrowers of color, I think, is something that we need to, as a group of individuals who care a lot about this specific issue, we need to be looking at this more sensitively. So in terms of DTI, I think it's important for us to be considering not just a person's debt, but their ability to handle those debt loads, what their student loan payments look like. There are some discrepancies between how Fannie Mae and Freddie Mac are handling student loan payments. One of the ways that our organization has determined to do that is if a borrower is on an IDR, that's an income-driven repayment plan. I'm sure many of you might be familiar with that term currently. If they can provide us with a statement that says that they are on an IDR currently, we can zero out their mortgage payments. And that has done a lot of significant good for many of our borrowers. Because if you're looking at this, when our payment becomes due in 5 years, typically you're not going to see someone's salary increase so drastically that they're going to be stuck with a student loan payment that's going to knock them out of bounds. So this is one of the policies that we put in place in order to kind of get a baseline for this in terms of how we're looking at a person's debts and how we're evaluating those numbers. We always want to make sure that we're giving borrowers the biggest chance and not counting them off with a student loan projected payment of $267 when they're on an IDR currently that's going to recertify on a yearly basis. There are ways to look at this where we can get to a baseline where we're providing more opportunity instead of taking opportunity away from borrowers. And I would fall back on that initial conversation where the gentleman mentioned African American student loan borrowers typically have a significant amount of debt. So when you're looking at policies that you're putting in place for your organizations in terms of underwriting, I think it's important to look at what is causing it, how did we get here, and how can we solve it practically without going by any sort of ill-formed policies, I think that that's a smart way for us to kind of adapt to the situation that we're currently in, and acknowledging where borrowers currently are in their finances. Another thing that we do is we make sure that we are line for line adjusting for borrowers' debts. If they hit a bump in the road, tell us what happened. I think a lot of mortgage lenders at traditional banks can sometimes look at a borrower's file and just preliminarily say no, without looking at the situation any further. We try to make sure that we're looking at the borrower's total financial picture, their history of repayments, their job history. What does that look like? Or have they gotten raises on a regular basis? Is there something that we can do? Do they have a good history of savings? These are all things that we look at to make sure that our underwriting is looking at a borrower's holistic financial picture versus looking at just a credit score and a DTI ratio with no other information.
Thank you, Lisa. That really speaks to the issue of not just creating home buyers, but also sustaining home ownership and ensuring that once buyers get into their home, they can stay in their home and pass that home on to their heirs and family members. And so it is clear that sustaining home ownership is also an issue. Given the Black home ownership rate in DC over the last decade, we've seen that rate dip. Let's talk about why you believe that we're losing Black homeowners in DC and what can be done about it. Director Greene?
I am not wholly sure. I mean, I think some of it might be foreclosure. I'm wondering if the loss, that percentage rate, is really reflecting the increase in population. Right, so the percentage of Black homeowners may be decreasing, but are there new entrants in DC? You know, what demographic is that, and is that affecting the dip in the percentage? So sometimes I look at that number and I'm like, yes, decrease overall, but what are the factors around it? One of the things that I was just thinking of sitting up here is that we often talk about first-time home buyers. And there's a lot of help for first-time home buyers. But for people that are transferring homes or upgrading homes, there's a challenge there as well. And one of the things that I have always thought about is, like, why can't they transfer their mortgage to the new home, which I think there's only maybe like FHA does that right now, or just it's not, widely done, but that is also something that helps. So then you don't lose the home buyer, right? Their home becomes too big for them or whatever. And then in terms of the debt to income ratio, people now own another home, or they're renting out their home to family members, or and that's still on their credit, that now they no longer can become a home buyer, right? So you lose them in that sense as well. So why it dips, I think there's also been, sort of an economic strategy to diversify DC and bring more income to DC, right? And that's what's happened to improve the economics of DC. And so, again, on a percentage basis, the home ownership is going down, and with that, the prices are going up. So there is a need to create new home ownership, so I don't have the answer, but those are things. It's a hard one.
Do you see the need for post-purchase support to homeowners once they get in their homes? Harvey or Lisa?
I would say 100%. I think it's important to, as we're talking about these programs, it's not just about getting folks in the door. MANNA has been very helpful, and we're in ongoing conversations about how we can provide additional services to our borrowers to make sure that we're supporting their homeownership journey in its totality, not just at inception. I think there's a lot of focus on getting Black homeowners in the door, and then we're sort of saying, we fixed it, we're done, and that's not necessarily the case. We want to make sure that we're able to provide a lot of support assistance, whether that's financial counseling, whether that's, hey, am I ready to refinance? What would that potentially look like for me? I want to sell my property. How long do I need to stay here? We want to make sure that we're able to sustain our borrowers throughout their home ownership journey, whatever that looks like. I know on average in DC, I think the average homeowner stays in their property around somewhere between 7 to 9 years. And I know that's what we've seen in the previous version of our program as well. And 7 to 9 years, that's a significant commitment. And everyone's going to come at that number at different ways. Like some people are going to want to stay for 5 years. Some folks are going to want to stay at 3. But what does that look like? And also, when they get to a point when they're looking at selling their property, how much funds will they be able to take out of that versus the amount of assistance that they receive to subsidize the purchase price of their property to move on to the next home? Because wealth generation only really works if a borrower is actually able to get in the door of a property and actually stay there for, somewhere in that 7 to 9 year range, and then move on to the next property as their family grows or as their job changes and be able to move on to the next property. We want to make sure that our borrowers acknowledge the trade-offs and equity that come with participating in any sort of down payment assistance program. And we also want to be sensitive to the fact that we want to prepare homeowners for what that looks like and how they can get into the next home when they leave this property. I think it's important for borrowers to be well prepared about what assistance programs look like and what their repayment terms are and understanding all of that. And I know in our experience, borrowers are super excited to get to a closing table, but then it's like after you get to that point, what happens? And we want to be there to make sure that we're there to explain, we're there to answer all the questions. If they're participating in HPAP or other assistance programs, we want them to know that, hey, if you've got a question about this process, what it looked like, what it's going to look like 5, 6, 7 years down the line, we want to answer those questions. So I think it's important for us to be thinking about how we can sustain the home ownership, not just provide the initial home ownership. I think both of those things are equally important as we're speaking about expanding Black home ownership.
And I'll just add that, through our neighborhood-based activities and community-based organizations, we do provide eviction prevention counseling and foreclosure prevention counseling. One of the things that I think I should mention coming to mind, and to be very frank and honest with you, there was a lot of pandemic relief programs, and we're coming out of that now. And very clearly, like the Homeownership Assistance Fund that we had was a COVID program that was funded by the federal government. It's sunsetting. So I think that people there was some behavior change. We see it in the sort of housing ecosystem overall, and people need to learn again that there's that responsibility, and those programs that were pandemic relief programs are no longer going to be available. So I think it'd be interesting to see what happens with the Black home ownership rate if people sort of don't get on board in terms of, now this is still my responsibility, right? Because those programs have ended or are ending or very soon, and so I hope that that's not an impact, and that's going to be, hopefully not going to be realized in the way that I think it might if people don't get on board to understand that that's not there anymore.
Thank you for bringing that up. The Homeownership Assistance Fund has been very, very important in ensuring that households that were disproportionately affected by COVID, maybe had challenges with their mortgages, can actually stay in their homes. So that was very important to retaining our current homeowners in the district and even across the country. So let's talk a little bit about what can our audience and those who are listening virtually do to get involved in advocating for wealth building through the number one tool that we know to build assets, which is homeownership. What can audience or policy practitioners, advocates do to get involved to address this issue? Harvey? Who wants to start?
Education. We have to become more aware in educating the buyers and the existing homeowners of how to stay in the house, how to maintain a house, and how to purchase a house. I didn't know how to purchase a house until I was 22, 23, bought my first house when I was 25, but I wasn't educated by my parents. So that's one of the things that sticks with me, is that when we do sell a house, we educate the parents or the buyers on how to stay in the house, the purpose of the house. Your house is your savings account, over a period of 7 to 8 years, that you build that equity to stay in the house, to help your kids go to school, to help start a business, or potentially, help put a down payment on your son and daughter's house when they want to buy in the city. So education for me is key. And again, all the different programs and how us as developers that we can, change the landscape by, sharing the line edges of educating, as well as helping with assistance, down payments, or other different programs as well.
Do you ever wonder, like, when you drive in certain areas, you're like, who are buying these homes? Like, I think I know a lot of people, and I don't know people that can afford these homes. Like, they're 1 million, 2 million, like 3. Like, I don't know who they are. Like I honestly feel like I have a very diverse group of friends and family, and none of them can really afford maybe one or two, but not a vast majority. So I always wonder about that. And so I feel like there is some creativity that needs to happen to affect the market and to stop the inflation of the pricing, and whether that be federal or local or whatever, like even sort of like building costs have gone up. I mean, Harvey can speak to that. Like the cost of construction have gone up, and they continue to go up even though some things have stabilized. So insurance continues to go up even though some things have stabilized. So I feel like there has to be some real, like, where the government can, and it's not just the government, where the government can sort of put measures in place that are sort of like non-capitalistic solutions in some ways, to say, stop it, just stop it. Like, there's a run on this in the economy that is not making sense to me. So just creativity around products, creativity about how we think about this going, because if we're going to continue to we're either going to have to stop the economic issues that keep going this way, or we're going to have to match with the products, like the 40-year mortgage, the greater interest rate buy-downs, the different looks at DTI, I just, like, I don't know who buys these homes.
Yeah, I can say I've lived in and around this area for probably 30 years. And I actually, when I was in high school, my first jobs were at Washington Hospital Center. I now drive past homes that I think were probably around $200,000 that are now selling for over $1 million. I think about this on a regular basis, just like you, when I'm driving around the city. Like, what has happened? And I think it's very difficult for us to have these conversations without taking into account, like, simple things like, so if the incomes aren't going to keep pace with what the income that you need in order to purchase a property, how do we stop this? And one of the things that we continue to have conversations about with all of our partners, et cetera, is making sure that we're all thinking about this and how can we expand opportunities inside of the framework that we all have to work inside of, right? Currently, it's a 30-year mortgage, and maybe a 40-year mortgage is the next step. Mm-hmm. But at the same time, it's like we're extending that debt load, right, for a particular borrower. And is that actually going to stop the purchase prices from continuing to escalate? This is a complicated issue. I don't think that there's an easy solution to it, but I think that everyone needs to start thinking about this in terms of how can we make sure that we're trying to close the gap. And I was at an SPCP talk the other day, and another startling statistic that I heard is that if white borrowers their income stopped increasing generally right now, that it would take somewhere in the neighborhood of 320 years for Black Americans to catch up. And I thought, that can't be right. So I went home and I Googled it, and I was shocked. I mean, we all know and understand that this gap exists, but we forget sometimes how significant it is and how long it took us to get here, and that it's going to take collectively a lot of thinking, a lot of brain power, and a lot of intentionality to get us to a place where we can upset that apple cart and turn this around. And I always fall back on the policies that we need to start implementing and thinking about in terms of whether that's issues like DTI, whether that's credit scores, whether we're looking at the homeownership preparation. I saw a very shocking video the other day where someone had just purchased a property and was shocked that their personal property taxes immediately went up. And my thinking was, how did we get into the door of a home without acknowledging that? We need to make sure that we're actually preparing borrowers for what this looks like. And yes, property taxes will increase. Your homeowner's insurance definitely will increase year over year. We need to make sure that we're preparing borrowers for what this looks like with real information and not just taking for granted that they understand this process. Because, like I said, a lot of borrowers are very excited to get into the door of their first home without thinking about what that means in the long term, which means there needs to be a little bit more focus on the education and the support services post-closing. I mean, how many borrowers know that you can dispute your property taxes? There's a process for that. Not a lot of them. How many borrowers understand that sometimes in order to avoid DTI issues, sometimes they're getting insurance that's not adequate to meet their coverage, which means that if they had a loss after closing on their property, that they could potentially put themselves in a situation where they're not covered enough to replace that property. There are a lot of things that borrowers are not actually aware of, and we need to make sure that as lenders, as real estate agents, as nonprofit housing providers, as affordable housing advocates, et cetera, that we're actually being intentional about making sure that borrowers have this information, because for some of them, it's going to be the difference between being able to maintain that home ownership or losing it.
Thank you. Harvey?
The key word is being intentional. Last week, I had my staff go through all our previous buyers, and 50% of them wasn't taking advantage of the homestead tax exemption. I got my admin on the phone. I said, call every single homeowner and let them know that they're paying the city extra money when and I knew most of them that lived in their homes. It wasn't rental homes, they lived in their homes, and I had them call them to make sure that they understood that, hey, get your paperwork in so you can take advantage of living in your home. And that's one of the things that everyone has to be intentional about. And the other thing that we're looking at, and as we're doing it, we're building communities. As we're building communities for folks from 15 homes to 20 to 30, we're building communities for first-time home buyers that would have probably never taken stake in the city. So, and we're intentionally doing that. And we're partnering with City First on our construction, which has been tremendous, tremendous support for us.
Yes, intentionality is very important, and that's why we're all here. We know that housing supply, or the lack of housing supply, also contributes to the problem in access to home ownership. And we know that the tools have been limited, although in DC we have many more tools than other states can speak about. But we also know that to create affordable housing, there are many more tools available for affordable rental housing than there are tools to create affordable owner-occupied housing. Harvey, can you just share for the audience sort of what advice do you have for developers who want to get into the homeownership development space, given the lack of tools, but with the tools that are available, how you're utilizing those?
Understand your market, understand your client, understand the dynamics of partnering with the municipalities that are in the area and the different programs that are out there. And also understanding that you, as the developer, you have a torch to carry, meaning that from start to end of building a product and understanding that you're changing people's lives as you go through that process as well.
Thank you. Well, we've explored the tangible impacts that affect the inequities on Black home ownership, and it's clear that addressing these challenges require just a multifaceted approach. It requires public-private partnership, and as we move forward to continue this dialogue and take concrete action that promotes equity and fairness in the homeownership space, we're really just thankful to NHC and the Black Homeownership Collaborative for creating space for this important discussion. Thanks to our panelists for sharing their expertise, and to our audience. I also want to thank those who are participating or at least joining us virtually, and I want to give a shout out to my team that are listening virtually, who do this work every day on the ground to address affordable homeownership. Thank you.
All right, thank you. Let's give our panelists another round of applause. Thank you very much. Thank you guys very much. We're gonna, it's good to see the room filling up. I'm glad you guys are here. We're gonna turn our attention to the next panel. Well, the first idea we had was to have you guys hear about what's going on in DC proper, and then now we're gonna talk about what's happening regionally. So our next panel is Pathways to Home, Regional Strategies for Black Home Ownership. Kiyadh Burt is with Hope. Hope he is the moderator. Kiyadh, come on up. Marty, Marty, come on up. Wendy Penn with Mortgage Bankers Association. Tawkiyah Jordan from Habitat for Humanity. And again, we want to thank Habitat for Humanity. Come on up. We're going to hurry up and get to our seats here. And we're going to keep going. We want to thank again Habitat for Humanity for the opportunity for their Black home ownership exhibit on the other side. So please make sure that you guys take full advantage of that. And also Tamara and Fannie Mae, we have an exhibit from Fannie Mae that we really want everyone to see.
All right, good afternoon. All right, let's start over. I'm from Mississippi, and so when I say good afternoon, we do the call and response. So let's try one more time with a little more energy. Good afternoon. Good afternoon. Thank y'all so much. Somebody must have missed some coffee or something. But either way, my name is Kiyadh Burt. I'm director of Hope Policy Institute, which is the policy and advocacy arm of Hope Credit Union and Hope Enterprise Corporation. Collectively, we are a CDFI located in the deep south states of Alabama, Arkansas, Louisiana, Mississippi, and Tennessee to work to increase financial inclusion for our historically underserved markets in the region. Today, I am moderating a panel on pathways to homeownership, looking at regional strategies to increase Black homeownership in our local markets. I'm joined today by some very impressive panelists. We have Marty Kooistra, Civic Commons, we have Tawkiyah Jordan, and we have Miss Wendy Penn. And we're going to start with introductions. Well, we're also going to start with slides and overview. And with that, we'll start, as I just mentioned, with introductions of the panelists and the conversation. So I want to say we're going to start with Marty.
Well, thank you. Good to be here with all of you. I have some slides I'm going to walk through rather quickly, talking about the Black Home Initiative, a specific effort we have going in the Seattle-Tacoma region. Normally, when we do this, we do learning labs in about 3.5 hours. I'm going to take you through that in about 5 minutes. These slides will be available to you, and I have some literature over on the table there as well. Let's see if we can make this work. There we go. So how did we get the Black Home Initiative to actually happen? About 52 bankers met in March of 21 and decided we needed to do something specifically about the issue and the gap. And so we worked on our 7-point plan version in March of 21, released that towards the end of that year, and brought together an initiative with the Center for Community Investment, working in 5 cities across the country, to form the Black Home Initiative. You all know these stories. We've been hearing them already today. Interestingly enough, in our market, we've had a 16% decrease in Black homeownership, ironically, since the passage of the Fair Housing Act. We have very similar disparities in the Black-white homeownership rate. And of course, the piece that is most disturbing to us is the fact that 4 in 10 Black Washingtonians have 0 net worth. And so we are fortunate to have a group of core team leaders who are driving this work. This group meets on a monthly basis. They are the strategic focus and force behind the effort. And we have mapped out, as we began our work in 2021, the relationships, connections, and existing collaborations of all of the partners who make up the core and the full teams. The reason why we do this is because we believe in the impact network mindset that relationships is where we start and how we get the work done. So our priority really is about making sure the benefits of the ownership model get available to as many LMI buyers, Black buyers who want it, but our ultimate desired impact is the reduction in inequity and, of course, the increase in intergenerational Black household wealth. We're not naive enough to believe it's the only way to do that, but it is the pathway that BHI has chosen. And so by the end of December in 2027, we hope to have 1,500 new Black LMI buyers in place and double that to 3,000 by the end of 2032. We're doing this in a very comprehensive way, and simply put, the light blue at the top is all about increasing supply, whether that relates to land, new funding streams, or the diversification of the product we increase to put on the market. The dark blue in the middle is all about the demand side and how we change up the entire process and system, which started with a study we did with a group called New Impact, really looking at the Black homebuyer journey and the systems that we're facing in our market environment. And then the light green at the bottom is really about the ecosystem. How do we get alignment in the ecosystem? There are now 91 partners signed on to the BHI pledge, and we're trying to move that ecosystem to an ecosystem. So you might be thinking, this is nice, what's different? Well, it's really about the fact that we're spending all of our energy creating this impact network. It's about working in a much different way than people are familiar with. And for us, it looks a whole lot more like the murmuration on the right than the typical way we think about organizational design on the left. It's about having that shared priority serve as the glue and bring people together in a state of emergence where we know that we don't necessarily have the answers, but we are committed to the shared priority and willing to work together to try to get there. So it's about really a different mindset shift. It's about thinking about mission and shared priority, not about organization, focusing on trust. And that's trust for accomplishment, not necessarily trust for affirmation, affection, or acceptance. It's about humility rather than brand, and building constellations rather than stars. And you cannot probably read the detail on this, but these are all the project teams within that shared priority working. Again, the dark blue is all about the demand side. The light blue is the supply side. That makes up 6 project teams right there. And then we have a funding team, narrative shift and communications team, and also a policy mobilization group. And they're connected then outside that circle with all of the associations and partners, including the REALTORS, NAREB, et cetera, et cetera. We also completed the first ever in the nation localized Sheba report in partnership with our friends at NAREB, and so this was just published earlier this year. And you can find this online at our website, but takes a very deep dive into the specific market conditions we're dealing with. We've also launched 2 new funds on the demand side. One is our Legacy Fund, which is a capacity building fund specifically for nonprofits working in the space of increasing homeowners. And then we will launch in July our Debt Reduction Fund, which is intended to serve buyers with up to $25,000 of grants specifically for debt relief. We've also launched the Field Order 15 Fund, aptly named specifically for pre-development, for BIPOC developers to be able to increase supply, and we're working on finalizing the details for that ever-elusive construction financing that is a challenge around the country, making sure that our Black developers can actually get construction lending after they've gone through the pre-development process. This is our biggie. This is the game changer, the first in the nation special purpose credit program we passed and will launch in July. It's going to provide up to $100 million a year across the state of Washington, specifically as down payment assistance and closing costs for those who are negatively impacted by the state allowing restrictive covenants. So we use a $100 bump in the document recording fee to create this account, and we're really excited to see what happens when we kick this into gear here in the next few weeks. Also, and finally, we're working very hard on every one of the local market comprehensive plans to try to change all the regulatory conditions, zoning, and so forth related specifically to allowing home ownership. So that's in a nutshell what BHI is about, and I'm excited to be here with Wendy and Tawkiyah and the rest of you to learn together.
Thank you, Marty. Wendy, you want to go next, Kiyadh?
Yeah, my slide's up next.
All right.
Hi, my name is Tawkiyah Jordan. I'm Vice President for Housing and Community Strategy at Habitat for Humanity International. My team does a wide range of things, from construction and development to advancing strategic initiatives like our Advancing Black Homeownership Initiative. The initiative is about 2 years old now. I have to thank Marty for helping us in our design phase. He's been an amazing partner. We work nationally. We have about 1,000 affiliates, and at least one in all 50 states. And we also have state organizations that participate in our strategy, design, and implementation. I just have a few slides. I'm not as fancy as Marty. But is this the button? Okay. So when we first launched the Advancing Black Homeownership Initiative, we were really thinking about how we could deepen our organization's commitment to the work we've done for about 50 years, which started on a farm in South Georgia, where the founders believed that we could live in integrated communities. So it was a very radical idea at the time. And some of that work actually led to some of the land trust movement. And today, we still serve predominantly Black households across the country. But what we wanted to understand was how well we were serving those households, and then how we could connect our work within our network to what's happening in the broader conversation across the country. And these were some of the original focus areas of that work. To date, we have about 196, I think it's up to maybe 205 or so of our affiliated organizations deeply engaged in leading this initiative over about 34 states. I was looking at Sarah to see if I was... Some of the things that we've launched in the Advancing Black Homeownership Initiative led us to an understanding that maybe we kind of knew in the back of our minds, but has become clearer. I think there's a principle when you're doing any kind of equity work of looking in the mirror before you look out the window. And so we realized very rapidly that the best thing we could do is look at ourselves. are there policies that we have implemented that themselves are barriers to Black homeownership opportunities across the country? And could we expand the ways we're working in community in order to reduce barriers? So right now we're really focused on low barrier strategies to advancing Black homeownership, and I can talk a little bit about that later. I don't want to take up too much time. But let's say I'll just choose one of our policy initiatives. Right now we're looking at criminal background check policy. And we're doing that with the National Fair Housing Alliance as well as Rowman Associates, their legal team that has a deep bench related to fair housing and other challenges in the housing market. But what we're trying to understand is how we can use some of the work we do with undocumented households to identify low barrier strategies to underwriting mortgages. So one of the things that folks sometimes don't understand about Habitat is we finance most of our own mortgages. We self-finance. That's changing as the market and interest rates change, but it's one of the things that we do. We hold those mortgages. Sometimes we sell them off. Sometimes affiliates actually keep them for the life of the loan. But what that allows us to do is to take risks and learn new things. We're a very risk-tolerant organization. And what we've found is that we're highly successful with our homeowners. The last panel, someone was talking about the holistic perspective. So one of the things that we do pretty well is serve undocumented populations, both migrant and new American populations. And there's a lot of ways that affiliates do that, but we've begun to look at the fact that for some populations, we are looking at credit and criminal background, and for others, we are not. And that there is an opportunity to learn and share what we're learning from serving different populations. So that's something that we're doing right now and looking to work with our partners at Joint Center at Harvard and Urban Institute as we move through what we're learning to publish and amplify to the sector. We're also looking at financial coaching and counseling and how kind of historical trauma related to housing and community development has impacted homeowners or potential homeowners' access to financial services. There are barriers that have a lot to do with trauma, and that came out of a lot of the work we did with homeowners. And I guess we're right now in the design phase of a trauma-informed financial coaching model, and we'll see how that goes. It's interesting. And then we're going around the country with the Black Homeownership exhibit, which is really about narrative shift, an opportunity to open up difficult conversations, answer questions, invite people into the opportunity to do work with us as partners. And then finally, the intergenerational wealth research and design effort is connected to lots of the stuff that's in this first bucket. But what we learned through our process is that there's more Black wealth at risk of loss than we have opportunity to create in the immediate future through entry into homeownership, for many of the reasons that the last panel raised. And so a lot of our work is about that sustainability piece right now. We do a lot of repair work. We actually do about 10 times more repair than we do building. And so that opportunity, we've begun to focus on communities that are not well served with traditional financing to do maintenance on homes, or that where homes are, let's say, undervalued and therefore hard to finance repairs for. One of the things that we know well through our repair work is that low-income homeowners are some of the most fragilely housed people in the country. Often their communities have been ravaged by decades of disinvestment. They don't have great infrastructure, and they don't have financial institutions that are focused on lending in those places. So we're trying to figure out how can we advance a repair program that allows us to invest alongside homeowners in the value of their property and the stability of their property so that there is wealth to transfer. I think about my family's home in Detroit that was sold for $20,000 after my grandparents owned it for 70 years. There's no wealth there to transfer. So we want to get in the middle of that and figure out how we can change some of those conditions. I won't go too much further into that, and I think there was one more slide. We have affiliates across the country, always, constantly sending us in what they're learning, what they're doing differently, how they're challenging themselves. Of course, in Seattle and King counties, we have an affiliate that is deeply connected to the work that Marty is doing with BHI. In East St. Tammany, which is in Louisiana, we have an affiliate that's working more in that intergenerational transfer work, and they are holding like will parties. We found that Black homeowners are not really super open to either working with lawyers or talking about death. It's very cultural and related to history, right? And so we're trying to change the energy and dynamic in that by looking at how we can connect trusted institutions to groups of Black families in order to get them thinking about estate planning. And our Twin Cities Habitat for Humanity, which is, I would say, like super out front of most organizations in this work, they actually did some data analysis that helped them think about who they were serving. And what they were finding is that they were actually losing most of their African American applicants. So they were serving the Black community, but not African Americans. And they tried to figure out, well, why are African American applicants dropping out of our processes? And some of it was tied to that like undocumented populations work, where African Americans were being screened with different scrutiny. And so they're really now testing more low barrier opportunities to bring homeowners into their space and make them successful as homeowners, whether it's a Habitat house or out in the private market. That's my stuff.
Thank you. Now we're going to do another presentation. Wendy of the Mortgage Banker Association.
Yes.
Thank you.
Thank you. I am Wendy Penn with the Mortgage Bankers Association here in Washington, D.C. And want to share some information with you about our Convergence initiative and how we turn the gaps that we've identified into opportunities. Convergence is a collective impact initiative to increase Black and Hispanic and other minority homeownership rates by changing the systems that create barriers to homeownership. And we do that by focusing on 4 gaps. And trying to close them, of course. The information gap, which we've heard a lot about. There's misconceptions about the home buying process. People think they need 20% down, perfect credit, all the things that you're very familiar with. And people will self-select out without even trying when they might actually qualify for home ownership. This trust gap has been a thread that we've heard all morning. David talked about it, and when he mentioned the foreclosure crisis and subprime lending and people seeing friends, family members lose homes. Bryan talked about it when he mentioned redlining and racially restrictive covenants. All of these things have caused a lack of trust. People don't trust lenders, they don't trust real estate professionals, anyone involved in the process. And again, will self-select out or just decide this isn't for them. The market gap, you may have heard that there is a supply shortage, particularly when it comes to affordable housing. And in Convergence, we really look to try to work with smaller developers, help with infill development. And then the resource gap, making sure that housing professionals, lenders, housing counselors, as well as consumers know what's available to them in terms of the programs and products that might help them get into a home. Convergence creates a model for local stakeholders like lenders, loan officers, local government, CDCs, to to work together in a way that they might not have otherwise. Are we getting feedback? I'm not sure I hear. I don't know. I saw both of you move your mics, and I thought maybe.
No.
Okay. Because I hear a whistle. I wasn't sure. To work together in a way that maybe they hadn't before, and then bring in resources from the national level through partners like Fannie Mae and Freddie Mac and CoreLogic and others. So the goal is to help people work in a way that they might not have otherwise, and through that we create home ownership opportunities, really looking at buyers who might be ready now, but again, maybe don't realize it or don't trust the process, but also looking at a pipeline and looking at potential buyers who might be ready in a year or a couple of years with a little bit of assistance. This also creates market opportunities. We've heard about that gap, the white-black homeownership gap, how it's 30+ percentage points. Well, there's opportunity in that gap. There are more reasons for trying to close that homeownership gap, but there's also business opportunities. And then there's studies that talk about household formation over the coming decades, and the majority of the homes that are being formed will be minority homes. So it is wise for people who make their money by being in the housing ecosystem to use that gap as an opportunity to grow their business. We also stress the importance of elevating community partners. As I said, these are locally driven, place-based initiatives. The local stakeholders are already on the ground doing the work. They are the ones who are trusted in the community. So the goal of Convergence is to elevate what already exists and then help to provide resources for new opportunities and solutions. And what comes out of that is we create these new locally tested and driven solutions. So think about things like down payment assistance programs, housing counseling pilots, housing supply pilots. And each of these pilots or program or activities is an opportunity for us to learn. So we take what we learn from each city and then try to adapt it and apply it in another city in the network. And through that, we are taking these learnings and developing what we're calling a knowledge community. And the knowledge community is an opportunity for peer-to-peer learning within the Convergence network, but we will also be creating tools that can be used in markets that are outside of the network. Because the goal isn't to just assist the cities where we have a presence, but to provide information, ideas, and resources that can be used more broadly in the industry, again, with that goal of expanding business opportunities and helping to close that gap. We have Convergence Initiative in 3 cities right now. We launched the first one in Memphis, Tennessee in March of 2020. Yes, March of 2020. It was great timing. I wasn't with MBA at the time, so I can't take credit for that one. The second in July of 2021 in Columbus, Ohio, and then the third in Philadelphia, Pennsylvania last year in March. And I'll be able to talk a little bit more about each of those initiatives as we go on.
Yeah, thank you so much, Wendy. So you all talked about the regions that you all serve and the initiatives that you all have implemented to increase Black home ownership. Can you talk a bit about the lessons you've learned in implementing these initiatives, maybe some impact data on the progress, and also some of the things, even you mentioned, Wendy, about extrapolating those lessons to other cities for scale. What are some of those lessons that you've learned?
Sure. I'll start with one of the main lessons we've learned is to listen. Before we go into a city, we have what we call the Hearts and Minds Tour, where we visit the city, talk to the local stakeholders, and really understand what the challenges and opportunities are. Each Convergence initiative has a local host organization. And what that means, there is a local nonprofit that's already part of the housing ecosystem that is trusted, that knows the community, that has connections, and they are really responsible for managing the day-to-day operations of the initiatives. So one, that's key, to have an organization that is truly the backbone of what the initiative is going to be, and then making sure that they have the connections within the community. And then the listening. So we have these listening sessions, and some of them might be industry specific. So we did a listening session with realtors, or we'll do a listening session with lenders, and then we'll do some combined ones with housing counselors and others. Because what we also understand is there is mistrust among housing professionals. Yeah. So there's often we're working on the same issue, working in silos, working sometimes at odds because the goals might be the same, but your organization might have priorities that conflict with another. But being able to get in the same room and start talking is key. So for us, the key takeaway is to make sure you have that trusted organization that can really manage the day-to-day, and then listen, because not only are those professionals going to be the ones that are going to help design their programs, they are also going to be the ones that have the connections with the consumer that ultimately are going to, they're not going to trust Wendy from the Mortgage Bankers Association, but they might trust Leslie from the Urban Affairs Coalition in Philadelphia, who that happens to be one of our host organizations. So you have to make those connections there so that you have the connection to the, ultimately to the community and to the consumer.
Thank you. Marty or Tawkiyah? Lessons learned.
Yeah, I would just build on what Wendy is saying. The fragmentation in the market that we work in is pretty significant. It's not necessarily true that we're resource poor. Up and down the West Coast, the housing ecosystem has aligned around the low-income housing tax credit and multifamily rental in a way that homeownership never has. And so bringing together all those disparate organizations in a different way, including the nonprofits. The incentive structure for EDs and CEOs based on what they get from their boards and from philanthropy is to grow their organizations, not necessarily to solve the problem. And so we have to change the mindset of folks to really dig in deep and say, how are we going to work together on a shared priority in a new and different way? And that relationship work takes an awful lot of time. And it was not easy to do during the pandemic, of course, when we couldn't be in person near as much. I think the other lesson learned, there's so many, but really trying to figure out how to get people to also embrace this idea of coordinating intake and assessment so that you can track people on their journey. We tend to see dropout rates when we look at the studies, whether it be from our NAREB study or from the study for the Covenants Homeownership Account. Those dropout rates tell us some things about why people drop out, and I think we can all speculate. But if we work relationally with people, we can help them, whether that journey be a one-year journey or a four-year journey. But again, a different mindset, right? When your loan officers are compensated purely by commission, they're not motivated to work with somebody on a long journey. And so getting community lending officers that are actually compensated in a different way is another big learning that we're striving for.
Thank you. Kiyadh?
Sure. I mean, Marty has covered a little bit of what I was thinking about, which is looking at the data, especially for institutions that do lending. It's really important to understand who you're serving, who you're not, and why. In addition to looking at kind of secondary data in your area. So, you know, we work with local organizations, and what we often help them to do is think about who's actually in your community. And then of that community, who are you serving? And then in your process, who's dropping out? So that you're looking at all of the data and providing context that helps you understand whether you're impactful and successful. Because we often think we're doing really well. And it's not that we're not well-intentioned, but without understanding the data, we can't actually identify a true impact. So that's something that we've been thinking about deeply.
Well, these are great responses. You know, what I'm hearing you all say is we should listen to the communities that we say we're trying to serve and identify their needs as they see it, and also be humble enough to use data to evaluate our impact in actually meeting their needs. I think similarly with Hope, as the credit union, we think a lot about how to center our members' experiences in accessing mortgages. For example, we serve a region of 5 states, as I mentioned, Alabama, Arkansas, Louisiana, Mississippi, Tennessee, and this is the home of most black people in the country, and it's also home to a third of persistent poverty counties. This is any county that has a poverty rate of at least 20% for the past 3 decades or 30 years, if you will. And one thing we notice is that our members, our communities are disproportionately the low income. They have poor credit scores. They have higher finance for mortgages. They have higher student loan debts, higher medical debt. And so we designed a mortgage product, we call it the Affordable Housing Program product, that circumvents some of those systemic challenges in accessing mortgages. For example, we will deploy a mortgage loan that has a credit score of at least 580. We will We will 100% finance that loan, no private mortgage insurance. We will accept alternative forms of credit repayment history, 12 months of rent, for example, utility bill. We will also use deferred student loan debt. So if it's an income-driven repayment plan, we would use that monthly payment instead of a percentage of the student loan debt. And so what we found is that this mortgage product meets these communities where they are. And how do we know that? Is that we look at the data. 94% of those mortgages are to first-time home buyers, 86% are to women, and 80, I wrote it down, and 90% are to people of color. So we have created a product based on where our members are, or our communities are, and we follow the data to make sure that it's doing what it's supposed to do. And relatedly, in meeting our communities where they are and making sure we're tracking that information, how are you all working with others to do the same? I know you all have talked a lot about collective and collaborative efforts. How exactly does that really pan out in the work that you're doing?
I can start. You heard me mention that there is a host organization for each convergence initiative, which is critical because the host organization knows the community, they know the needs. But further, when you drill a little bit deeper into the initiative, we have what we call each initiative has work streams. So those are the people who are doing the work in the other organizations. So housing counselors, lenders, real estate professionals, the CDCs, local government, as well as the national partners. So Fannie Mae, Freddie Mac, CoreLogic, iEmergent. They come together. So it's a committee, if you will, that looks at each of the challenges related to the gaps. So there might be a work stream on outreach and education, an outreach, programs and products work stream, or something that the collective group has identified as something they want to focus on. And through those work streams, they'll say, well, maybe there's enough down payment assistance programs, but there's not enough awareness of them. So the outreach and education work stream will say, this is what we need to do to make sure we're sharing the information more broadly. So the way we engage the community through these stakeholders is to have their voice literally around the table or around a Zoom or what have you once a month or quarterly to talk about what are they seeing when their clients come in the door? What are the challenges? What are the opportunities? And just have that constant flow of communication back and forth. And that's how we can ensure that we are hearing the voices of the community. One good example that I'll raise was at Convergence Columbus. They wanted to create a website that has information about the home journey process, the home buyer journey process, where there's tons of websites, there's tons of information. How do you trust it? How do you know it's the right thing? They held a series of focus groups with renters. One of the Convergence stakeholders organized it, used their facility. They met several times to really understand, what does home ownership mean to you? Not just that it's a safe place or equity building. These are not necessarily the words that the consumers use. Right. They don't want to have their children change schools. They want to be able to not worry about neighbors and all of these sorts of things. But through that focus group process, they came up with the concept of Bloom. And so Bloom makes you think of things that are growing, opportunity, things that are lively. And they created this beautiful website, bloom614.org, that if you go to that website, there's not a single stock photo on there. All of the pictures are people who live in Columbus. They're people who participated in the focus groups. They're pictures of loan officers, real estate professionals that are engaged, that really want to work with and serve the Black and other minority communities. So the consumer, the residents see themselves in that website. They know that they can trust the information that's there because they see a list of organizations that they're familiar with, the Housing Authority, the NeighborWorks affiliates that's there, Homeport. All of these groups that they see and hear every day that they interact with have essentially validated the information that's there. So really hearing the voice of the community through the stakeholders, and then you end up with a product that people can say, I had a role in that, and then you can refer it to someone else. So it helps to not only provide the information, but close that trust gap that is so significant.
Thank you. Now, we have about 15 minutes left. I know we've covered a lot of information through our slides and a couple of questions here. I'm going to ask one more question. I'm going to turn it over to the audience. If you all have any questions that you want to raise, so you can start jotting them down now and get ready. But before we do that, I want you all to think about this. What future opportunities exist or do you see forthcoming to expand Black home ownership? Just for context, we understand that the racial home ownership gap is larger today than it was in 1960 when explicit racial discrimination in housing was legal. And if you were to think about the next 60 years of home ownership in this country, will it expand or decrease based on what we do today? But what are those opportunities that you see that we should be taking advantage of and be monitoring now to better encourage and supply homeownership opportunities for Black Americans?
So I'll go radical a little bit, and I'll say
Go ahead.
we probably have to look at ways to remove some of our affordable housing from the private marketplace. Because what's happening, what I see happening in the housing market is that property is an investment vehicle, right? It's a pretty sound investment in a lot of markets in the United States. And so we often see our home buyers and really ourselves as builders in competition with that investor market. Nothing against investors, but in order to kind of lock in our investment, we have to identify ways. I mean, you know, land trusts, I mean, they work. Yeah. Even if they don't limit equity, they still work as a way to maintain opportunity through the mechanisms that just exist in the land trust. But it's something that we're expanding use of within our network and with our partners. We do a lot of partner development. And that has shown promise. Because even where we have maybe a trigger for shared equity, and I don't want to get too far into the model, but you know, we can allow for equity to go, let's say, up to a certain amount, and then if it trips, like we have in Southern California, where we've had homeowners buy our homes for $400,000 and sell them in 2 years for $900,000.
Wow.
We said, well, yeah, that's not working, because we're running an affordable housing organization, not like a lottery.
Right.
But when we capture that value in the property and are able to pass it on, and in fact use that equity to do more development, we keep that stable. We stabilize that stock. And so for me, that's like one of the things we can get creative about. There's a lot of shared ownership stuff bubbling. We'll see what works. Some of it is, you know, like the co-housing space is a little funky, but I think there's promise in that if we just keep testing different models.
I like the innovation. Wendy?
One of the things that I think actually both of you touched on a little bit when you were in your opening comments is about shifting narratives. There's a lot of, we're hearing more conversation and more pushback about DEI efforts, about things that are specifically for Black populations or other minority communities. And sometimes those messages are the loudest ones. And I think it's an opportunity for us to be equally loud and share messages that are not just about the benefits of homeownership, which are great. And I believe the personal stories are very important when you see a person who has purchased a home and what that means for their family. But there is also a very clear business case for the work that we're doing. So making sure that we are balancing the message, that it's not just a good thing to do, it is a smart business move for people as well. And really paying attention to where the growth opportunities are, where the new buyers are coming from, and making sure that that is the message that we are sending as well. So it's a very well-rounded message, because the pushback isn't new. The pushback has always been there. The message changes, the format changes, and we have to be as responsive in making sure that the messages that we are sending out there kind of match up to that and get people's attention as well.
It's almost as if equity is good for everybody.
I think so. I've heard that. I've heard that.
Marty, what you got?
You know, they've hit on all the high points. It's a comprehensive approach, right? Supply, demand, and ecosystem. I think the thing that I'm most keen on right now is making sure that we're changing the face of who are the underwriters, who are the lenders, who are the realty professionals, who are the contractors and subcontractors, and the developers. Because it's not just the economic benefit from the home ownership itself, it's all the economic activity that goes into producing and selling and who is benefiting from that. And I think if we can get deeper in that, we can accelerate the benefits that we're trying to accrue in the home ownership space itself.
These are all great responses. I'm going to just throw my hat in there just really quickly and say, I think it's also an opportunity as we could look for low-hanging fruit. one example that we're engaged in at Hope is taking LIHTC, low-income housing tax credit tenants, into homeownership opportunities. In our region, there are about 5,000 LIHTC properties that are going to come to compliance about year 16. And these are specific properties. These are single-family detached units. The tenants have been in there 15 years. They made their payments on time, but they don't have enough money to purchase the home from the developer. And so we've been able to partner with developers in the state of Mississippi and to stack federal dollars, the Equitable Recovery Program, to provide not just mortgage financing for these tenants, but also down payment and closing cost assistance. One example is we have a tenant who's purchasing her home from the developer for $40,000. The house has been appraised for $107,000. So her equity already is going to be amazing, right? But not only are we going to underwrite her loan with the loan product I described earlier, the 580, 100% loan to value, et cetera, we're also going to add $30,000 in closing costs and down payment assistance. So she has a $40,000 mortgage, $30,000 in down payment assistance and closing costs. So her mortgage at the end is $10,000 for 30 years. I wish I would have had that product when I bought my house. Now, there are about 5,000 of these opportunities in our region alone. So the question would be, how do we take that to scale and find other opportunities across the nation? LIHTC varies by state, but it's also to say, like, what could we do today that will change the futures of folks tomorrow? So this is low-hanging fruit, but being creative and expansive about our opportunities to increase Black home ownership. So I'll stop there, and I'm going to look to you all to see, do we have any questions for our panelists today? We have you with your hand up.
My name is Jordan Harris. I work for Compass Working Capital. Recently, the 11th Court Circuit went against a Black woman-owned venture capital program, saying it was discriminating by only giving money to Black women. So do you have any fears of groups using the court system to mess up the work you're doing advocating for Black homeownership?
Fear, no. I guess facing reality has been what we're doing. We have partners in the fair housing space that we're working with to consider what we should do, how we should do it. But one thing I kind of personally grapple with is what we don't say about why this is a challenge. My group does a lot of grant making. And we provide grants that focus on veterans, older adults, migrants. No one complains until the group we're focused on is Black folks. And so I think there's a conversation there that we're not having around the discomfort of Blackness that Blackness creates in this country, and why. And maybe I just lived with it so long that it's very easy for me to have the conversation. It doesn't make me uncomfortable. But we have to become more comfortable with just talking about it, being real, and then tackling what challenges arise from that. And so if it's changing the name of the program, or dealing with how we're looking at data, whatever, there's ways to deal with everything. I used to work in government. I know how to navigate.
So you know how to navigate the water. So.
I do.
Any other takers?
If you didn't notice, yesterday Shelter Force came out with a fairly comprehensive article on this very topic. I would encourage you all to look at it. We obviously, with our state program, are creating the first government special purpose credit program, the Covenants Homeownership Account. We are not naive enough to believe that it may not be someday legally challenged. But to Kiyadh's point, all of these efforts are about creating fear. And I think that that's the resolve that we all need to have, is to say we're going to stand up against it. If you haven't done this recently, don't do it right now, but tonight before you go to bed, look up the first time these three words were used in American history: badges and incidents, okay? Badges and incidents. Look it up, and it will help you reinforce what Tawkiyah is saying about conviction.
I'd add to it as a CDFI. CDFI is a Certified Development Financial Institutions for those who might not even know. By our mission, we are directed to increase financial services and products, access to financial services and products to historically marginalized communities. About 1,200 of these institutions across the country. They could be loan funds, credit unions, banks. The fight against racial reconciliation, the fight against reparations is long-standing. The arguments are the same, the tactics are the same. It may just look different today because of the internet and all these other different devices. The reality is, in my perspective, on behalf of HOPE, the question is how do we continue to do our job in ways that matters to the communities that we serve? Because the opposition has a clear stance. They don't want equity. They only want the status quo. And so to your question about are we afraid or is there fear, we acknowledge the opposition, and now we have to go back to our communities and say, here's how we're going to continue to provide you access to wealth-building opportunities, because the opposition is aggressive, and so must we be in making sure that we stand on the right side of history. And so we are also working with legal partners to make sure that our services and products can stand legal scrutiny, because that's really what this is boiling down to. Are we doing what we say we're doing in a way that could withstand the legal scrutiny? And the short answer is we're all supposed to be protected under the law.
Yeah.
To your point, whether we're a veteran or woman-owned or whatever other special purpose group that's protected, so why us? Or rather, why not us? We could be homeowners, right? We could be business owners. That means venture capital in one sense, it's affirmative action in another. So my response to that is to say, let's continue to find motivation to do what's right. So, any other questions? We got time.
A question for Marty and maybe others on the panel. I have a supposition that when you started, your horizon was shorter and your numbers were higher. I may be wrong. But when I see your goals for, was it 1,500 new Black homeowners by 2031 and
2027.
2027 and 3,000 by
2032.
2032. How much harder is it than you thought it would be? And a related question is, how many of these homeowners, when we talk about results, and we have it at Convergence too, I work with Wendy at the MBA, how do you know whether they would have become homeowners anyway? In other words, what's the incremental lift?
Yeah, on the latter part, we get this question quite frequently, and we're working with Laird, of course, at iEmergent on trying to get a sense of what would be the trajectory and baseline. And I think you've indicated probably one of our greatest challenges is that none of us believed when we started that the market was going to do what it has done. We're at a median home price in Seattle right now of $1 million. You add that with the interest rate components, and we're up against a huge supply challenge. This is the greatest fear of those that put out the Covenants homeownership account legislation, is that we got DPA for what if there's nothing to buy. And so we're reevaluating those numbers, but also backloading them in the 5 years to say if we get everything right, hopefully we'll get the machinery to happen and we'll get there. We're not going to give up.
Any other questions? Somebody had raised their hand. Yeah.
Hi, I'm Emily from the Urban Institute. I was just wondering, since you all come at this from different perspectives in the field, what you think is the importance of making business case arguments for solving the Black homeownership and wealth gaps, particularly as our Urban Institute projections show that all net household growth between now and 2040 is going to be from households of color. And so I don't work in advocacy, but I'm curious about how you think it's important or possible to make that case of why serving these households is going to be really important for the market share growth of businesses, lenders, home builders, et cetera.
and I will say at the Mortgage Bankers Association, our members are very interested in that business case, and so that is something that is very important for us in Convergence to be able to show them that there is a case. And as Marty was just talking to Bob, it is hard to be able to prove necessarily that the interventions resulted in the increase in home ownership, but when you show the statistics, just like what you're talking about, some of the things that Urban puts out about where the population growth is, when there's clear documentation of where that gap is, it's part of building the case, but then there's also, you need the information about showing that these borrowers are not necessarily more risky than another. So I think you have to just continue to make the layers and answer what the concerns are. Is there more risk? Am I going to have to change my credit box? Am I going all these other things? Because then there's a ripple effect. Well, then I have to change this technology. Then I have to do this. And am I going to make the money back by doing all of those things? And so it's not an easy case to build, but you do have to listen to what the concerns are and be responsive, and then be able to back up that with the data, be able to back that up with the reality of, this is what the potential is if you can be if you are at the table, if you are in a work stream talking about the challenges you have, so that the housing counselor, so that the real estate professional better understands what your challenge is by, it's not just as easy as saying, oh, I'm going to take off that overlay, because if I do that, then this will happen. So being at the table and being part of that conversation so that the other housing professionals understand what the challenges of the lenders are, but then so the lenders can also hear, by you doing this or not doing this, it then causes this ripple effect. So not just telling them, but having them kind of be in that conversation and hear from the others that are impacted as well.
We have time for one more question.
This is a question specifically for you, Marty, and appropriate for any of the panelists also. You push supply as a big part of this plan. That's something I know in my core, that the more individuals we empower, but we don't have enough housing, it's just going to automatically push prices even higher. And so you mentioned zoning, different concepts, perhaps still different construction styles, higher density. And I'm curious that logically it makes sense. We can even go to DC or our state legislatures and have some movement there. But you go to the local legislators, they're scared stiff because their voters are so resistant to it. So I'm curious, the reality is there have been studies that have shown that more diverse communities or broader cross spectrum of folks from different economic status are healthier communities. But it's hard to get that message across to the general public. And I'm a realtor in that side. It's hard for us to talk to our clients when they push back hard. Have you had experience with best practices or good examples of where folks realize it's actually a good thing that you broaden the home ownership among all segments of your communities?
Yeah, I think Wendy nailed it. It's part of the whole narrative shift component. I mean, I served on the Growth Management Policy Board for many years in Seattle, and all of our electeds at the local level would say, encourage me, but don't require me, right? And so, when we look at how do we change this, especially as it relates to zoning or the use of some of the things like design review and all of that as ways that neighborhoods can block density, we need to protect folks. And we finally, in Washington State, the folks in Minneapolis led the charge on this, got a statewide zoning law passed last year. That gives cover, and now we're building in the requirements in the local comp plans that you have to show how you're actually going to meet the numbers. Because in the past, it's all been about encouragement, and now the dynamic has changed. That should give local electeds the cover they need to have the courage to do the things that they need to do. But it's not easy. I mean, having gotten mandatory housing inclusionary zoning done in Seattle after 20 years, it was a rough road. I can tell you that. So we have to have our convictions strong, and it goes to Wendy's point about narrative, and it goes to the heart of what Tawkiyah does at Habitat. Every time a volunteer shows up on that Habitat site, they better never leave without becoming convicted that they have to be advocates for change in their own blessed neighborhoods. They don't just get a free ride to say, I volunteered and built a habitat house, I've done my thing. Sorry, that's my sermon.
You know, Marty, you make a good pastor. It's the shortest sermon I've heard. Well, listen, thank y'all for joining us for this panel. I hope you took away some good instructions on what to do in your own region, your own community. I would tell you, I'm walking away with some reading from each of you, and say thank you all again, and we'll be around later today for some additional questions if y'all have any. So thanks again.
Okay, we're going to now shift quickly to lunch. The food is outside for you all, but also we want to make sure that you see the exhibits that Habitat for Humanity and Fannie Mae have. So please make your way. If the line looks too long for food, just go to the exhibit. We'll meet back here around 12:30. You can bring your food in here as well, and we'll be having the fireside chat with our FHA Commissioner, Julia Gordon. Thank you all very much.
Just thrilled and honored to have Julia Gordon with us. She is the Assistant Secretary for Housing and the Federal Housing Commissioner at the U.S. Department of Housing and Urban Development. Throughout her career, Ms. Gordon has been both a strong advocate for and a hands-on practitioner working to achieve equal housing justice, fairness, and equity in housing and consumer protections. I know this because I've worked with you in about half of your jobs, and that is absolutely true. As Assistant Secretary for Housing and Federal Housing Commissioner, Commissioner Jordan is responsible for HUD's policies, programs, and operations supporting the nation's homebuyers, homeowners, renters, and communities. She is responsible for the Federal Housing Administration's single-family, multifamily, and healthcare mortgage insurance programs currently serve more than 7.5 million homeowners and 1.5 million renters, as well as 4,000 healthcare facilities across the United States and its territories. In addition, Ms. Gordon is responsible for HUD's multifamily assisted housing portfolio, which serves more than 1.2 million low-income residents, the administration of HUD's housing counseling program, and the development and oversight of federal standards for the design and construction of manufactured homes. Now, I really appreciate you coming here because I know you're working 22 hours a day. Prior to joining HUD, Commissioner Gordon was most recently the president of National Community Stabilization Trust. That's where a policy person goes to get mud on their boots, and where she was a passionate advocate and leader for housing equality and neighborhood investment, launching multiple new initiatives supporting neighborhood stabilization and affordable housing. From 2013 through 2015, she was the senior leader at the Center for American Progress, where she led the center's work to address access to affordable homeownership and rental housing and safe financial products and services. And previous to that, she had leadership roles at
way too long.
FHFA and CRL, because I only mentioned the ones I was really impressed by. So, and then finally, Julia received her bachelor's degree from what Charles and I fondly call the Michigan of the East, also known as Harvard University. So thank you for being here. So let's jump right into it. FHA and racial wealth gap affects black home buyers. It affects really all minority home buyers, AAPI, Latino. FHA loans have always been a core product for this community. Tell me a little bit about what you've been doing in this space since you've taken over.
So, good afternoon, everybody. Delighted to see a room pretty much full of friends. To the two of you I don't know yet, hi. We can get to know each other after. And just so you know, I'm bringing up notes with me, not because you can't like wake me up in the middle of the night and hear this speech, because you totally can, but because we've done so much on this issue, I don't want to, leave anything out. So I bring the little bullet points just to remember. And, I would be remiss if in a room like this, I did not say that the vast majority of what I know on this topic, I have learned from somebody in this room. I just saw Kooistra walk in. She was one of my early teachers on these issues, and Ricardo and Charles, and there's just a lot of us go way back. And so when I was thinking about working in the administration, I will be honest with you, there was no other job I wanted. I wanted this job so bad, and the reason is because I have felt like FHA's historical reputation is not accurate now, and I wanted to be at FHA so that we could demonstrate how strong and important a program this is, particularly for those of us who are here today to talk about black home buyers. Because FHA you know, pound for pound, sort of relative to our overall book, serves far more first-time home buyers, first-gen home buyers, Black home buyers, Latino home buyers, rural home buyers than any other channel. And, you know, we're basically the original special purpose credit program. And honestly, there's a lot of people out there I think are kind of reinventing the wheel when the FHA program is now a lot more appealing, both from the perspective of borrowers and also from the perspective of lenders. So, you know, I'm really proud of FHA's presence in the market right now. Of course, as you know, it's, you know, the original low down payment homeownership product, and we are always making changes to try to be better. And, you know, I'm looking around this room, a lot of you know where FHA came from. FHA is turning 90 years old this year, and in the first part of that history, FHA was a product of its time and its stereotypes and its discrimination, and it played a role that was not a positive role for many of the communities and populations that we're particularly focused on serving now. And, you know, I say this not because we want to like wallow in the sins of the past or anything, but I think it's really important to look at the trajectory of something like FHA, because you see how what I'm sure at the time was considered just a risk mitigant actually turned into a real barrier for Black and many other homeowners who didn't fit a certain model to not be able to grow the assets and wealth that other families got to grow. And I say this because we see this in other areas now. Not, you know, and FHA, I'm very proud of what we're doing now. But when you look across other sectors that touch home ownership, I mean, you know, insurance or things like that that come to mind, you can see how there are decisions being made that are being justified based on risk that are exclusionary. And so I just think it's really important to learn the lessons of the past. And, you know, certainly my presence at FHA is because I feel like now FHA is doing so much to really try to make the marketplace more accessible and more affordable for Black home buyers.
And so let's talk a little bit about the specifics around that. Tell me specifically, how is FHA a better product today? And what are some of the programs that you think are doing a good job at reversing that legacy? Because it's pretty, FHA didn't invent redlining, it perfected it. So I think HOLC gets all the credit for inventing it, but it's certainly on the scale that it was used. But the maps had a long impact. So let's talk about how we turn that around.
So just in terms of the credit box, you can't beat FHA's credit box.
Mm-hmm.
We don't have a credit score cutoff. People think we do. You see credit score cutoffs because lenders put overlays, but we don't actually have a cutoff. And I think that's just a really important piece of what we're doing. We also, of course, are much more flexible on debt-to-income ratios than some other channels, and we are still successful. We are still making loans that are sustainable and maintained over the years. Our serious delinquency rate, I just got my monthly briefing this morning, and it's even ticked down a little bit in this last month. So what we're doing seems to be working with our much more flexible credit box. And then within that credit box, We're trying to be creative about making sure we're not keeping people out. I think you know when this administration arrived, FHA was counting student debt in a weird way, if I can say weird way.
That's a technical term.
That's a technical term. And we changed it so that we actually count the payment you are actually making, which seems to be the relevant one. And that is important for all of our borrowers, but for no one more than for Black borrowers who tend to have higher levels of student debt. Another thing we've done that has been really an unqualified success is begin to count positive rental history. And you can clap for that. And I will tell you, it took a while to get to that because you may know that something FHA is not on the forefront of is modern technology. And you know, there's some of you, I'm looking at Jonathan, there's some people in here who are very technology forward. And there was this idea that somehow you had to like make your technology really super modern before you could look at positive rental history. And that just clearly was not going to happen for us anytime in the near future. So we found a workaround. And the workaround is working great. Early returns from some of the evaluation that our PD&R at HUD, which does the evaluation for us, is that thousands and thousands of people are making it over that line into home ownership who wouldn't have made it before they had that plus factor. So that's really exciting. And one more thing I'll mention before I let you talk more if you want to. Is that
not many people need to say that.
You know, just if you're ever just alone with David and me, it can be a little hard to take.
Unless you're a good listener.
Something that HUD has been leading, but it's an administration-wide effort, is what we call the PAVE initiative, which stands for Property Assessment and Valuation Equity. And this is about all the harms that have been done to communities of color by appraisals that come in low simply because of who's living in the community, you know, because of bias. And the efforts around this, and again, these are efforts with FHA and VA and USDA and Fannie Mae and Freddie Mac. We already see the focus that we've put on this making a difference out there. We are seeing fewer words that relate to bias in the written part of appraisals. And we're making some changes so that we can make sure we know what's going on out there. One is the data sharing among the GSEs and FHA. That's, you know, if you can't see it and you can't measure it and you can't count it, you can't fix it. So the data sharing that, you know, FHFA is really taking a leading role on is incredibly important. And then another thing is recently, in conjunction with Fannie and Freddie, we announced our reconsideration of value policies. And what this does is require all our lenders, without being, we tried not to be too prescriptive because, you know, Bob told us not to be too prescriptive. It requires that every lender has a process. So if a borrower thinks something has gone awry in their appraisal, particularly if they think there's evidence of bias, they can raise their hand and they have a path to get that reassessed. And we feel like that's really, really important. And so I'm going to stop there and wait for your next question to go through a lot of my other bullets.
Well, good. So let's talk a little bit about fair housing and what's happening there. And there's a complicated legacy, as we know, but there's also a more recent experience where FHA, so for instance in the 70s, in the 235 program, took so much risk that communities were devastated. And then you've got the mortgage crisis and the legacy of the False Claims Act. now discouraging lenders from being in the game. Loss mitigation is so critical, and if you're going to take more risk, you have to get that right. And I know there are few people in this room who know as much about loss mitigation as you do, so let's talk a little bit about that.
Sure. So something I've said since my time at CRL is we're not here to support home buyership, right? You need to be able to sustain those mortgage payments over time. And that means getting mortgage products that are fair and that don't have features in them that are designed to fail. That means doing a thorough underwriting process so that you know a particular household is ready for home ownership. And that means understanding who you're serving. At FHA, we're serving primarily first-time home buyers. And what that means is these are people with less experience. We serve lower income borrowers. As I said, we serve lots of borrowers of color. And what that means is you have to have ways to help along the journey. It's not just get someone in a home and you kind of walk away and don't have anything else to help, because this borrower population is going to encounter financial hardship. They are going to encounter fluctuations in income. They are going to encounter all the exogenous events that affect all of us, like, you know, pandemics and stuff maybe we wouldn't even have thought of some years ago that can happen. And it is so important to have a robust servicing system in place. And what we've seen since the financial crisis, when millions of people lost their home to foreclosure who should not have lost their homes to foreclosure for many different reasons, both because they were put into bad products and because there was servicing that was not helpful. What we've seen since then is a real sea change in loss mitigation and in the ability of mortgage servicers to provide, to act as if the folks they've always called their customers are actually their customers, and to provide that assistance. And you see this across the industry now. Again, you know, Fannie Mae and Freddie Mac, but I think nowhere more than FHA do we have more options built into our program to help borrowers who face either a temporary or a permanent reduction in income stay in their home. And the pandemic experience was truly a field test, a real stress test of that system. Had things really changed from 2008? And what we learned is yes, things have really, really changed. And the measures that the government put into place across all the mortgage channels, the CARES Act forbearance, which FHA and the GSEs kind of came out with even before the CARES Act passed, the forbearance, and then what we call the COVID loss mitigation waterfall for when people are coming back into mortgage performance after their forbearance, have been incredibly strong. At the height of the pandemic, or the height of the kind of recession caused by the pandemic, FHA had almost 12% of its portfolio delinquent. You could have looked at that and said, oh, there goes FHA again.
No, it was extra special. I was at Treasury, and we were seeing records of loans that were 1,200 days late. I'm like, the guy who's 1,200 days late is not answering his door to somebody who says, hey, we can cut your payment by 20%. So
the reason we had such high levels of delinquency is we had allowed so many people to take forbearance to try to ride out the pandemic. And this worked. This worked beyond, frankly, beyond my wildest dreams, that we would have been at that level of numbers of people taking forbearance or not even taking forbearance. Mm-hmm. And to come now, just a few years later, and have our serious delinquency rate be below pre-pandemic levels, that is truly a successful program that basically allowed people with these loans when we were all terrified during the pandemic and people had relatives dying or they were sick themselves and they were losing jobs, and we were also terrified we were doing things like wiping down our groceries. And the one thing we didn't have to worry about was paying our mortgage. And that gave so much comfort to the homeowners of this country. And they paid that back by showing up and going back to paying their mortgage afterward. And we showed that a streamlined approach to loss mitigation could really work. We cemented the data we had from the financial crisis, that what really helps a borrower go back into performing status and stay there is payment reduction. And so FHA has learned all of these lessons and done some really innovative things in loss mitigation, but none as innovative as what we're doing now, which is the one thing the loss mitigation system that grew up after the financial crisis did not really account for was the kind of rapid and steep rise in mortgage rates that made it very hard to use what had become the standard modification, that rate term modification, and get somebody the payment reduction that was going to help them. A little bit easier at Fannie and Freddie because they had the ability to keep people at the interest rate they were already at, and so then they could adjust the term and get payments down that way. But at FHA, our servicers had to buy those loans out of the pool in order to modify them. That meant they had to redeliver at current rates. And what that meant was that rate term mod was not working for us very well at all for so many people, you know, for people who already had a low rate mortgage. And so that's when we all put on the thinking caps, and all together, I'm looking at so many people here who were part of these conversations to figure out what we have now rolled out called the Payment Supplement Partial Claim, where FHA borrowers are allowed to use that special thing that FHA has, the partial claim, which is basically the ability to kind of lend yourself some money and use that to basically buy down your monthly payments for 3 years so that you can get through that hardship period. We have heard the very first servicer has just rolled it out in kind of record time, honestly. And we expect a bunch of other servicers to be rolling that out in the next couple of months. And we're just really excited that one of the things you get now when you get an FHA loan is this incredibly robust loss mitigation infrastructure. Sorry, that was a long answer, but I feel
No, that was great.
strongly about it.
You're constantly at risk of segueing into my next question and then answering it before I get to ask it. So I've checked off 3 of these, but let's talk about headwinds, because there's a lot of pretty strong headwinds both in our initiative and your book of business. Mortgage interest rates obviously increased dramatically, ended up being very sticky, probably going to stay high through most of this year, if not all of it. Housing supply, critical crisis there, both for move-up buyers and especially first-time home buyers. Appraisal bias, progress, but still a big problem. And tell me about the impact of these things on the FHA market and how you're trying to mitigate those.
So volumes are down everywhere, but we do tend to be a, quote, counter-cyclical program. And so actually our volumes are not down as far as some other volumes. And it really helps that I think folks know that last year we reduced the annual mortgage insurance premium by more than 1/3. And that helped make our pricing much better.
Yep.
So that's really helped people. You know, we see people, particularly with the help of HUD-certified housing counselors, we've put out a bunch of initiatives to really focus on homeownership for underserved communities.
Mm-hmm.
Just yesterday, I was in Harrisburg announcing a new $10 million initiative for housing counseling to focus specifically on improving how they work with populations where it's important to have the right languages, have the right culturally appropriate and sensitive approaches, and really to not just say, we're going to just kind of take all comers into our program, but okay, we're going to go out and we're going to find people who we think, with the help of these counselors, can get into home ownership. I was with 2 clients yesterday on the stage, someone who was an immigrant to this country who had been here less than a year and had already been able to buy a home, and she was particularly grateful for the language assistance. And someone, a single mom from Philly, which is where I'm from, where some other people here are from, who had just bounced around to so many different places and had an 8-year-old son and has now bought a home, and that child's outcomes are going to be very, very different as a result of this. So we're really trying to be affirmative, to go out there. We've run a sort of awareness campaign called Let's Make Home the Goal, because the consultants told us that sports metaphors are good for everybody in America except for me. And we're really excited by the response to that, because look, homes are way more expensive, mortgages are more expensive, but in many parts of this country, it still is affordable to buy a home. And in many places, you're not going to spend more on your home than you spend on your rent, especially over time. You get that fixed rate mortgage, and you don't have to be at the mercy of the landlord who's just going to, jack the rent as much as they can, as often as they can.
Another technical term.
So that's another technical term. So I've heard it in technical conferences. We're really focusing on being intentional about what we're doing. I do think it's important to, note a few things that I'm going to look at my notes here and make sure that I do say. So I want to talk, you mentioned something that I really want to talk about. You mentioned the whole FCA claim thing.
For background for people,
yeah, I'll give some background.
False Claims Act, also known as the Lincoln Law, implemented during the Civil War to prevent military contractors from selling shoddy wool and lame mules to the Union Army, evolved into a major tool since 2009 that has really sought to punish lenders who've made sometimes serious errors, sometimes errors on loans that they had acquired as a result of saving another bank, and sometimes as a result of having a staple missing.
So I'm going to say this generally. This is not just about False Claims Act. When you run a government program, you have a responsibility both to the taxpayer and to the users of your program to not have lenders committing fraud. This is really important. If lenders went around and committed fraud and we didn't do anything about it, we wouldn't have much of a program left, and Congress would probably shut us down. So it is important to have rules of the road. What we have tried, and on the False Claims Act issue, during the Obama administration, FHA issued a memorandum of understanding that made it very clear that lenders would not be penalized for non-material errors by, treble damages. That memorandum, for anybody who is not aware of this, is very much still in effect. That's going to remain in effect. And that memorandum came along with a very important thing, with a very non-mellifluous name called the taxonomy, the defect taxonomy. And what that is it's FHA has put in writing the different things that can go wrong and sort of what category of error they are. You know, is this a really profound abuse of the system, or is this a foot fault? And that part of the taxonomy that related to origination has been out and working well for some time now. We are about to put out the part of that taxonomy that relates to servicing, and we hope it will work equally well. But our efforts to work well with lenders are going far beyond this question of the False Claims Act, which really is a problem of the past, I will be honest with you. A lot of the False Claims Act activity was kind of a result of the many people who engaged in wrongdoing in the run-up to the crisis and never really received any kinds of consequences for that. And so there was just the desire to go out there and make sure there were some consequences. I don't see that as the problem of the future. What I see as the problem of the future is making sure that FHA's handbook and rules are extremely clear, that there are excellent staff at the FHA Resource Center and at the National Servicing Center to answer questions, that we make it easier for lenders to engage with us, that we are fully transparent in changes we make to the FHA program. We are very fortunate to have the ability at FHA to put out, you know, rulemaking goes through the APA rulemaking process where you get to see a proposed rule and you get to comment on it, and then we have to take those comments into account and write up those comments and putting out the final rule. But for most sub-regulatory guidance, which the vast majority of the FHA program is kind of, the nuts and bolts are at the sub-regulatory level, agencies can just do stuff without asking anybody. And as someone who spent most of their life outside of government, I would see policy changes and I would be like, why did they not call me before they did that? And I'm sure many of you have had that thought over the years as well. And so what we're trying to do is use this unique ability we have to put things on what we call the drafting table, which is a place where we can informally gather public feedback on changes we're going to make to the handbook. And we can hear from consumer advocates and lenders and servicers before we put something into policy. And that has worked incredibly well over the past couple of years. Our policy making has been so much sharper and better because of it, and because of the strong relationships we've built with trade associations, consumer advocacy groups, folks that we talk to folks on the regular all the time, even when there's not something on the drafting table. And I think that right now, if I were a lender, I would be very excited to partner with FHA.
So that's a great segue into my last question, but my second to last question, which is not the softball, is on the life of a loan on MIP. So we've reduced the amount, which is great. I think it's probably at a reasonable level. 1/3 of a percentage point is a big deal. It's not a game changer, but it can make a big difference on a lot of loans. Adds up over time, but over time is the problem, right? That this stays, no matter what, no matter how much equity you have, no matter how many months you've paid your loan on time, every single month. How do we deal with that? Because that's a big difference in the execution for the borrower between you and Fannie and Freddie and many bank products.
And absolutely, and I'm going to give you a pretty fulsome answer to that, and everybody needs to listen to both parts of my answer. That's just like a pre-clue here. FHA mortgage, our business, we are a mortgage insurer. We are not Fannie and Freddie. We don't buy the loans. We are a mortgage insurer, and we insure that mortgage until you are out of that mortgage, until you owe zero on that mortgage. There is no time where our mortgage insurance falls off of the product. At Fannie and Freddie, when you get private mortgage insurance, that falls off, right? And then you get to stop paying for it because you're not insured anymore. But Fannie and Freddie also have another charge. It's called the G fee. It's not exactly analogous because we don't do what Fannie and Freddie do, but that G fee, which is baked into the rate that you pay for your mortgage, that is a life of loan charge, and that's what Fannie and Freddie basically get paid to do this. And so for us to drop off that insurance premium when we are still insuring you is something that is theoretically difficult and from a modeling perspective expensive. When we do the modeling that's required for a federal lending program under the Federal Credit Reform Act, which for those of you who don't know that legislation, let's just say it's no joke. We have to model things for the 30 years of that loan. So the first part of what I'm saying is our mortgage insurance isn't the same as private mortgage insurance, and you can't really equate them when you're thinking about them conceptually. That said, we live in this reality, and we know that the fact that there is a life of loan insurance premium that doesn't go down is a differentiator of our product, and not in a good way. And we also know that as a borrower's equity goes up, that they are in fact less risky to the fund. So we are looking at whether there are things we can do in this area. Again, we are an on-budget program, basically. Like, you might say, well, isn't FHA kind of like off-budget? Don't you get to make a bunch of money and spend your money? It's not how we work, actually, sadly. So we return receipts to the federal government every year. That's called a negative credit subsidy program, and we contribute to the general revenues of the United States of America. When we make changes that cause us to make less money, that has a budgetary impact, even though you don't see it in a line item. So we have to weigh all of these things as we try to look at it. But, we've in this term, we have kind of a limited time. I am hoping that our time will not be so limited and that we can continue to work on all of these great things that we're working on. And that is something that we continue to reassess that every single year.
And we may have a more fulsome conversation about that in January, one way or another. Last question. How can we do a better job of working with you to serve the purpose of the Black Homeownership Collaborative?
So I want to thank everybody here who's come into our office to talk to us. A lot of you have. A lot of you have met with us on Zoom. Especially grateful to people who actually make the trek down to L'Enfant Plaza and the historic Weaver building. It's really incredibly, raise your hand if we've done something because you came to us and told us to do something. So that happens. That is a thing that happens.
Yes, but the room has a 8 or 9 raised hands, and that never happens when we're talking with government officials. Yeah. So thank you for that.
But for those of you who didn't raise your hand, if you haven't come to talk to us, come to talk to us. We're friendly.
Just don't use a sports metaphor.
Oh yeah, well, and also we don't give you food when you come to visit us because we're not allowed to do that.
Right.
It's really important for us to hear from people working in communities with borrowers, what are the barriers that you're encountering? And are they myths or are they facts? Help us do myth busting around FHA. FHA loans don't take longer to close than other loans. FHA loans don't require that you have handrails or whatever people imagine some of the old minimum property standards are that are much more skinnied down now. FHA is a going concern. Help sellers not discriminate against FHA loans, which happens all the time out there. I don't even know why a seller should get to know what kind of financing somebody is coming with, because that's just another area where stereotyping and misimpressions can creep in. But if you see things that are true about our program that need to be fixed, come talk to us about them. Some things, people have sometimes come to me and we can literally fix something in a couple weeks. Sometimes it's, if it's a rule or something that has to go through OMB, it takes longer. But we are very responsive, and there is no more important audience in my office than the people sitting in this room today. So please come talk to us, tell us what you need, tell us how we can help you, and I'd love to get to know those of you who I don't already know.
Well, and I don't think there's been a more important and valuable FHA commissioner since I've been doing this, and that goes back to only 1984 or 1994, so thank you for that. And yeah, and I think people will be very impressed that Julie and David had a conversation that only went 10 minutes into overtime. So thank you very much.
Okay, well, we definitely want to thank our FHA commissioner again. She's wonderful. She's so glad that Commissioner Gordon was here. Thank you again, Julia. So we're now going to turn to some research and data. Young Choi is here from Urban Institute, and the Urban Institute provides valuable research and other data for our 3x30 initiative, our Black Homeownership Collaborative. So I'm going to turn it over to her now, and then right after that, we'll go into our exciting two panels this afternoon.
Oh, I think I have. Okay, good afternoon, everyone. I'm Jung Choi. I'm here to entertain you with a lot of data following Julia and David, and also following your lunch. So if this is not exciting enough, our Matthew from the Urban Institute, he might do a housing finance chart book dance for you after my presentation to keep it more entertaining. But I also wanted to say that Emily and Matthew from Urban, my colleagues, are also here, and they also really contributed a lot on creating this presentation. So this is a joint effort by the three of us. So we will be looking today at some of the achievements that we have made since the Black Homeownership Collaborative started 3 years ago. And here's the contents of today's presentation. I think a lot of you will already know the relationship between homeownership and wealth, but then I will show you several slides to set the stage. And then we will be looking into how we are doing in achieving the 3x30 goal. So that's like 3 million net new Black homeowners by 2030, as David mentioned this morning. Since we're in DC, I'm also going to do a deeper dive into looking at some numbers in DC, both in the city and the metro, that we also heard in the morning. And then I'm going to just go over some of the recent innovations that we have made, which I think also has been discussed a lot in the morning session. So this is a good segue. And then I know that in following my presentation, there's there's going to be some discussion on how to overcome some of the challenges like heirs properties and appraisal biases have been talked. So I'm going to look at several of those challenges and what could be done further. So homeownership and wealth. So this is a recent research that we did showing that in 2022, the wealth gap between homeowners and renters reached its historic high. So you can see that in 2022, the average wealth gap between homeowners and renters were around $1.3 million. And then the median wealth gap was around almost $390,000. And the reason that we have like a greater average wealth gap, as we know, is that the wealth is really skewed among those small number of households and individuals. But then you can see that over the past 30 years, both of the graphs shows an upward trend. So we see about a 70% increase in the median wealth gap between homeowners and renters in this country. And then we see about a 260% increase in the average wealth gap between homeowners and renters. So when we first looked at this, we were kind of also thinking about what is driving this. And especially if you look at the past 10 years, and this is for the median wealth gap, because we kind of wanted to focus on typical households. But we do see that the gap, housing wealth really has made a huge contribution in like growing wealth gap between homeowners and renters. And you can see that this is also related to the housing supply shortages that we have been talking about in the morning. And then you see that from 2013 to 2022, we have a steep increase in the wealth gap, housing wealth gap between homeowners and renters. And what we also was thinking about, well, we also hear a lot of stories that it's really, really challenging to become a homeowner right now. So we thought, well, maybe like renters, since they can't really like use their down payment saving right now, they might be investing in financial investment, and we also saw some rise in the stock market prices over the recent years. So we thought maybe they are still making some money by investing in financial investment. But we also saw that there has been rising gap in the financial wealth between homeowners and renters, and we show in the data that renters, a lot of them don't really have much left to make financial investment after paying for rent, which also has experienced a pretty sharp increase due to the supply shortages, especially over the past decade. And then this is kind of showing that the delays in homeownership are likely to affect your future wealth. So what we show in the x-axis is that the age of buying your first home, and the blue bar shows that median housing wealth at age 60 or 61. So it's like the age near retirement. And what we see is that those who buy their homes earlier in life, they have significantly higher housing wealth at the age near retirement. So what we see is that those who bought their first homes between 25 and 34, those were the groups that have the highest housing wealth in the age in their 60s, and then that number goes down as they buy their home, for those who buy their home later in life. And I also wanted to point out that those who buy their homes before age 25, which is not really happening much these days, but they are compared, the yellow bar is showing the first median home value of the first homes, and this is all inflation adjusted. So they are more likely to buy cheaper homes when they start, but then the amount of wealth that they gain over time, that return is higher for the groups that have bought their homes before age 25. And we also know that homeownership transfers from generation to generation, so it's not only affecting your own wealth, but then it's likely to affect the wealth of your children, because a lot of the parents who own a home are likely to support their child's homeownership in terms of down payment, and that they can also provide some information support. So our research also shows that even after controlling for children's income, education, and wealth, the children of home-owning parents are much more likely to be homeowners earlier in their life. And as we know that Black young adults are much less likely to be having home-owning parents. So this is another factor that explains why there has been a persistent racial homeownership gap, despite some of the changes and efforts that were made to kind of eliminate the more direct racial discrimination in this country. So how are we doing with achieving the 3 by 30 goal? So when the pandemic started, I think many of us in this room was really concerned because like in 2019, just before the pandemic hit, we were finally seeing some improvement in the Black homeownership rate. So for all the other race group, we actually saw that homeownership started to increase back up from 2015, except for the Black households. So they were experiencing an ongoing decline, and then in 2019, we were seeing some positive numbers finally, and then the pandemic hit, where so many of us were at the collaborative was super concerned that we will now like see a reverse trends, and then we will see a further decline in Black homeownership. But then to our pleasant surprise, we did see that Black homeownership continue to increase until the most recent data, which is 2023, and then what the data show is that between 2019 and 2022, we have added about 466,000 Black homeowners, reaching about 6.92 million Black homeowners in the current market. So the Black homeownership rate over this time increased about 2.1 percentage point, and then we were able to close the Black-white homeownership gap by 1.3 percentage points. So some progress has been made, but then it's not fast enough to reach the goal that we are hoping to reach by 2030. So if the Black homeownership rate increases by the current rate, we will have about 8.5 million Black homeowners by 2030, which is about 1 million short of the goal that we're trying to achieve. So now let's look at some numbers in DC and US. And so just some for background, I kind of put where we are in this green. I don't think it's green in the screen, but it's supposed to be green, but we're right there in the green dot. And then we're in DC proper, where the population is about 670K. And then you can see the larger DC metro area, which has about 6.4 million population and 2.4 million households. So as we know, Black households account for a higher share in both DC regions. In the city, there's about 39%, that's in the yellow area here in the graph, of Black households in the city of DC. In the metro, that share is about 26% compared to about 12% in the nation. So I thought when I first kind of looked at this number, I thought this graph was really interesting because we kind of see really different patterns in like the trajectory of Black homeownership in DC, the city of DC, and DC Metro. So what we see here is that, so the sky blue line is the homeownership rate trajectory of DC Metro, the darker blue is the city of DC, and the green line is the US. So in the US, as we know, over the past 40, 50 years or so, we haven't really seen much changes in Black homeownership. The number was about like 42% in 1970, and it's about 4%. So we saw about 2 percentage point increase. But in the city and in DC, up to 2000, we actually saw some upward trends in Black homeownership. So, but then after the Great Recession hit, we actually see that we've discussed this in the morning. There has been some decline in the city of DC in terms of Black homeownership. So Black homeownership is currently about 33%. In the metro, however, we have seen an ongoing increase in Black homeownership. So what we see in the DC metro is that The homeownership rate was about 31% in 1970. That number is now above 50%. So we're hoping to see this kind of direction and also our national numbers as well as other numbers. And I think it was kind of enlightening for me to see that there is some areas in the country that have made some progress, and we're actually in the metro that have seen some improvement in Black homeownership. So in the city and a metro in both the DC regions, we actually have a smaller Black-white homeownership gap than the nation as a whole. So in DC, we talked about like real challenges in affordability in DC, and that holds for both Black and white households. So they do have the lowest homeownership rate, but the gap between the two groups is about 15 percentage points. So it's lower than other areas. And then in the US, we know that there's almost about 30 percentage point gap between Black and white homeownership rate. But in DC Metro, we are seeing about 20 percentage point gap. So if we are able to achieve the 3 by 30 goal by 2030, we are estimating that we will have similar homeownership rate of what we see in the DC Metro. And then the DC Metro experience does suggest that this is like an achievable goal that we can still pursue despite some challenges in the market right now. So this is the rent burden share. So like as like homeownership is becoming more and more challenging, the increase in rent is also increasing the share of renters paying more than 30% of their income on rent. And this yellow area is those who are paying more than 50% of their income on rent. So what we see is that Black renters who are on the left side in all three regions, they have a higher share of rent burden households, which also makes it very difficult for Black renters to save up for down payment compared to white households. But then you can see that overall DC rent burden numbers are lower than the nation, especially the share of severely rent burden households are smaller in both DC proper and DC Metro compared to the nation. And then when we look at those who are homeowners, we kind of talked about sustaining homeownership, but then I think our next steps, like once we achieve the 3 by 30 goal, is like further work towards like reducing the gap in the housing wealth by kind of looking at the home values. So you do see that the median home value gaps exist in all three regions. It's smaller than in DC. It's smaller in the US. There's about a $50,000 gap, but then it's much higher in the city of DC. There's almost over $330,000 median housing value gap between Black homeowners and white homeowners. Although you can also see that in the city of DC, the median home value for Black households is higher than the US. So there's like a lot of numbers there, but then that's the trends that we are seeing from the graphs. And then I'm gonna briefly talk about some recent innovations that we have made. First is the one that Julia just talked about on like forbearance and loss mitigation. So this recent research does highlight that we were able to disproportionately help Black homeowners to stay in the house because of the forbearance policies that were in place. So what we saw in the data is that Black homeowners were most likely to be taking advantage of forbearance during the pandemic, about 20%. So 1 in 5 Black homeowners were in forbearance during the pandemic, and this is the highest among all race and ethnic groups. And then among those, like forbearance, we kind of estimated the number of Black homeowners that we saved from entering into foreclosure, and that number was about 76,000. And then and that accounts for about 1.7% of like all mortgages by Black homeowners, which again is the highest among all race and ethnic groups. So this number is like maybe you can think this is like smaller than expected, but then there's also a lot of other things that were going on. We actually saw a faster job market recovery than we expected, and the home prices really was high. So this is also kind of impacting the number of loans that didn't go into forbearance. But then overall, the story tells us that we were able to disproportionately save Black households from entering into foreclosure by these swift actions that were taken in place by a lot of the people who, and I know that a lot of the people today have really worked hard to make this happen. And then we did talk about special purpose credit programs. We have seen an increase in attention of special purpose credit programs for lenders to offer credits to underserved borrowers. There has been several lenders. I know that Marty and then Lisa also mentioned about their special purpose credit programs that took place recently. And then in 2022 and 2023, Fannie and Freddie also launched their own SPCP programs, and also they have started to purchase SPCP loans from the lenders. And then I think there's some cutoff in the slide, but then this was just a little self-promotion of the work that we did with NAFA, because what we found was we heard a lot of stories that especially the small lenders writing a written plan to justify SPCP and really kind of digging into the market data was challenging. So we did launch a data toolkit that helps the lenders to identify what's going on in their markets and also kind of design an effective programs to target the population that they want to kind of serve, and also help them to kind of write the written plan. So that is in this link. So please check it out if you're interested in looking at it for more. And then we did do a little bit, I think, discussion on first-gen home down payment program this morning. And what we did initially in the research was so we kind of wanted to estimate the share and the number of Black home buyers who can benefit from this program. So this graph is kind of showing that most of the DPA programs are just focusing on income eligibility. What we have estimated is that if we increase the income eligibility to, instead of 80% of AMI, which is mostly the federal DPA programs, to 120, but then further impose first generation criteria indicating that your parents also are not owning a home, how does that kind of serve or target households of color? And we kind of find that in a typical income eligible DPA program, about 18% of Black home buyers would qualify, but if we impose first generation down payment program, that share would increase about 30%. So this is a better targeting program if you want to serve the Black or Hispanic community. And then the other debate, I think we heard in the morning that there are some of the criticism towards demand side policies, especially in this really heated, low supply housing market that is only going to increase price. But what we see from these more targeted programs is that the number of people that can qualify actually is smaller than the income alone program. So it's a better targeting, and it has less upward pressure towards increasing home ownership. So we know that a lot of while waiting for the federal government has announced again in their new housing affordable plan to kind of this plan is still included in the White House plan, but then while waiting for the federal government to take actions, there have been a lot of state and local programs that have started to create and implement this program. And then Fannie and Freddie have also collaborated together, and then we also partnered with, I think they also partnered with a lot of people who are sitting here today to kind of really create a clear definition of first generation home buyer, which there's multiple generation. I won't go into detail, but then depending on how you define, there are some changes in the potential number of people who are eligible, and then it also changes how easy or difficult it is to implement this policy. So the the GSCs have announced their definition of the first-gen homebuyer in the Equitable Housing Finance Plan, and we're hoping that this will also facilitate more lenders and more states or localities to take a look into these programs and implement first-gen DPA programs to serve those households who don't benefit from receiving down payment support from their families. And then Julia has mentioned that the FHA also started to include positive rental payment history in their underwriting, and that also happened among both Fannie and Freddie over the past 2 years. So there has been some movement to really incorporate rental payment history into mortgage underwriting after having this discussion for a really long time. And then the GSCs and some of the startup companies are really making it more easier to report positive rental information to the credit bureaus. And finally, I think still there needs to be more efforts to change the single-family zoning. Although the process may seem slow, but then over the years, a lot of the states and municipalities have worked hard to reform the single-family zoning. So these green dotted area is the places that were successful in changing the zoning and land use regulations to facilitate more development of ADUs and 224s and also transit-oriented development. So there has been some progress to make innovation in this space, but then there are still challenges ahead, especially in this market where we actually saw a huge surge in interest rate amidst the lack of supply. So this black line in the left is actually showing that the active listing numbers have fallen significantly over time from 2016 to 2024. You can see that although there's seasonal fluctuation, the number of active listings, listed homes for sales have been declining. And then you can see that below that red area is the homes that are below 330K, and that share has declined significantly. So in 2016, that number was around 70%, now it's around 45%. So there's really lack of affordable housing that especially Black households with lower income or lower wealth can take a look at and have an opportunity to purchase. And we can also see that especially in the most recent 2 years with the rise in interest rate, there has been a huge rise in the median housing expense to income. So how homeownership has become more unaffordable in the recent 2-3 years. So this is actually showing in our mortgage data. So I just want to make a caveat that the 2023 data, I calculated this from the HMDA data that is out right now, but it's not final, so there might be some slight changes in the numbers once the CFPB releases the final HMDA data. But what we see is that from 2021 to 2023, there has been a huge drop in mortgage origination in all three areas. But in DC, there's less drop because there's already, even in 2021, it was really difficult to purchase homes in DC, but there has been still 25% drop in the mortgage origination for home purchase for Black households. There's been about 48% drop for in DC Metro, and then in the US, the drop was about 35%. So there has been a huge decline in the Black home buyers' mortgage origination over the past 2-3 years. And then I think we have talked about denial rate in the morning. I would also like to mention that the application withdrawn from the mortgage process have also increased between 2021 and 2023. So with the rise in interest rate, a lot of people are just pulling out during the mortgage application, and you can see that. So this blue line is 2021 numbers, yellow line is 2023. So you can see that the increase has been happening for all regions, for both Black and whites. But you can also see that for all regions, compared to white borrowers, the people who are taking out their mortgage application certification is higher for blacks compared to whites. And you can also see that there has been an increase in mortgage denial rates. And then in all three regions, again, like you can see that denial rate gap is significantly higher than the application withdrawal gap. Black mortgage applicants are substantially more likely to be denied of mortgage compared to white borrowers. And what we also see is that between 2021 and 2023, we see a greater jump in the denial rate among black borrowers compared to the white borrowers. So this is suggesting it's becoming more and more challenging for black borrowers to access homeownership in the current situation. And then what we're seeing is in order to lower the mortgage payment, a lot of the people are putting, let me just see if and then I just want to really kind of quickly mention that as I think, I forgot who mentioned this, but then we are seeing, I think it was Lisa in the morning, we are seeing that there has been a growing share of mortgage denials because of high debt-to-income ratio in the past 2 years. And then there has also been a significant increase of share of borrowers who have a DTI ratio of 45% and above. So this is all kind of driven by the rise in interest rate that occurred in the past since 2022, early 2022. And then in order to lower the monthly mortgage payment, we see from the data that more and more borrowers are putting more than 20% down. What we see from the data is still, so that number has, compared to 2021, for all race and ethnic groups, we can see that those who put 20% down has increased. But then still, we are seeing that black borrowers are less likely to put 20% down compared to white borrowers because they are financially resource constrained. So this is meaning that those with like lower wealth and lower financial resources are having more challenges in accessing home ownership because they don't really have substantial wealth to put down and lower the mortgage cost. And then we are also seeing that over the years, there has been a rise in the borrowers with higher FICO scores. So overall, we kind of see that those with higher wealth and higher FICO scores are more likely to enter into the current home buying market compared to those with lower FICO scores and less wealth. And this is also disproportionately impacting black households. So, we talked about appraisal. This is kind of data showing that as the share of people of color increases in the neighborhood, we are seeing that the share of homes that are appraised below a contract price also increases, especially in the US. There are some regional variations. We do see that in the city, there are less share of properties that are appraised below the contract price. So I think this kind of varies by region, but overall, like we do see that as share of households of color increases, the appraisal gap is likely to be larger. And then this is, I think, the next panel's discussion on what the NAR settlements how it will play out. There has been some initial research done in this space that shows that this would likely to disproportionately harm households of color, especially black households, because they don't have financial resources to pay an upfront fee to the real estate brokers when they purchase a home. So the research shows that the number of black renters who will qualify for a $250,000 mortgage will fall about 26%, which is the greatest decline among all race and ethnic groups. Finally, I'm going to end with like some of the climate change data. So we do see that the average home insurance premiums have increased, and the growth rate of the insurance premium is going up over the years. And then the other thing that we see in the data is that black households are less likely to have home insurance compared to the white households, especially in the nation. About like 12% of black homeowners don't have a home insurance, indicating if they do face national disaster, they are much more likely to face a greater loss. So I will end there. Thank you for listening, and I'll turn it over to Charles.
Thank you so much for that information and research. Now we're going to quickly go to our next panel, and this is to follow up on Jung's slide. We're going to talk about the future of buyer representation in the home buying process with David Dworkin as our moderator, Steve Brobeck from the Consumer Federation of America, Sarah Rodriguez from NARAP and the Hispanic Wealth Project, and Mosé Gatling from New American Funding. And we'll also ask the panelists to make sure that they can have the mic close enough so that everyone can hear you all. Don't put the mic so far away. Thank you.
Thank you. Appreciate that, Charles. We'll have everybody seated. Thank you. And I'm going to start us off here. Well, thank you all for being here for this really important panel. The settlement with NAR and other real estate companies is such a big mover, as we saw in Jung's slide. 26% for Black buyers, that's pretty dramatic. And so we want to explore that further and talk about where we go from here. We have a great panel to do that. I think really some of the leading experts in this space. Steve Brobeck served as executive director of the Consumer Federation of America from 1980 to mid-2018. And he now holds the position of senior fellow, where he continues research and advocacy on issues including personal savings, auto insurance, burial services, and residential real estate brokerage. He's also published research on social change, including the first annotated bibliography of the consumer movement, the modern consumer movement, references and resources, and has edited 2 encyclopedias of the consumer movement, the Encyclopedia of the Consumer Movement, and Watchdogs and Whistleblowers, a reference guide to consumer activism. So if you're looking for summer reading, I'm going to put in a plug. Sarah Rodriguez has over 20 years of experience in Virginia real estate title industry. She is a sought-after speaker and educator in Washington, D.C., in the Washington, D.C. metro area, and her practice specializes in all matters related to residential and commercial real estate transactions. She is the recipient of the Housing Wire Women of Influence Award for 2019 and 2019 and 2020. And she is a member of the Virginia and District of Columbia Bar Associations and has practiced immigration law, family law, and real estate law. And Mosé Gatling, also a sought-after speaker, is the Senior Vice President of Strategic Growth and Expansion at New American Funding. She's a highly experienced loan officer, including positions at Loan Depot, Guild Mortgage, Home Community Mortgage, MetLife, and Bank of America. And in 2023, she was recognized as a woman of influence by Housing Wire magazine that year, and she ranked 15 in the country for FHA originations. That's pretty impressive. So thank you for welcoming our panel. So let's jump. That was too close. Let's jump into it. First, give us a little background, Steve. We're going to keep this short. Everybody's going to talk for a few minutes, and then we're going to have a conversation. We're going to invite you into it, because this is something that I think everybody's been talking about. But give us a little background, Steve, on how we got here. What was the impetus for this suit, and where we are now.
Thank you, David, and thanks for the opportunity to participate in this important forum. A century ago, the industry tried to explicitly set and enforce commission rates. Beginning in the 1940s, the Department of Justice began filing lawsuits that challenged this rate setting, and in court victories or settlements, DOJ first prohibited explicit rate setting and then recommended rate setting. But as the 1983 FTC the Federal Trade Commission report showed, this was a massive report, several hundred pages. It remains, I believe, the most accurate description and analysis of the industry. If you want an introduction to the industry, read the 25 single-space executive summary of that report. It's very illuminating. According to that report, rates were still being effectively set in part because of the industry's mandatory commission offer rule. That is, to list a property on a local multiple listing service, I assume you all know what a multiple listing service is, the listing agent and effectively the seller had to offer a fixed commission to buyer agents. And what that meant effectively is that buyer agent commissions were not negotiable. Not surprisingly, listing agents and the sellers were reluctant to offer a rate below most other rates that were being offered because of the fear that buyer agents would steer buyers away from their property. This is an important reason. Commission rates have been relatively uniform and relatively high, 5 to 6%. Now, they range greatly throughout the industrialized world, but they're as low as 1.2%, according to the last survey I've seen in the UK. And there's a huge difference if you think in terms of aggregate dollars collected between 1.2% and 5.5%, which it appears is the average rate in the country now. Now, to be fair, in the UK, they have a different system. They have estate agents. There's typically one agent involved in a sale, and that agent really functions as a facilitator, not as fiduciary. In 2019, 2 class action lawsuits were filed that challenged this mandatory buyer agent commission rule. They were filed in federal courts in Chicago and in Kansas City. The Kansas City case proceeded the most rapidly, and last October, a jury ruled in favor of the plaintiffs, awarding them $1.8 billion and the possibility of treble damages, which would bring the total award to over $5 billion. And that was essentially just for home sellers in the state of Missouri. There was also a commitment to make regulatory and structural changes, but those weren't spelled out in detail. The jury decision had several impacts. First of all, as you know, it generated a great deal of press coverage, including somewhat inaccurate headlines that said there would no longer be 6% commissions. But all of this press coverage was really the first time that many consumers were exposed to the residential real estate brokerage industry. And even though, according to all surveys we've done, other people have done, consumers are not very aware of what's going on in the brokerage industry, nevertheless, there was a quantum leap in terms of aggregate consumer understanding of what's going on, especially by people who tend to be well educated and read newspapers. Second impact was that the jury decision encouraged copycat lawsuits all over the country. There were a couple of dozen major ones. They're still being filed. And when you think of the liability that is being created, it's just huge. It's certainly well in excess of $100 billion. The industry simply can't afford that. Third, the jury decision emboldened the Department of Justice, which since that decision has made statements that it opposed all seller payments of buyer agent commissions. So all of this persuaded the industry, I think they were very wise to do so, to try to settle all the major lawsuits. In March, the industry announced the consolidation and settlement of the two major lawsuits, agreed to awards that may end up totaling $2 billion. I've seen different estimates. And also, the industry agreed to stop posting commission offers on MLS websites. Now, I've been referring to the industry. I mean the National Association of Realtors and its members, which includes about, somebody help me out. Is anybody from NAR here? Maybe 85% of the industry. But much remains to be determined. First, will DOJ accept the settlement? As I indicated, they've given every indication that they will not. Second, can multiple listing services include the commission offers any place in their listings? They said they would drop the listing, the explicit listing of the offer, but some large MLSs plan to include those offers as concessions. Now, concessions can be anything from we'll fix the fence to the plumbing, but they're proposing to put a dollar figure or maybe just a willingness to, on the part of the seller, to provide some compensation to the buyer agent commission. So that's a question. And then a third issue is, will sellers decide not to offer commissions? Now, especially in a buyer's market, I think you might see some sellers say, no, I'm just not going to do that. I think I can sell the house without having to pay not only my own agent, but also the buyer's agent. And then if they aren't willing to do this, how will buyers with limited resources afford the commissions? Now, to me, the logical way is just allow them to add that to the mortgage. But there are federal regulations, GSE and FHA regulations that limit the concessions and the ability of buyers to include the buyer agent commissions in their mortgages. So will buyers be able to afford buyer agent commissions if they can't finance them? Well, I think that's the subject of our discussion.
That's exactly right. And I can't think of anybody better to kick us off than Mose, because you've been already dealing with this on the ground.
Yes. The proposed settlement, y'all are stressing me out. That's what I have to say about it. Y'all are just stressing me out. I feel like I'm a little bit of an OG at this, David. About 4 years ago, I started partnering with a home builder that's in my market. I'm in Las Vegas, and they offer a great product. It's about $160,000 less than our median sales price. They help with closing costs to all buyers. They do all these great things. However, they do not co-op with agents. So what had to happen in my business was I had to be able to engage with real estate agents that would bring buyers in and maybe coach them through or talk about a buyer brokerage agreement, or how we affectionately refer to it, a BBA, and to be able to get that negotiated and to talk to their client about it in order to simply not sell the home, because I guess where in America do you ask someone to work, give them an option to work for pay or for not getting paid at all? But that's what this kind of boils down to. So I started having to do this about 4 years ago and talking agents through the fact that they can negotiate an agreement, they can still get paid, the homeowner saves money, it's a great option for them, whatever the package the builder happened to be giving. Fast forward to now that some of these things are coming to fruition, it's affecting my market at large. There are additional national home builders. I feel this is a good sampling for people to kind of consider, because things tend to move from coast to coast. If it hasn't happened here yet, perhaps it could be the standard. Homes are sold based on market price, period, point blank. So all the things associated with the home sale follow market. So if the sellers are paying closing costs and that's what market is commanding, that's kind of what happens as a standard. The thing is, if agents are not being offered commissions and that becomes standard, it will move that way as well. So it becomes harder for homeowners. So now that I have 2 additional national home builders that are either paying nothing, I say nothing, but it's $400 flat right now in my market. A national home builder is paying real estate agents. Another one went to $5,000 flat, regardless of home price. Now we have more of where available housing is not actually paying a real estate agent. So the builder that I've worked with for the past 4 years is in the top 100 home builders in the United States, but 98% of their business is not with real estate agents because, again, they are being given the option to work for pay or not. So I feel like inadvertently it's causing somewhat of a steering process. Like I said, I come from mortgage, so we use aggressive words, so forgive me up front, okay? In my world in mortgage, it's called steering. If I don't offer something or I don't give a product based on pay, I can't do that as a mortgage lender. But the system is being set up to where agents are being forced to make that choice. They're gonna show homes where they get paid, right? Just who wouldn't?
Pretty much.
Yeah, who wouldn't? So if I qualify a buyer right now, that immediate impact on my business is how do I quantify to a homeowner that you can qualify for a home loan as long as you don't have to come out of pocket now to pay your real estate agent. There is no form for that. The mortgage industry hasn't been set to change by this proposed date in August, so it's definitely going to affect the mortgage industry probably more than we're all wanting to own up to right now. And it's also caused home buyers of mine that I have dealt with to be declined because of the financials. And sometimes when it comes to buyer brokerage agreements with real estate agents, it's not necessarily part of a home builder's purchase contract or a resale purchase contract. The documents were never set up to describe pay to me as a loan officer. So when someone's qualified, they go into contract, they are happy, they think they're gonna get this home, and I find out by way of typically the title company, who you're going to hear from next, I find out what those economics look like on the pay, and all of a sudden I find out the person doesn't qualify. Now, this person has lost the dream of home ownership, and it's very, very hard to get them mentally back in the game when they're discouraged to that degree. So the homeowners that were declined were definitely diverse buyers, Black and Hispanic. 6 months ago, 7 months ago, they had to pay 3% co-op, I think was their buyer brokerage agreement, to their real estate agent. The agreements varied in length from 60 days to 12 months, meaning that person would legally have to pay this agent regardless of what home they purchased, that amount of money. If the seller doesn't pay it, the homeowner is then obligated. So it ties my hands as a mortgage professional, especially when I find out at the end of the process that this is a cost. There's no way for me to quantify that up front. So it is an immediate impact. That, and along with, like I said, now my market is basically saying they're not paying agents a higher percentage. Some are not paying at all, or they're paying a flat fee of $400, $500 to real estate agents, which then falls back on that home buyer that if they can't pay all the things associated with getting the mortgage, such as down payment, closing costs, which I call the total cost to close, then there's this unknown that I'm sending buyers out into the world like, hey, you're qualified, I hope, right? Because I don't know what they might have to pay a real estate agent because it boils down to the house they choose. So it has been an immediate impact, and the trauma that comes with, we're talking about home buying trauma all the way back from redlining and pre-Fair Housing Act. And then we talk about the trauma that came along with the financial crisis in 2010, right? With people losing their homes and being afraid to take out mortgages. And now I have the trauma of home buyers not actually getting to buy because they can't. I have to go explain this because I deal with the money, that they can't buy because of this 3% or 2% or 1% that they now owe, and how somehow it's no longer being included. And how do we keep just having this reoccurring trauma in Black home ownership that is sidelining people from buying and really just souring their idea of what home ownership is supposed to be.
Yep. Sarah, tell me about what you're seeing at the closing table and what you anticipate
Well,
seeing.
first of all, I want to thank everybody that's here and taking, putting attention to what I think it's a very important subject that is definitely going to impact our minority communities. But I really hope that you take it further than just being present into this conversation and trying to understand all the moving parts, but you actually have a voice for those that don't have a voice. And I'm going to go into my anecdotes, but I want to say a couple of things. Number one, for the last 100 years, give or take, the system might have not been perfect, but the system has helped many be able to get home ownership. I find it interesting that now, when we are seeing that the majority of the population that is coming to be homeowners are from a minority demographic, is now when we have a big issue with how this has played out. The fact is that a lot of the sellers that have been able to create wealth by purchasing properties and having the seller use closing concessions, however you want to call it, to be able to help this buyer get the representation that they need was fine. And now that we have the majority of the demographic that are the new home buyers, young populations that haven't been able to create the generational wealth building that maybe some other demographics have, now we have an issue, is something that is very troubling to me. So we'll start with that. The second part is that I feel that, of course, we should always be looking to see how can we create more homeownership. We know the facts cannot be disputed that homeownership creates a safer environment, stronger communities. It creates wealth for some of those demographics that truly don't have another way of creating wealth. And now we should protect that, but we shouldn't make it impossible. As a Latina, I can tell you that a lot of my demographic struggles with trying to create that wealth, because as a demographic, the majority of the Hispanic population is just starting into their home buying years because they're just starting to work. They're an average demographic of 30. A lot of the Hispanic and other minorities, Black and brown communities, do not come from families that have been blessed with generational wealth, so they are starting to really make progress in getting a college degree, going out there and starting to get better jobs so that they can start worrying about their 401ks, putting money aside, and start to build their nest egg. And they can do that by homeownership is a really great way of creating wealth. In fact, we've done studies at NAREP where the average Latino renter has an average net worth of $6,000 versus the average Latino homeowner has a net worth about $190,000. That's 28 times the difference of wealth between a homeowner and not. So now that we have Black and brown communities that are finally in a position where we can start supporting them and start, lowering that wage gap and allowing them to become homeowners, which is the American dream, guys. Now we start putting impediments in there with a hypothesis, because this is all that there is, a hypothesis that that is somehow going to lower the sales price and make things more affordable. Whereas, unfortunately, the reality that we have seen is what Mosi said, that the prices of homes are determined with what's out there in the industry right now. It's not going to be whether a seller pays or doesn't pay a certain percentage for their compensation. It's going to be what can the seller get in this market and who is going to go out there and give him the most money. Because at the end of the day, for sellers, it's about the bottom line. What creating these additional steps, which in theory, in a vacuum, sitting down with air conditioning, a water, my wine, whatever you want, might not seem like a big deal. The reality of the situation, when we get to boots on the ground, is that it is a big deal. First, we start going down the pipeline to see what are some of the things, some of the unintended consequences that this can create. Well, number one, we say, okay, well, the listing agent, the one who's working for the seller, is definitely going to get paid, because I don't know about you, but I like to get paid because I have bills to pay. You know, when I was an immigration attorney, I worked very hard, but I had to get out of it because I would get paid in taquitos, right? And my husband said to me one day, he's like, if you can pay your bills, the electrical bill, your mortgage with taquitos, go for it, babe. Otherwise, you really need to get paid because we need to, you know. So that's the same thing for
They
real
were
estate
really
agents.
good ones.
They were really good taquitos, but I couldn't sell them off. So you know, we were fed. But the reality of the situation is that realtors are providing a valuable service out there for clients, just like a divorce attorney. Let me ask you this. If you were getting a divorce, would you like it if your spouse's attorney was the one that was negotiating on your behalf, or was the one that was determining everything? Because this is essentially what we're trying to do. We're saying the listing agent that works for the seller can go ahead and, you know, do certain administrative tasks for the buyers. These buyers that a lot of the times are first-time home buyers that might not understand what it is to have a home inspection, or how important it is, or what they need to look for, not only with loan, but the title company, or what their rights are. These agents are also there to be, you know, to not only help them with the buying process, but also alert them as to certain products that are out there. Yeah. As a title company, I'll leave it with this, I will tell you that I've been in the title industry for over 20-something years after I left, you know, immigration. And I will tell you that a lot of the times I have a lot of for sale by owners, we call them, where there's no agents involved, or where there's a listing agent and the buyer is not represented. And I always see that those transactions end badly, because the buyers think that somebody out there is looking out for them, or that they are going to be honest about what they're going to be describing the way of the house is, or something like that. And then when they move into the house and the first rainy season comes and their basement floods, or something happens that they didn't know and they weren't expecting to have, you know, that roof, or they didn't know that they could negotiate to get that roof fixed, then we start seeing that there's a problem. And more often than not, especially in those minority communities where these home buyers are already stretched thin, trying to afford a home in this market, then their dream of home ownership goes up in smokes, because they have to decide, am I going to pay that roof, or am I going to pay my mortgage?
So I want to talk a little bit about the time differential that a buyer broker invests in a deal as opposed to the seller's broker. And I also want to talk about the income differential that exists between, say, a first-time home buyer or first-generation home buyer and a multi-generational, multi-home seller. But first, I just wanted to clarify a couple things, because this issue about comparing U.S. rates to foreign rates comes up a lot in terms of commissions. I've heard it many times, and principally, I always object to comparing different countries with different legal structures and how people are compensated, just as in general. And you mentioned that, Steve, is that they can be very different. But also, when you look at all of the countries, you see Germany, 2 to 6%, Croatia, 6% and split, Czech Republic, 5 to 10% split, Italy, 6 to 10 split, UK as low as 1, but as high as 7, but also split. And so the split, I think, is one of the issues that I'm really worried about as we move forward with any possible suit by the DOJ, who's signaled that pretty strongly. But to start with, let's just talk about what the broker, the agent, the buyer agent does, and the time commitment there. So we can start Mose, and then Steve, and then we'll come back to you, Sarah.
The buyer's agent in this situation is really the glue to the transaction. Let's call them the glue. They are taking buyers around. They're a little bit more than an Uber, let's call it. They're taking buyers around to look at homes, but they're also helping get people financially ready. They pair them with all the resources that they need. They're the ones that often pair them with a lender. or directly to a housing counseling agency to get what they need as far as resources for home readiness. The seller doesn't do that. Like sellers, people that largely are listing agents will have to go learn that skill, because I think you'll find when you look at real estate agents that there's a big divide in who tend to carry most of the listings versus who tend to represent buyers. And also most of the buyers agents tend to be more diverse buyers, okay? In my market, about just under 40% of all homes closings are to Hispanic buyers. I'm in Las Vegas. So when we talk about that, it is going to be Hispanic representation in a lot of the cases for those very buyers in the community, and not necessarily the listing agents, just because of how those numbers play out. So it could be 6 months, it could be a year, it could be 2 years while that person is getting ready for whatever they need to do, whether it's budgeting, it's credit items, it's family demographic and they can't find anything. It's even more prevalent in this market when housing supply is at an all-time low. How do you find that home, and how long does it take to get that home? It's just a longer process than it used to be.
Writing multiple contracts,
Multiple
doing
contracts
CMAs
and
for all
offers.
these contracts,
Yes.
looking for grants. I mean, it's a lot of work.
It's a lot right now to help a home buyer, especially in this market, find something that's a good fit.
And Steve, I mean, Consumer Federation of America has been fighting for consumers forever. I'm a member, I'm an avid fan, but what we're talking about here is which consumers? Low-income consumers, high-income. How was that factored into some of the scholarship on this?
I think the challenge is a little bit different than as it's been described. And I would agree that buyer agents face some huge challenges. I don't think that the concern about buyer agents getting paid is quite as significant as is being made out, and here's why. I mean, first of all, you do have grants, which Moshe has been using very, very effectively, and more agents, I think, if they were educated about those opportunities, would be able to take advantage of them. I think quite a few agents just don't understand those grants. Also, the FHA does allow a 6% concession. I'd assume that was taken up with the traditional closing costs. So I talked to a leader of one of the larger multiple listing services. He pulled out this data that suggested that quite a few homeowners taking out FHA mortgages are not fully using that 6%. But the most important factor is that most of the industry is determined to press sellers to make available funds to cover this commission in some of the same ways they do today. That is, when listing agent will say, look, we have to offer the buyer agent a commission, or at least part of a commission, or there's the risk that the house won't be sold. I mean, that gets back to the steering issue, which is really at the center of a lot of the litigation. And I'm convinced that the listing agents will be able to persuade a large majority of the sellers to offer the buyer agent commissions. And then what happens today and what will happen in the future is that the listing agents will say to the buyer, look, we'll just add that to the sale price. And in fact, there's broad consensus within the industry that the buyer agent commissions are baked into the sale price. The problem is they're implicit, they're not explicit, so they can't be negotiated.
But is anybody going to say, I realize now my seller agent is not going to have to share his fee or her fee, so I'm going to cut my price 3%?
They don't, and then you're going to be seeing...
That is going to get worked out by the GSEs and FHA eventually. It will take time, but let me just finish. Now, if all that fails, the industry is going to do what they did on VA mortgages. VA mortgages could not include buyer agent commissions. The industry went to the federal government. The federal government responded. And now, at least for the foreseeable future, you can include the buyer agent commissions in the VA mortgages. We started calling 6 years ago for the federal government to allow the buyer agent commissions to be included in the mortgages explicitly, not implicitly as they are today. And I believe if this ends up as a real crisis, both the real estate industry and the mortgage industry will go to the federal government and they will get that relief. That relief can be very easy. Simply take the FHA concession at 6% and increase it to 8%. Nobody should be paying 3% to an agent, or very few people should. Every prediction I've seen suggests that the commissions are going to come down somewhat to 2%. When I talk to the people in the industry, that's what they're talking about, 2%, from 6% to 2%, and then they can be financed.
So Steve, let me ask you a couple of questions. So number one, I don't think GSA sets home prices. That's usually, again, done by sellers and the market. Number two, what about financing and appraisals? Because as far as I know, when a lender goes and does an appraisal, they're going to look at the value of the property, not the value of the property plus the commission. So again, we have a lot of hypotheses, but the risk that we are already seeing for our minority home buyers is real. So it's not one of these things that maybe it'll shake out in a few years. It's the fact that we are doing something right now without thinking about these consequences that are severely impacting the minority demographics. Mostly, correct me if I'm wrong.
With VA loans, they just did a temporary, so right in VA guidelines forever and ever, what it said was a realtor cannot be paid a commission outside of the seller paying it. That has been the rule forever. So the temporary injunction, and it's temporary injunction, it is literally a Band-Aid fix that they announced to now allow a VA homebuyer to pay the commission outright, just like in the circumstances I was. It is not allowed to be financed. Commissions cannot be financed in any type of mortgage loan that's in existence right now. So it's just the infrastructure doesn't exist this is happening very rapidly, and there are no solutions. There are just, people are kicking the can down the street. Yeah.
And I would be shocked if this were not permanent. Absolutely shocked. And it was amazing how quickly the industry went to the federal government and got a change.
So I'm just going to assume that it's going to be permanent. I think that's a fair assumption. They're definitely working towards that. But tell me, Mose, as an underwriter and loan officer, how is this a 2% fee going to impact the debt-to-income ratio?
Well, right now, because in home loan guidelines, everything is paid in cash at closing. That's what's stopping the ability from people to acquire the home ownership. With VA, they're not allowing it to be financed. They're saying a homeowner can pay it out of pocket just like they can on FHA and a conventional loan.
So it's adding to their closing costs.
It's adding to the closing costs.
But if you finance it like FHA, it's adding to your payment, right?
So FHA allows
You're financing it over 30 years.
Up to 6% seller concession to be paid, but it is not financed in either. It's not financed in on FHA either.
Where does it come in?
They literally are paying it cash to close.
At the table.
Everything is cash at the table. So the buyers that have experienced this, the decline or not being able to get ownership is because they couldn't afford it. And I'm going to be honest, like brutally. If I went to go buy a house in my market right now, because of the cost that's similar to my home, it would cause me to have to purchase a house around $1 million. If you said, Mose, you can go pay your agent $30,000 or you could buy furniture, honey, I might have to decide to go buy my furniture and not pay my agent. So for me to think that someone that can't afford $1 million home is not going to have to pick the same struggle, I would be fooling myself.
But can I make a comment?
Crazy.
Not only that, when I was able to buy my first home with my husband, we were only able to do it because we were VA, and it was 100%. I bought my first home with $500. That allowed me to create equity. I was in law school. I had enough student debt. There was no way, that I was making, I was struggling, right? We came from nothing. And I was able to buy my first home and start my journey into wealth building because I was able to buy my agent, who was the one that showed me, hey, you should do VA, your husband's military, hey, you should do this, and that, and ask for these concessions and do that. That allowed me to be able to become a homeowner, start creating my wealth, get a down payment from that house to be able to start upgrading and be able to do something. Number two, let's say it's not finance. So let's say now that we are going to be debating or negotiating with the seller to get more closing cost contributions so that we can have our representation, a buyer representation done. That's something else that the buyer is going to have to negotiate. Whereas before, they knew that they could be represented and they would be taken care of. So they only had to worry about negotiating the condition of the house or closing cost assistance. When we're putting more things on the table for these buyers who are already at a disadvantage, I mean, if we want to really talk about what's the real problem here in America, it's affordability, it's inventory. That's the thing that we really should be talking about, not whether the seller can pay a commission like they've been doing for the last 100 years. It's about how can we make more affordable housing for people to be able to afford a house and get out of renting, right?
But Sarah, isn't that, Sarah, the function of the buyer agent to represent? I mean, buyers don't really understand anything about this process. They rely on a buyer agent. And I didn't get to the real challenge that the buyer agents are going to be facing, but look, we're looking at a gap of $75–80 billion in annual commissions between UK and US at the same, if you had the same basic sales. Now, nobody thinks that we're going to end up like the UK. I'm not arguing for that. What I have suggested for a number of years is that the rates are going to come down from 5 to 6% to 3 to 4%. That represents every year a $20 to $30 billion savings. Now, can a marketplace function like this in the United States? Yes, actually, New York City. We did a major study on New York City. Throughout New York, except ironically, the most expensive areas, Manhattan and the higher income parts of Britain, the rates are already 3 to 4%. And there are complicated reasons for this, but some of the same reasons will obtain when the settlement actually goes into effect. Now, the challenge that the agents are going to face is this. We haven't talked at all about the other big part of the settlement, and that is, and this was really at the initiative of the industry, and that is mandatory buyer contracts. In the future, realtors will not be able to get paid unless they have the buyer's signature on a contract. Surprisingly, until recently, fewer than half of all buyers ever signed a contract, and the contracts often didn't disclose the terms of the compensation, and they were typically signed fairly late in the sale process. Now they're going to have to be signed before the first offer. And some of these contracts are extremely complicated, and a large percentage of buyer agents, or just agents, because most agents both sell and list, are not going to be able to deal with this. And they're going to have trouble persuading buyers to sign the contracts, which very clearly will say, look, if we can't get the funds from the seller, you're going to be obligated to pay the commission. That's the big, that's the big crisis, I think, that's going to occur. What it's going to lead to is this, I believe, and this ought to be of concern to all of us, and that is the buyers will say, I'm not going to sign this contract. I'm not going to take on the risk of, say, additional 2 to 3%. I'm going to go directly to the seller. And in New York City, that's what's happening in about 40 to 45% of the cases outside of Manhattan and Williamsburg, parts of higher income parts of Brooklyn. And so the question then is the buyer represented, okay? Now, I know the buyers are not going to pay the listing agent an additional 2%. They'll end up as customers, and if they don't have the assistance of an attorney or a nonprofit housing counselor, CFA is very big on nonprofit housing counselors, they will have trouble getting a good deal with the listing agent, even if they're not paying a high commission.
And the importance of housing counselors, especially for first-time home buyers, cannot be understated at all. I think it's critical. We have such a huge shortage, though, and there's such a big struggle on how to pay them already. I worry that they'll ever be able to make up the difference. And I'm also worried that, if we look at the UK as an example, they have a 50% home ownership rate. And that's we're at, what, 66, 67? And that's a big gap. And so who's going to be part of that gap?
Yeah, it's not really comparable, but
I don't
you
know that
I can
housing
agree with that.
counseling agencies are prepared. So first of all, nobody wants to really take on the legal liability that a buyer's agent takes on to advise. I don't want to do it.
Well, lawyers will.
Well, in
Lawyers
my
are
state,
traditional.
lawyers aren't required. We're a title state. You know, we don't have attorneys. That's why I said there's no national baseline for rules. Problematic when you're less than 60 days away from implementing something. That's the crazy part about that. It's the timing. There is no infrastructure set up. So in 60 days, is anything going to be there that someone would even be willing to open their mouth to advise a buyer to do something and not risk being sued as well? Everybody's lawsuit happy. Clearly, they're coming for the real estate industry. I'm not saying anything. I'm a mortgage person. I'm going to stay over here in my lane happily and stay out of this. I'm not going to be able to tell a buyer, oh, you got a home inspection, or go get a home inspection. Oh, your home inspection says there might be asbestos. You need an asbestos inspection. Here's a number for that person. I'm not doing that. That's what a buyer's agent is for. But what you don't realize is when they don't do it, they will call the mortgage company back when they pick that struggle to not pay their mortgage and go rectify the very things they didn't have guidance in repairing. And now it's a taxpayer issue that the GSEs, HUD, and VA will have to deal with, because the number of foreclosures or risk for foreclosure you will have because they're picking repairs over payment, it will impact everybody in this room at that point. So are we going to wait to find out? That's what we're doing now? Like, I just don't know who was in the room when all of this was proposed.
Exactly.
Clearly, I'm thinking maybe nobody Hispanic, nobody Black, maybe nobody that does mortgages or title that has these other perspectives that affect the industry. Because I'm just talking about the blowback on mortgage. When we went through our regulation and change to CFPB in 2010, it did not impact real estate to this degree. There was no impact to real estate, but now who holds it? We're holding mortgages. If I'm declining more diverse buyers, how are they going to look at me? We just looked at the report from the Urban Institute on segments of diverse buyers that are declined, Black buyers being declined at a higher rate. Is this another hurdle for that? That's going to get factored into those numbers, and what? It's going to take us 2 years to realize why? We're talking about it today. Let's go.
So was disparate impact ever considered as a part of the consideration on the suit?
Well, I wasn't party to the lawsuits. I mean,
So you're not party to the lawsuit, but CFA's been involved in this, and CFA recently led an effort to write to the Attorney General about this. So help me understand, how was disparate impact considered when the suit was, and the issue was evolved?
Well, there are two issues, and one is real, but it's going to get worked out, and it's going to get worked out more quickly than I think you imagine. And that is transition. Whenever there's a radical change, it's disruptive, and it creates uncertainty. And right now, lots of people are very uncertain. I will predict that by August 17th, when the settlement, basically goes into effect, or that's the last day, a lot of these issues are going to get worked out. I mean, we've been communicating with large realtors that are determined to persuade their sellers to continue to make contributions. And if they do that, you won't really see, I mean, you may see a difference because of the paperwork and all that, and on the mortgages, but the consumers are not going to see much of a difference. Then you're going to see, by the end of the year, you're going to see more progress. That mountain, and it is a mountain right now, at least in people's perception, may not be a molehill, but it will be shrinking. The big X factor here, the big question mark is, to what extent will DOJ get involved and oppose the settlement? And nobody really knows. But politics, of course, is going to be involved.
Yes, but I am concerned about DOJ, because while we've been talking about the fear of DOJ moving even further and essentially radicalizing and leveraging this disparate impact, in my view, on June 13th, CFA and other groups, including Americans for Financial Reform, wrote to Attorney General Garland and the head of the Antitrust Division, encouraging them to continue to press this issue. And it's hard for me to kind of understand why this is the case. But we have a lot of experts in the room.
What's being pressed is, I think the big issue of contention is going to be this, and that is, will the MLSs be allowed to list the mandatory offers in the concession field? That's what I think it's going to come down to. I don't know how that's going to work out. The election may affect this, but I hold to my prediction that by the end of the year, lots of these concerns are going to just evaporate. People are working very hard in the mortgage industry and the real estate industry, and as you can see, the VA had to work pretty hard in a very short period of time to make adjustments. Now, but what's at stake is not just tens of millions of dollars. We're predicting a decline by $20 to $30 billion a year. That's not pocket change, but here's the other thing about the system. There's no relationship between the payment of a commission and the quality of the service you agreed. Every agent gets the same thing, basically. If they're in a 2.5% area, they get 2.5%. They may be incompetent. The industry sponsored a huge study on the industry that involved interviewing 7,000 to 8,000 members of the industry, and one of the major findings was there are a large number of incompetent and some dishonest agents, and the honest agents, and there are hundreds of thousands of them, complain bloody murder all the time, not just on Quora and Reddit, but they complain to me about that. That is a huge issue. If that issue were addressed, I can tell you so many other problems would just evaporate. You would have a lot more business. I distinguish between the professionals. I've talked to hundreds of members of the industry over the decades, and 95% of those I consider to be professionals. But then there are the salespeople who just are in it to sell property and make a buck. And unfortunately, with almost 2 million agents, there are a large number of salespeople. What the industry needs to do is to move away from an emphasis on just salesmanship to professional service.
I think we see that in a lot of industries, and I can't really speak to these numbers. I've always hired an agent based on word of mouth, and that comes with a recommendation. But we have a lot of experts here. Let's open it up. Does anybody have a question? Want to get into this? I see, yes, right in the middle here, and then we'll come over here. And please introduce yourself.
Yes, my name is John Wong, a realtor for over 40 years and the founder of the Asian Real Estate Association of America. All the comments that were made all have some level of merit. But I think the focus, especially at this meeting, and I think the FHA, since the commissioner mentioned it, this is not the Black Home Buyer Collaborative. It's the Black Homeownership Collaborative. We've spoken about the fact that there were bad loan products where buyers were ill-advised and got into that was devastating to our country and communities, in particular communities of color. The challenge I see is we're talking about who earns what fees, what do they get for it, how's that going to affect price. The reality, and it was already mentioned by Sarah regarding having some guidance for a buyer who has representation when they're purchasing. There was a time when you had agents who had listings, and everybody who represented the buyer, whether they were in the same company or another company, were considered sub-agents of that listing agent. We have the peril of first-time, first-generation home buyers falling into that situation. And what you lose there is the fiduciary responsibility to guide them. Because if you are truly, and there are many agency laws that didn't exist before that now exist in states, if you are a sub-agent, I have to tell you, you ain't got no representation. You're on your own. And if you choose to go to an attorney, well, attorneys, I'll tell you what, I'll do it for $1.50. I don't think so. Because the reason an attorney will charge a significant amount is the same reason that agents who represent buyers and sellers earn the fees they charge. It's not because just the duties and professionalism. It's the fact that something goes wrong, there's an E&O policy to back up punishing that bad professional from doing something wrong. I do a lot of expert witness work, and as a realtor, I'm not advising all the clients to go out and immediately sue the person who represents them. But the reality is that is a fallback position. I agree that counseling agencies can give great advice. They currently work with agents on both sides of the transaction to help a buyer understand. But I don't know of a single counseling agency that can respond to breach of duty lawsuits that the real estate industry encounters. So I think that the big concern I see is that if I have a house, I'm not a first-time home buyer. I sell a home, I have some equity to pay the agent I want to represent me. If I'm a first-time home buyer, my family has, and we've seen examples that is not uncommon, that the parents or the uncles or the grandparents assist with that process of the purchase. If I'm first-time, first generation, I don't have those resources, number one. Number two, if I don't have representation, I'm really going in blind. It is very similar. Oh, you can buy a house. I'll tell you what, you work in a restaurant, let's say you make $1 million a year. We're going back to that kind of potential process, and I see that this as potentially being as devastating as redlining, because it's going to all of a sudden be a roadblock for entire communities. We've already seen the devastation for the African American community, the black community. It's going to be true for any first-time, first-generation home buyer. And the reality that we'll work this out, I can see it in San Francisco where I work. When you have a market like this where there's not enough supply, you don't even need 15 offers, you have 5 offers. 3 of the offers, the buyer says, I'll pay my representation, and 2 do not. Which offers are likely to be considered? Exactly. We see that right now. As a real estate agent, it's insane to write an offer with no loan contingency, no inspection contingencies. But you're seeing that, and you're seeing that sellers will select those. So I think the process will work out. I'm just afraid that whatever the process works out is going to be a tremendous roadblock to first-time, first-generation home buyers, of which communities of color are indexed very, very high. And regarding the VA process, I've followed it pretty closely. I've seen that VA says, oh yeah, Mr. Buyer, you can pay the commission now before you were prohibited. I didn't see anywhere where that could be packed onto the financing piece. It's and that's my concern. Because that, all of a sudden, how does that affect appraisals? All of a sudden, if you're a person of color and you have to have something in the pricing and stuff like that, how do you separate that from an appraisal? Is that, in fact, another potential form of appraisal bias? And I've spoken a little bit long, but thank you so much for the time.
Thank you, John. Other questions? Yes.
How you doing?
Questions or comments?
Robert K. Lenore Mortgage. I don't know in other parts of the country, but I'm from Florida. And commissions have never been, they've always been negotiable. I know that the MLS says, hey, look, 6%, 3% of the buyer, 3% of the seller. At the end of the day, that contract is null and void when you sign the sales contract. And in the sales contract, it stipulates X amount to the buyer, X amount to the seller agent. And that seller's agreeing to that. And it's not always 6%. Sometimes it might be 2 and 2, some might be 2.5 and 2.5. That's always been negotiable, so I don't understand this part about the whole, no, we should get 2%. First of all, you're trying to dictate what someone earns, which is not the American way.
Exactly.
But, and I understand that you want to protect the consumer. And the easiest way to protect the consumer is to have educated people guide them. I know that there's a few bad apples, but there's a few bad apples in everything. And I don't think everybody else should be paying the price for that. It's just my 2 cents.
So I think you make a good point. Sorry, one quick second. I think you make a great point, because what I see in the market is sometimes a buyer will talk to their buyer's agent and negotiate with the buyer's agent and say, okay, you're getting this amount of compensation. I want to, if I'm buying and selling, will you provide me part of that as a credit so that I don't have to ask the seller for a credit, so then I can get the house and be more competitive? So in essence, I've seen it be, definitely negotiable depending on what market you're in. And I see it as a way of allowing these buyers more opportunities to play around to be more competitive without having to ask the seller for one more thing.
There are 8 states do not permit rebates, and that's opposed, that's supported those anti-rebate statutes by those states. We also know that very few buyers ever get a rebate. Only a minority ever ask for a rebate, and most of them are denied according to the research, which is not definitive. But let me just respond to your first point about they're not being able to be negotiated. We did a report. I mean, we've been hearing this. I talk to National Association of Realtors all the time, and what we hear is that, look, they're negotiable. So I did a study. We called 200 listing agents across 20 cities, and we played the role of a potential seller. And we had conversations with those agents. They thought that we were, legitimately interested in selling a house. 3/4 of those agents said they would not negotiate the fee. And I'm sure that a good portion of the remaining quarter would have maybe knocked it down a 0.5 percentage point, especially if it was at 3 down to 2.5%, but not down to the 2% to 1.5% where it often should be.
Well, somebody not wanting to negotiate their fees doesn't make they're not negotiable, right?
I don't understand. Who determines it's supposed to be 1.5 or 2%? Who came up with that number?
Which number?
Everything's negotiable. In commercial real estate, they pay as high as 10% commission sometimes. And there's multiple agents involved. I know that residential is different because we have the consumer side of it. And in commercial, you should know what you're doing. But it doesn't, that's like price fixing, basically. I think if you're a seller and you call a realtor and he says, hey, listen, no, I'm not going to negotiate you have the right to go to somewhere else. Or say, you know what, okay, I'm gonna take your 6%, but if I get full price. But if, let's say, somebody makes an offer on the house, right now it's a buyer's market, so they're probably gonna get more than what they're asking anyways. So they don't mind paying the commission because they agreed to it in the first place. So I don't understand the part where, and on top of that, when you sign a contract, like we use standard Florida bar contract in the state of Florida, and that contract has stipulations as to what the commissions are. And the seller is agreeing to pay 3% on the buyer side, 3% on the seller side, or 2.5%, or whatever it's negotiated to. So that's just my 2 cents.
All the evidence that we have, I keep asking the industry, show us the numbers, but they never show us the numbers about what the commissions actually are. You're right, they're offered rates. The reason everybody's so concerned, and the industry has commissioned studies that show how uniform the offered rates are. This is not, we've done research on 35 cities using MLS data that also show the uniformity. Reddit has done, the fact is the rates are very uniform. Why are they uniform? Because there isn't price competition. And there are lots of reasons for that, okay? We think that the settlement is going to open the door to a little more price competition. We're not going to end up like the UK, 1% and 2%. We're going to end up, hopefully, 3 to 4%. You know what? The really good agents and brokers are not going to have to drop their commissions at all. We're going to see a greater variation of the commissions depending on the experience, the confidence, and how much effort the agent puts into that sale. What's very unfair right now in terms of the agents are the buyer agents who show dozens of houses potentially over a year. There's no sale. They're not compensated. That's unfair. There ought to be some compensation for that. The compensation system today, in so many ways, doesn't make a lot of sense. And I think we can evolve to a fairer system that's fair to the agents and the brokers, you know, as well as to consumers.
So that's great, and I could do this all day, and some of you actually do it all day. But let me ask Mose and Sarah and Steve to just have a quick last word. And Steve, since you're outnumbered, do you want to go first or last?
I just say, try to calm down. I know it's hard. Things are going to get better. You know, they're smart people who are very determined to work out these problems. We're not going to end up with a perfect system. You know, I told a very important industry leader the other day, we're never going to have a 100% price competitive marketplace. If we go from 10% to 50%, I'll be a happy camper and shut up about commissions. But it's going to get better.
Look, did you hear my exhale? Yeah, I hope it gets better sooner. I think the timelines are ridiculous. I don't think that the industry can figure it out in a couple of months. I would hope maybe by the end of the year, but I hope that they maybe include other parties that are affected by it. Because when a settlement is reached and then you go ask mortgage in the GSEs after you reach it to make concessions to change their rules, it doesn't work. That's putting the cart before the horse. So I hope it does work out for the sake of home buyers and the people that cannot pay for representation to be fairly and adequately represented, aren't penalized and lose out. It's very hard to get a black home buyer re-engaged after so many hurdles to even get to that point, to find out that they can't qualify because it's a miss of 1 to 3%.
I would say a few things. Number one, if whoever's making these decisions is truly doing it in a way where they want to represent all consumers and not just some consumers, then make sure that everybody is at the table, that everybody point of view, because where I came from, what my finances are, my background, my demographic is not being represented. That's number one. Number two, economists said that if the interest rates more than doubled, there would be a housing crisis. The interest rates more than doubled, and the rates, you know, are super high, and it's still really hard to get a house, and it's still competitive, and the prices haven't gone down. So I truly hope, is the industry perfect? No, but I would hope that we would take a pause and try to look at all these massive repercussions that our minority, our black and brown communities cannot withstand just because we're just going to hope and pray that it's fine. So my hope would be, let's pause, look at something that we know and not just hope is going to work out before we make these big changes, because our demographics don't have that much generational wealth to withstand a couple of years for us to say, we got it wrong, now we're going to go back. We're going to lose a lot of people on being able to actually, you know, thrive and survive in this market. So let's bring people of color into this decision, to bring part of our conversations into this, so that we don't make a decision that is going to really devastate our black and brown communities. That's all I ask.
And I would let that be the last word, except I'm me, and I'm also moderator. So I'll take the last word just to say,
6 months.
you know, I'm all for competition. But, you know, I was with my girls on Sunday night for Father's Day, and my Father's Day gift was a pair of tennis shoes called the Roger. And so they're Roger Federer tennis shoes. They're very comfortable. But if I played tennis with Roger Federer, and we both got to wear the same shoes, and had the same rackets, and used the same balls, I would not win a single point. Because he has the advantage of a lifetime of experience, and I don't. And that's the piece that I'm really worried about. And I'm worried about the same thing I was worried about when we were thinking about GSE reform in, you know, at Treasury Department 10 years ago, which is people keep pointing to all of these foreign countries and saying, but what about this and what about that? And, you know, and I keep looking at our home ownership rate of 65% and theirs of 50, and that's the difference for me, is what's the track record of human behavior? And we're going to have to figure this out, and I think that for all of us at this table, this is not a government policy. This is a court case that's been settled, that was decided, and that we have to live with now. And as long as the government doesn't make it worse, which the Biden administration Justice Department could easily do, which would be, for me, a bitter irony, we're going to have to figure out how to make this work. And I hope that everybody at this table and everybody who's been party to the suit is going to roll up their sleeves and let that happen. So with that, I want to thank all of our panelists and for this great conversation, which we don't have often enough. Thank you.
Okay, after that very interesting, exciting panel, we're going to give you guys a break, but it's really like 5 to 7 minutes. We have 2 very important panels left up for the day, and then we have a reception as well. 15 minutes? Okay, 15 minutes, but we got to start right after that, okay? So that's 3. The name of this panel is Advocating for Equitable Housing Policies to Protect Civil Rights. Bryan Greene, Barry Whitus, Ken Scott, and Lisa Rice will be our panelists.
Yeah, I want it. Okay. All right. We're going to jump. Is this mic on? Make sure you hold the mic close to you. Yeah, I got to hold it. This is. Wait, I think he's going to. Testing. Got the orange one here. Hello? Hello? Oh, there we go. All right. All right. So, we've had wonderful discussions today and wonderful remarks from a number of people. Here we're going to talk really about fairness and how we are ensuring as we go forward that housing policy at government and among the industry is ensuring fairness. I said earlier this morning, I shared some of the background of how NAR and other industry actors and government contributed to the legacy we see today of housing disparities, which has led to the 30 percentage point gap we see between African American homeowners and white homeowners. Here we're going to talk about some of the actions we have taken as the Black Homeownership Collaborative, but also other actions we've seen in the industry and among government to take interventionist steps to close these gaps. We'll talk about what some of these actions are that we've seen, but then we'll also talk about what some of the challenges are to some of these steps. And then finally, what we need to do going forward to safeguard the progress that we've made and to do more. And with us is a great team to talk about these issues. Every one of them have been advocates and warriors on these issues and have made sure that over time that we've been in the field, in the arena where things happen, and that we've made progress and that we don't lose ground. So let me introduce the panel just very quickly. On the far end, we have Lisa Rice, President and CEO of the National Fair Housing Alliance. Barry Whitus from the Office of Comptroller of Currency. And seated right next to me is Ken Scott, partner at Relman Colfax. And I want to start with Lisa. The National Fair Housing Alliance was also a founding member of the Black Homeownership Collaborative. And Lisa, perhaps we can just first start by talking about some of the major activities we have seen in the last few years that have helped make housing more equitable, but also perhaps you could say a few words as well about some of the challenges those activities face. And we'll get into a more robust discussion of those challenges, but I'm very interested in hearing your insights at the outset.
Well, thanks so much, and I want to start out by thanking the National Housing Conference for sponsoring this very important convening, the 3rd anniversary of the Black Homeownership Collaborative, and to all of the organizations that make up a part of the collaborative. We wouldn't be able to get this work done without every single organization that is a member of the collaborative. I just want to, let me start out, if I can, by sort of framing a couple of things. Bryan, we know that the Black homeownership rate reached a recent historical low in 2019. That's when the Black homeownership rate fell to 40.6%. At that time, the Black-white homeownership rate was at more than a 30 percentage point difference. And that's a difference that we had not seen, quite frankly, since 1890. That's how much we had regressed in terms of the Black-white homeownership gap. But since 2019 to 2023, we've seen a dramatic increase in the Black homeownership rate. So remember that the Black homeownership rate actually started falling in 2004. The foreclosure crisis hit the Black community first in 2004, the Latino community in 2005, and then hit at the macro level in 2008. So Black and Latino consumers, homeowners, really were the canaries in the coal mine. So since 2004, the Black homeownership rate had been on a downward trajectory, and we turned that around, and since 2019, we've seen about a 13% increase in the Black homeownership rate and a 7.5%, almost an 8% increase in the Latino homeownership rate. And that's a very dramatic turnaround. It's an important turnaround, but it's not a turnaround that happened by happenstance. It happened because of deliberate actions that we all put in place. I'll lift up just a couple of them. One that springs to mind is bringing a little bit more clarity around the False Claims Act litigation. Many lenders were very concerned about their exposure and liability with respect to false claims acts when they were making FHA mortgages. And as we know, FHA plays an outsized role in providing mortgage access for Black and Latino homeowners. The second thing I want to lift up is the revamping of the qualified mortgage rule. That rule went into place as a result of the Dodd-Frank Act. The CFPB, when it first issued its regulations, there were many of us that were concerned that that rule had turned the dial a little bit too tight and had cut off access to credit. Everybody remembers Appendix Q. Very, very prescriptive piece of regulation, and it was very difficult for many consumers to implement. And so we were able to readjust and I think right-size the QM rule, and that has helped to widen the aperture of credit access for many consumers. The GSEs have ramped up their efforts to allow for rental housing payment information to be used in a more streamlined fashion in the underwriting process. HUD's Special Purpose Credit Program guidelines have really, when HUD released that guideline, it was the catalyst for many organizations to develop and implement special purpose credit programs. And we have seen since the implementation of that rule, literally tens of thousands of consumers getting mortgage credit through special purpose credit programs. There are a couple of more things I want to lift up, Bryan.
Go ahead.
We put together just a bevy of protections when the COVID pandemic hit. There were too many to name, but I do want to name a couple, just a few. The Emergency Rental Assistance Program, the Homeowners Assistance Program. For the first time in U.S. history, we had direct benefits going to homeowners so that they would not lose their homes during that economic crisis that hit. When the pandemic hit, there were many people who were projecting that we were going to see a second major foreclosure crisis. People were calling it the COVID foreclosure crisis, the impending COVID foreclosure crisis. That didn't happen because of all of the protections that we put in place during the COVID pandemic. And then the last thing that I'll lift up is the forbearance programs that were put in place during the COVID pandemic that saved people from going into foreclosure. So, Bryan, there were many ways, myriad ways in which we created this huge homeownership and racial wealth gap in the United States. And it's going to take many, many different initiatives and efforts to get us out of this space, but it feels like we're headed in the right direction.
Excellent. Well, I love that tone of optimism. One of the items you mentioned, special purpose credit programs, really was unleashed by that memorandum you mentioned from the Department of Housing and Urban Development, saying that special purpose credit programs were consistent with the purpose of the Fair Housing Act, informing lenders that this program, which was permissible under ECOA, they could move forward with and not fear violations under the Fair Housing Act. I want to ask Barry if he could elaborate more on how the government has followed through on that and the work that he's been doing with Project REACH on special purpose credit programs and beyond.
Sure, I'd be happy to. So the Office of the Control of the Currency, where I work, OCC, is the supervisor of national banks and federal savings associations. And we supervise most of the largest institutions. And we began our journey towards helping financial institutions that we supervise address racial equity. You know, after the murder of George Floyd in 2020, we had a lot of financial institutions back in 2020 that were really coming to terms with some of the historic inequities in the financial services system. And a number of those large institutions that we supervise made racial equity commitments on a number of different fronts, including on the mortgage front. And so in 2020, the OCC formed our Roundtable for Economic Access and Change, or REACH, where we involved civil rights organizations, the banks that we supervised, other key stakeholders, including the National Association of Realtors, the National Fair Housing Alliance, and many others, to work together on a number of different fronts that address racial equity. One has to do with providing financial access for credit invisibles, another to strengthen minority depository institutions, minority-owned banks, a third looking at strengthening minority small business, and then the one that I'm the OCC staff lead for is looking at reducing the minority homeownership gap. So we are now 4 years into our Project REACH initiative. We had a summit a couple weeks ago in Washington, D.C. Several hundred people came to hear about the work that we've been doing on those fronts and to kind of envision where we're heading in the future. But to answer your question, Bryan, the work that we're doing around minority homeownership has indeed focused on expanding the use of special purpose credit programs for mortgage finance. When we started this work back in 2020, there weren't any large banks and very few financial institutions at all that were offering special purpose credit programs for mortgage finance. And Lisa mentioned, you know, one of the reasons why is that we had a lot of banks come to us as we began our discussions about ways that we can improve racial equity in the mortgage space, and a number of banks said we would offer special purpose credit programs for mortgage. We know it's specifically authorized in the Equal Credit Opportunity Act, but there was always a lingering concern, perhaps just amongst the lawyers, but that mattered. And they said we really need clarity that is also permissible under the Fair Housing Act. And so that is what a number of the regulators worked with HUD, Department of Justice, you know, taking these concerns from the financial institutions. And the result was a number of things. A legal memorandum that specifically stated that special purpose credit programs are permissible under the Fair Housing Act. There was a very detailed guidance that the Consumer Financial Protection Bureau put out regarding what detailed information a financial institution would need to collect and to analyze to justify why a special purpose credit program is needed and what goals they were seeking to achieve through a special purpose credit program. And then, of course, regulatory encouragement, you know, through statements, speeches by Acting Controller Sue, the head of our agency, the Controller of the Currency. and through our work in Project Reach. And so we formed a work group within Project Reach, specifically focused on sharing of best practices amongst financial institutions that one by one were beginning to test the waters with special purpose credit mortgage programs in certain cities on certain terms. Some were focused on people currently living in majority-minority census tracts that are moving to any other census tract. They were programs different from the bank's CRA programs, which were income limited or income targeted. These special purpose credit programs were more geared to helping people, in particular racially, in certain census tracts that had high concentration of minorities. And so now, we are 4 years in. We have 12 major banks, plus both GSEs that are part of Project Reach, now offering special purpose mortgage credit programs. And the group meets on a monthly basis to share best practices, to hear about new approaches, such as those that are talked about for first-generation home buyers, which has been brought to the group. The civil rights groups are challenging the financial institutions about ways that they can expand the programs, learning from which programs are most effective. And so it's really been a wonderful collaboration. And that's just an example of how we at the federal level, working in partnership with civil rights groups, banks, and other stakeholders, can really tackle this minority homeownership gap problem.
Thanks, Barry. I think in this area of special purpose credit programs, there's just been a lot of dialogue about, how they can be tailored to be most effective. I was testifying at a hearing that the OCC, as well as the CFPB, the FHFA, and HUD had, you can look up those acronyms later, where they were saying, we are telling lenders to move forward, to move boldly on special purpose credit programs. Why aren't they doing more? And this hearing, I was saying, yes, I think not only should they do more, but they should be bolder, and that they can be bolder based on what we understand the law to be. Nevertheless, there are many who aren't directly creating programs that deal with race. They're finding indirect ways to perhaps help African Americans and others who've been excluded, and potentially maybe diluting the effectiveness of the programs. And many, even if the executive branch is saying they support these, are still afraid of private litigation. They say, fine if Rohit Chopra says it, but some private litigant or activist is going to sue us saying it's race discrimination. So we want to hear from Ken Scott, who's at Relman Colfax, the leading civil rights litigation firm, just to tell us just how real is this litigation risk, and how much confidence can we have that lenders can create these programs and keep them going?
Thanks, Bryan. Thanks to my panelists, and thanks to everyone for being here today. Litigation, no one can say, where that's going to go. We know that there's a lot of challenges going on across the board, across all DEI-type programs. I think all we can do from a litigation risk perspective is really prepare for litigation when it comes. What do we know today, though? We know that there is no special purpose credit program that's been put out by a private institution that has been challenged. And that's an important fact, right? I think if you look, there's been challenges to all types of DEI programs that are out there under Section 1981. There have been, stuff under the Equal Protection Clause, for this under state action, but nothing around kind of the ECOA and Reg B. So I think the plaintiffs bar and the folks that are really looking at this understand that just that suit is going to be a tougher suit than some of the other things that they've been doing. And why is that? If they bring something under the Equal Protection Clause, it's going to fail because there's no state action here. This is all done private plans don't involve state action. So we're safe from an equal protection clause perspective, right? When you look at kind of the Fair Housing Act, Section 1981, all of those predated the Equal Credit Opportunity Act and Reg B. So it's clear that Congress understood that what those laws required, and they carved out this special little area that said, in lending, you can, for want of a better word, you can discriminate when you're affirmatively reaching out to groups that have been disadvantaged. So, you know, it's pretty clear that Congress understood that, and it's a tough argument to make that it did not. And then, you know, lastly, when you look at kind of the ECOA, it is, you know, somebody could argue that it's state action, but it's really neutral on its face, right? It just says a private person can do this. It doesn't require anybody to do it. It doesn't say that the banks must do it. It's only when the banks decide to do it. And in that case, I think from a litigation risk perspective, anybody can bring a suit, but I think in this space, it is much safer than some of the other things we're seeing across the challenges on DEI. What I'm more concerned about is the chilling effect, though, of those other things on special purpose credit programs. You know, because for even those folks that have leaned in, and I think Barry, you went through that and said a number of folks have leaned in and put out special, they are all thinking about whether they should continue those programs, because as you think, you know, one of the questions around those programs is, why aren't the banks doing more of them? Well, if you look at it, most of the programs are structured in a way where they provide down payment assistance or closing cost assistance. So the banks have set a cost, they have to carve out a certain amount of money out of their balance sheet to be able to do this. And they're only willing to do it, but so much, right? And you have to create that imperative for them to actually do it. And why do they do it? Many of them are afraid of redlining cases. And as more and more banks do special purpose credit programs, they have expanded their credit box. And because they're doing more loans in some of these communities, when you do your traditional peer analysis, they're seeing they have exposure to DOJ and others from a redlining perspective because they're outside, their credit box is tighter. So that creates the imperative to do the special purpose credit programs. If we start seeing the reverse and banks start pulling back from special purpose credit programs, then those people that are doing it to meet, which is a significant number of them, to make sure they're not an outlier from a market penetration standpoint. I guess in this room I can say redlining. It depends on who I'm talking to. I used to say the redlining piece of it. You know, people will pull back on it again. So there's a lot of things going on today, and it'll be interesting to see where folks go and whether they continue to actually use this important thing.
Yeah, if I can add one more thing to what Ken just said. The HUD regulation, as you noted, played a major role in being catalytic for the development of special purpose credit programs, but that was by design. We too had the same conversations that Barry had with lenders and asked them, why aren't you guys doing these programs? It's a wonderful way to overcome some of the systemic barriers that we see in the marketplace, including the systemic barrier of the dual credit market that exists in our nation. And we got the same information and feedback that Barry did. Banks said, our regulators, our prudential regulators have told us you may be in compliance with ECOA, the Equal Credit Opportunity Act, but you may not be in compliance with the Federal Fair Housing Act. So the National Fair Housing Alliance commissioned Relman Colfax, one of the leading civil rights law firms in the nation, and we worked together collaboratively to develop a legal sort of treatise on special purpose credit programs, which we sent over to HUD. And we did a lot of advocacy with HUD. We were joined by the Mortgage Bankers Association. We sort of plied HUD with letters asking them to issue this guidance and to review this legal document that we had prepared that laid out all of the arguments that Ken just talked about and many, many more to explain why special purpose credit programs actually further the purpose of the Fair Housing Act, particularly when one considers the affirmatively furthering fair housing provision of the law. And HUD read that legal treatise and said, you're absolutely right. And very quickly, it was in record time that HUD issued its SPCP guidance. Now, of course, we had a secretary in place, and Marcia Fudge, who was gung-ho about doing this, but I just want to sort of double down on the point that it takes a village to do this work.
And speaking more of that village, the Mortgage Bankers Association have been strong advocates for special purpose credit programs, as has the National Association of Realtors. So all of us amplifying this message that this is important and necessary to begin closing the racial homeownership gap. I want to ask the panelists, just to stick on this for a moment, what more can be done? I mean, I thought everything Ken shared in terms of why he thinks it's a good risk for lenders to take. I think that's helpful for all the lenders in the room and watching. But what else can we do to promote their use and perhaps safeguard them going into the future? You want to, Lisa, you want to take that first, or do you? Oh, go ahead, Ken.
Well, I think that's a key point you said, safeguard them for the future. And that ties back to the litigation risk piece of this. And Reg B is pretty clear as to what you need to do and have in place when you have a special purpose credit program. And I think, if the OCC or the CFPB or somebody comes in and you say, well, I have a special purpose credit program, that's why I'm targeting this group, and they say, where's your written plan? And you scramble to create a written plan after the fact, that's not a good place for you to be from a regulatory perspective. It's not going to be a good place for you to be from a litigation perspective as well. You need to go through the steps that's laid out in Reg B. You need to have a written plan. That written plan needs to be very clear as to the groups that you're targeting, the nexus between the need that you've identified and why that group needs it. It needs to lay out what you're offering. It needs to lay out the background for the historical piece of why that group may have issues. And it needs to be laid out very clearly, and it needs to have some endpoint, and needs to be reviewed, and you need to also be monitoring it and making sure that it's operating in a way that it was designed. And if we all do that across the board, what that makes it easy for is that there's not going to be that one person out there that doesn't do it, that the plaintiff's bar or somebody focuses on, because they're very good at identifying the least common denominator. And as we know, bad facts make bad law. And so as a firm, we work very closely with our clients to make sure that we're crossing all our T's, dotting our I's as we're laying out kind of those written plans. So that would be one thought.
Barry, what else are?
Well, Lisa wants to make a point, and then I'll go.
Oh, okay.
Well, I may be stealing your thunder, Lisa, but I'll do it anyway. We have a really great set of tools that the National Fair Housing Alliance, the Urban League put together, the Mortgage Bankers Association, Special Purpose Credit Program, resource tools that provide banks in 50 of the largest cities in this country a way of analyzing how well they're doing relative to other institutions and where the need is for particular racial and ethnic groups. So I want to give a real shout out to Lisa, particularly, and her team in coming to Project REACH, speaking with our lender members that are part of REACH and saying, would this tool be useful to you? And then doing training and making the tool available for free to those institutions to do exactly what you just said, Ken, which is, make the analytical case for why they're needed, to monitor the programs as they're being implemented, and to your point, protecting yourself against litigation. And I think those are all important points. And then the other thing that I would add is that we should look at where these programs are being offered now. Is there an opportunity to expand the number of markets? and make sure that the client knows where the programs are being offered, what the terms are, and how to access them. And so one of our Project Reach member organizations, the Homeownership Council of America, is launching a special purpose credit program web resource that will provide a national database of all the programs that are out there, where they're being offered, what the terms are in those particular markets, and we'll really be working very hard with housing counseling organizations across the country that are members of REACH and otherwise to help make those counseling groups aware where the programs are offered, what the terms are, because unfortunately, there's a lot of different banks that are offering them in different markets, and each market may change from year to year, and the terms may vary from month to month. And so having some tools like that available to lenders, I think, is really going to be key for the continuation of these programs.
Thanks, Barry. And the only thing that I'll do is share with people the website address is spcptoolkit.com, and I'll just give a quick shout out to Shanti Abadan and Lori Benner, who are sitting in the back. Shanti heads up our Housing and Community Development Division, and they oversee the maintenance and management of the Special Purpose Credit Toolkit, and we have many resources on that toolkit that have been thoroughly researched by our Office of General Counsel and our legal partners to make sure that those who are using the toolkit can formulate special purpose credit programs that comport with the law.
You know, can I just add something? Please. I think one thing that special purpose credit programs take many different but the special purpose credit programs that relax underwriting guidelines, DTIs for groups, and that perform really well, you know, they present a significant opportunity because they're almost like a pilot, right? You're piloting it on a group that's arguably a vulnerable group, and if that performs well, and at the end of the year it's doing a fantastic job, there's nothing that says that's not taking any money out of your pocket. Like, you could open that up to and not just the groups you're targeting, to everybody, all the underserved groups that you may not have had a need for. Right? And if every lender does that, then we're expanding the credit box in a really meaningful way. And I think a lot of, it's one of the conversations I have with folks as I'm talking about special purpose credit programs. It becomes very difficult when it's, of course, a down payment assistance because you don't have unlimited money. But particularly on the terms and conditions, it presents a significant opportunity there, in my opinion.
Okay. Great. I mean, we've spent a fair amount of time on special purpose credit programs because it is one of the great examples of how we've made advances through our 3x30 initiative. I want to ask the panelists, what else do you think is making the most transformative change of the advances that we've made in the last few years? Maybe credit modernization? What would you like to highlight? Lisa?
Well, we talked about a couple of them at the outset. I will pick up on the thread that Barry laid down, and that's the first generation home buyer programs. NAFA, the Center for Responsible Lending, and the Urban Institute collaborated to develop the sort of framework for first-gen home buyers. The Urban Institute did the research for us, and basically there are about 5 million capable people, sort of eligible folks who fall into that category of first gen. 70% of them are people of color. So first gen is a race-neutral way to achieve some of these goals that we have been setting forth. And it's one of the reasons why we are encouraging lenders who are a little bit skittish about directly using race to design their special purpose credit programs, to design a first generation home buyer special purpose credit program, because that helps you kind of get to the end that we all are trying to achieve here. Those special purpose credit programs, the reason to do them, as Ken has mentioned, is you get to change your guidelines in order to expand access to credit. So you could do things like doubling down on using rental housing payment information to qualify people. One of the challenges we face is that many consumers of color live in what we call credit deserts. They haven't had access to traditional financial services, and what that means is, since they are disproportionately accessing credit outside of the financial mainstream, they're disproportionately accessing credit from creditors who are not reporting their positive information to the credit repositories. So they may have lower credit scores, and that keeps them outside of being able to qualify, or they may have no credit score at all. So using rental housing payment information is a way to help on-ramp those consumers into the financial mainstream.
You know, the other piece of this is that with every good, there's potential bad outcomes that can occur, right? So we all have agreed here that special purpose credit programs, you know, serve an important piece of it. But as you're designing them, you know, we don't want to create a situation where we're gentrifying neighborhoods, right? We don't want to create a situation where we're forcing people to stay in neighborhoods to be able to access these programs. So there's a lot of conversation around race-based versus, you know, place-based programs. And, you know, to me, a hybrid is the better approach. Many of the programs we see out there tend to be place-based. That happens for a number of reasons. They tend to be easier to operationalize. I think NAFA and others would encourage more race-based, race of the borrower programs that allow people to move to neighborhoods of opportunity. And you know, so we've seen, I think Fannie Mae came out with an interesting program that they've been piloting where you can access, if you live in a certain place, you can access their SBCP and move to anywhere in the country, right? So you haven't locked them in. So just being thoughtful in the design, also thinking about whether you're going to go for first-time home buyers or kind of first-generation home buyers. There are just a lot of things to think through as you're designing these to make sure that you're really addressing the needs of the community and not having any unintended consequences.
Thanks for lifting that up. Barry?
I would just reemphasize the opportunity for using positive rental payment history. Both Fannie Mae and Freddie Mac have built into their underwriting models the ability to consider that information as a positive factor. I think, you know, one of the problems is that not every person is able to have their rental payment history information reported by their landlord. We have newer approaches now that are able to extract the information from your checking account data and be able to have the loan underwriter analyze that. So, you know, people who are looking to buy a home definitely need to be mindful that all this information is available, and it can be positive, to your point, Ken, but if you're not paying your rent on time, you know, it's not going to be a positive. It's going. Now they say that it's not a negative; it can only be a positive. But you know, that's another thing to be thinking about is how do we get people to make sure that they're aware that all this information can be used, you know, potentially in a good way to help them to become a home buyer. And we're not too far from that point where we're going to be taking some of the information that we learned from some of these models that are looking at cash flow, just looking at the cash flow in your transaction accounts and being able to underwrite you based on, you know, how infrequently you overdraft, or whether or not you are, you know, having certain payments that are due on a particular date being paid on the requisite date. And so that data over the long term is just one step away from using your positive rental payment history to underwrite you and help you, but also potentially could harm you, as you look to buy a home. So, working early with the housing counseling organization, helping them help the buyer understand the implications of all this and manage their finances in a way that positions them best to become a home buyer, just really is underscore the importance of the housing counselor in this whole equation as well.
So this month, which is Homeownership Month, we'll also be hearing that it's the 80th anniversary of the passage of the GI Bill, and people will be celebrating the GI Bill and how it helped millions upon millions of veterans and their families enter the middle class. We all, and at NAR, we point out that African Americans were not able to use those benefits. So the millions of veterans who came back from World War II did not have that opportunity. And as we all know, that created many of the disparities that we're living with today. So in closing, I want to ask the panelists just to speak to what else do we need to do to help more of the American public understand the need for bold action, help people understand the legacy we're trying to overcome with housing policy. And why don't we start down on your end, Lisa, and come this way.
I think one of the things that I would sort of beseech the audience to do is to compel the industry to stick with us. Ken made reference earlier to the fact that we've seen a lot of entities, particularly on the industry side, pull back. Barry talked about the commitments that many organizations made in the sort of the midst of the movements and the aftermath of George Floyd's murder. Many organizations made commitments, and we're seeing those commitments sort of be fallow. They have not been fulfilled, and I think we need to double down and stay true to those commitments. And so I would urge you to reach out to your industry partners and ask them to fulfill those commitments they made, not shy away. If they need help in how to legally fulfill those commitments, they need to reach out to the civil rights experts in order to do that, because it can be done, and there's no reason to back down from it. It's no reason to shy away from it. The Citigroup did, they sponsored research, and actually I think their economists performed this research that showed if we eliminated racial inequality against Black people alone, we would increase the US GDP by $5 trillion over a 5-year period. That's huge economic gain and benefit for everyone. We often hear from a fair housing perspective about the concern that people's zip codes are very determinant in terms of their outcomes in life. And that is true. That is true today. And I think it should be a goal of ours to ensure that every single neighborhood is healthy and resilient and replete with the resources that people need to live thriving lives. That's how we all benefit, not only individually, but as a society. And we're only going to achieve that goal of affirmatively furthering fair housing if we're all in it together. So I would encourage us to kind of double down on our commitments.
I'll just briefly add, and it's more of a state and local initiative than a federal, but the relaxation of some of the land use restrictions that we have in place, particularly as it relates to single-family zoning. I was pleased to see, where I live in Montgomery County, the planning board just proposed legislation to the council, county council, to greatly increase the types of housing that can be built, in areas that have historically been zoned as single family. A number of jurisdictions, including Montgomery County, have already instituted policies to allow for accessory dwelling units. And more jurisdictions, particularly Los Angeles and California, have probably been leaders. So we can look to some of the states that have used, relaxation of land use to expand the supply of housing, and hopefully more affordably priced housing will come as a result of some of that relaxation.
Okay. As I think about it, we really want to think about where we are in the cycle, right? And how do we prioritize? What do we need to look at? How do we preserve the gains we have? And I thought about it. It comes to kind of 6 things, right? And we talked about some of them. Prioritize redlining, reverse redlining, and appraisal discrimination. That's number 1. Number 3, kind of educate the public on race and place and outcome and what that means and where it is. And that goes back to Lisa hit that, do we keep financing our schools and stuff using property taxes, local property tax, that creates inequality just by the bare makeup that we have, it's based on the equity in people's houses and how much the houses are worth, and it just creates a whole disparate impact just by the design. 1, maybe we provide more Section 8 vouchers to support people moving to opportunity. Continue to push back on DEI and diversity, making sure we really building an understanding of what the equal protection laws are about and what, not use them in the perverse ways we're seeing them being used today. And stay out of the Supreme Court as much as we can. And making sure we're using the court system as effectively as we can. So potentially start thinking about state courts, state constitutions, and what they can do to help us. And lastly, protect the CFPB. And with that, that's it.
Well, I'll add just a couple of thoughts to what you all have said. The supply issue that Barry raised, I think that is really key. It doesn't solve our problems, but we need sufficient housing supply so as not to exacerbate existing problems, so that we don't have a society of haves and have-nots, and where those who are relatively advantaged can access housing, and those who are disadvantaged see their lack of access compounded. And I would also add that I mentioned a book earlier in my opening remarks called 15 Cents on the Dollar by Louise Story and Ebony Reed. I think we all need to carry the message forward that they make in this book, which is that wealth gap between African Americans and whites, where African Americans have 15 cents on the dollar that whites have, and others have said it's even greater. They say that's not going to close itself, is not going to close by itself. That if we do everything and society is fair, it still would take about 100 years to close that gap. So it's important that we recognize that, and important that we recognize that initiatives like 3x30 are necessary, because we have to lead in order to make change. So I want to thank Lisa, Barry, and Ken for all of these great insights. This has been a wonderful panel, and thank you all for your attention.
Thanks. Let's give the panel another round of applause. Yes, thank you all. Scheduled for you all, so please listen to the panel, and then please join us at the reception. So our panel title, panel title is Rooted in Wealth, Safeguarding Black Homeownership and Land Legacy. Natasha Moody from the Housing Assistance Council will be our moderator. Our panelists will include Ink Burlow, Equal Justice Fellow from National Consumer Law Center, Andrew Carl, the author of The Black Tax, and Kevin Cameron from the American Land Title Association.
Well, good afternoon, everyone. Hello. Thanks for hanging out with us for this last session. As we're getting settled, I just want to say thank you for staying for this last session here as we wrap up. So we'll have our last panelist join us in a moment. Thank you. Thank you so much. There we go. Okay. Well, again, thank you, everyone. This is the session, Rooted in Wealth, Safeguarding Black Homeownership and Land Legacy. And, you know, I'm just really grateful for the opportunity to have this panel. Thank you for having this, because as we consider the mission of the 3x30 and, you know, 3 million net new homeowners, it's important to consider sustaining the home ownership and also considering some folks who will be new homeowners but through a different method of acquiring property. And so we will begin this discussion starting with talking about the historical context and some of the current implications of some systemic issues, and then going to talking about solutions to address some of those issues. So my name is Natasha Moody. I'm a research associate at the Housing Assistance Council, which is a national nonprofit intermediary that supports affordable housing and community development in rural America. And I would like to introduce my fellow panelists here. We have Dr. Andrew Carl, who's a professor at the University of Virginia, researching and teaching courses on African American history. Andrew is a very successful author, most recently publishing The Black Tax, 150 Years of Theft, Exploitation, and Dispossession in America. We also have Nketia Enkberko, who is an Equal Justice Works Fellow at the National Consumer Law Center. Inc. focuses on legal assistance and policy reform to enable Black families to stay in their homes and transfer homeownership to the next generation. Inc. also works with legal services programs in the DC area to provide legal advocacy and representation for Black residents with tangled titles. We're also joined by Kevin Cameron, Director of Federal Government Affairs at the American Land Title Association. Kevin has worked in political, fundraising, and advocacy roles, working on campaigns with senior members of Congress, and now Kevin works as a government affairs professional with a well-rounded perspective to strategy development and execution. So thanks to the panelists for being here. So to start us off, Andrew, would you be willing to share more about your research and your findings around the historical context and implications of taxes, tax sale laws, and more about your work, please?
Sure. So thank you for having me here this afternoon. It's a real pleasure and honor to be able to speak with this audience and be able to sort of present some of my work that looks at the history of racial discrimination and inequity in local tax systems and its role in fueling many of the problems that have been discussed all day today. And I wanted to begin by referencing a recent example headline from the news that perhaps many of you are familiar with. That was from earlier this year when the Johns Hopkins history professor Nathan Connolly and his family settled a lawsuit against the mortgage lender Loan Depot over an appraisal company's undervaluation of their home. In 2022, the African-American family sought to refinance the mortgage on their Baltimore home, but when the appraisal they received was suspiciously low, they sought a second appraisal, except this time they whitewashed their home, removing all evidence that a Black family lived there and had a white colleague pose as the homeowner during the appraisal. The second appraisal they received was $300,000 higher than the initial estimation. Now, this family's experience is the latest example of a more familiar problem, the racist devaluation of Black-owned properties in African-American neighborhoods by various segments of the real estate industry. And this racialization of housing markets really beginning in the early 20th century, this drawing of the color line, which was foundational to the industry's formation and growth in the 20th century, made property, white property, worth more because it was white, and made its value and continued appreciation contingent on the exclusion of the poor and people of color from these markets. And conversely, it made black property worth less because it was black, limiting its future appreciation, and with it the ability of homeownership to be the kind of vehicle for wealth building that it has been for generations of middle-class white households. All the while exposing African-American home seekers and minority neighborhoods to all manner of exploitation from this exclusion. But there's this other feature of housing markets that's been just as pervasive as the devaluation of black homes and minority neighborhoods on the market. And that's the overvaluation of lower value properties in black-owned neighborhoods and the undervaluation of those higher valued ones for tax purposes. Today, nationwide, African-American homeowners in black neighborhoods are overassessed for taxes by on average, 10 to 12%. In some markets, it's much, much higher. And this is in addition to the overall regressivity of property taxes, which is well established as a feature of how property taxes are administered, namely that lower valued properties are assessed higher relative to value than higher valued properties. Now, because African-American properties are worth less because of race, that means that they're taxed even more further still. So when combined, this really means that black homes and neighborhoods are assessed upwards of 45% above what they should be paying in taxes, which drives down the value of black-owned homes, further raising the cost of housing for black Americans and making the homes that black people own more expensive to hold and easier to lose. Now, these present-day realities form the backdrop to my book, The Black Tax, which is a 150-year history of racial discrimination and inequity in local tax systems and its cost for generations of black Americans and its role in shaping housing markets as a whole. And the book explains how this structure of local taxation in America became, in a sense, structurally racist, and how it has consistently undermined black homeownership and wealth building in America. Now, this overassessment and overtaxation of the homes and land that African Americans have owned in the places where they live, as I estimate, and the most conservative estimate, is that it has robbed black Americans of at least $300 billion since Reconstruction. Now, my book also sort of follows the money from black taxpayers' hands into local treasuries and then into the public budgets and spending decisions of local governments, showing how African Americans have also been consistently underserved when it comes to the public goods and services that local taxes go to support. And that's none greater than public education, which again has forced African Americans now to pay more while receiving less. And of course, as we all know, the quality of those public goods and services, like public schools, goes far in shaping the value of those homes as well. Now also, the third sort of leg of this three-legged stool that my book sort of focuses on is tax enforcement. And so when it comes, when people fail to pay their taxes on time, they are subject to tax liens, and in many states, including the District of Columbia, the local government will sell those tax liens to private investors at what are known as tax lien sales, which have created this lucrative marketplace for essentially preying on financially distressed homeowners, and in many states and localities, allowing them to take their property, all for the price of a single unpaid tax bill. African Americans here also have been disproportionately victimized by these local tax delinquency laws. This predatory practice, as I sort of argue in the book and show, by way of cities like Washington, D.C., has been an instrument of gentrification and black displacement, and been a causal force of African American land and home loss over the course of the 20th century, which has been documented to be upwards of 11 million acres that African Americans have been dispossessed of in the 20th century alone. So my work kind of calls attention to these features of local tax administration and enforcement that have really been kind of flying under the radar in many of these discussions about the driving forces of inequality in housing markets. And again, that question of why has housing and home ownership not worked in the same way for black Americans as it has for other groups of Americans. also answering this, addressing this question of, what have been the forces that have been fueling the racial wealth gap over the course of the 20th century and still today. And along with it, again, why has segregation and inequality remained these defining features of America's public educational system? And how are all these problems tied to housing markets and the source of local public funding, which are real estate markets? So again, this is a sort of history, again, that I think is one that is very much unresolved. My book really is sort of focusing on problems that have been long-standing. They've taken different forms and had different effects, but they are ones that are not by no means are in the past. Tax lien sales continue to remain a sort of real crisis in many low-income neighborhoods. Black-owned homes continue to be overassessed, and we continue to see great disparities in public funding for the local goods and services that these tax dollars pay for. So that's kind of sort of where my book sort of seeks to intervene in these discussions, and again, I sort of hopefully provide a little bit of historical backdrop here to the problems we're going to address this afternoon. So thanks.
Thank you, Andrew. Thank you for that background and history from your research. A lot of what we will continue to discuss in this panel today really relates to that, because when it comes to those predatory tax sales and folks are disproportionately affected by those, by losing their homes to tax sales, actually intersects a lot with heirs property, which is what we'll discuss as well today. And they're both impacts of systemic design that are disproportionately affecting Black communities. And so I'll transition into speaking a bit about the research that the Housing Assistance Council conducted in collaboration with Fannie Mae around heirs property. There we go. So I know we've heard heirs property mentioned a lot today, but to start, I want to share the definitions that the Housing Assistance Council used in their research, and also not to assume everyone's exposure to this topic. So heirs property are traditionally created when a property owner dies without a will or some other form of estate planning. Then that property is transferred to their descendants in a shared interest where no one person has clear claim to that property. And that creates a multitude of issues that I'll go into in a moment. But for the purposes of looking at the impacts on folks' access to housing and housing finance, the Housing Assistance Council also looked at properties where the owner does have estate planning, but they choose to leave that property to multiple descendants. So someone says, oh, I want to leave this to all of my children. But then for a multitude of reasons, those descendants do not go through the formal transfer of title, which in many states is the probate process. Then the title is unclear, and as the generations pass along, now we've created a complex, tangled title. And there are many reasons why. I mean, heirs property is just one product of systemic design, partially due to histories of systemic exclusion and exploitation from financial and legal systems. Particularly for Black residents and other residents of color, they were barred from participating in formal legal and financial systems, and so they had to find their own ways to decide amongst their families to pass on their properties through generations. So as they pass on the property in the ways their families have decided, over generations with that knowledge, today that knowledge that they've passed on through generation of how to pass on the property doesn't align with the formal and actually the legal system, what they need to be able to have full ownership of that property. In some cases, financial constraints contribute to the perpetuation of heirs property. The probate process and untangling a title can be costly depending on where someone resides and what the access is to the legal system and how tangled the title is. And so, those financial constraints can perpetuate the issue of heirs property. In addition, some families live in financial and legal deserts. The American Bar Association reported that 40% of all counties have less than one lawyer per 1,000 residents, and 196 counties are classified as legal deserts. So without being able to access the legal system, they're not able to do the estate planning, to clear the title, to be able to stop the creation of heirs property. And so why are we talking about this? Why is this important? It's because clear title is needed for market participation, to have agency as a homeowner, to be able to sell the home at market value if desired by the family. Clear title is also required to access the housing finance system, for loans, for rehabilitation, or to leverage the property, the equity in the property for the family's benefit. Clear title is also required for many forms of insurance, and in many states for full property tax exemption. It's also needed to access federal monies, whether that is for disaster recovery or rehabilitation or construction. So not having a clear title results in decreased agency for the property owner, as they're unable to access the needed financing or support to pursue the visions for their homes. they're also vulnerable to land loss through forced sales, as Andrew was mentioning, with the tax sales, or being sought out by nefarious actors seeking property at low cost. And so there's regional research demonstrating that many properties sold in those predatory tax sales are heirs property, in some regions as high as 50%. And so a lot of the research suggests that the 90% of black land loss that Andrew referred to earlier from 1910 to 1997 was in part due to this tangled title issue. And so with the loss of generational property, there's also a loss of generational wealth. And in areas with a high prevalence of heirs property, we see other systemic issues, like low mortgage rates, low market participation, declining populations, and other systemic issues. And so while there's been over 40 years of heirs property research that's been ongoing, the Housing Assistance Council and Fannie Mae collaborated to gain an understanding about the housing impacts of this issue. We realized that there was a need to better understand the scope and the scale of this issue for residential properties. So due to data constraints, this study is a very conservative estimate for 44 states and DC. And even with a very conservative minimum estimate, there's still $32.3 billion tied up in residential heirs property, equity that's not accessible to these homeowners. And so as we mentioned, heirs property does not exist in isolation. Heirs with a high prevalence of heirs property tend to have other impacts of systemic disinvestment. And so one example of that is that persistent poverty counties, so counties with a poverty rate of 20% or higher over 3 decades, had twice the prevalence of heirs property in comparison to other counties. And so from a housing community development perspective, it's clear that there needs to be access to the legal system to be able to resolve these titles, prevent these issues, but there are also housing and community development impacts to the communities with a high prevalence of heirs property that also need attention. And so there are many benefits to addressing the issue of heirs property for households and communities. It can decrease vulnerabilities to land loss, increase ability to access and retain equity in the home, increase ability to access financing for rehabilitation, construction, full tax breaks, many things that will give agency to the homeowner. And so we had partners that we worked with in this research that shared many recommendations, but for the purpose of this conversation, I'll highlight those that intersect with housing finance. So there were calls from our partners for more inclusive definitions of homeownership that may recognize heirs property owners. There are also calls to see if is it possible for there to be alternate forms of proof of homeownership to access housing finance products. Are there considerations? We heard many innovations today, of great innovations around underwriting processes and ways for folks to access financing. So are there ways to consider financial products that don't require a lien on owned land? We've heard from heirs property owners that after they fought for generations to hold on to their land, to then go for a financial product that if something goes awry, they lose that land in the end. They're not interested in those types of products because it's tapping into the very thing they're trying to prevent. There are also calls to see, are there ways for financial products in the housing finance space to include funding for those legal processes, for the legal fees, the court fees, for clearing liens, clearing tax liens? Are there ways to include all of those costs into rehabilitation loans or construction loans? Can we explore those options in the housing finance world, are the call that we're hearing from. And so, title resolution is not accessible for all residents, as you mentioned, the legal deserts and the costs, and there are many folks who are working tirelessly and doing amazing work in the legal space. And can housing finance and the housing sector come alongside to continue to support that work? We heard some examples of those innovations earlier today. And so, again, just mentioning that this will impact housing preservation. We work with partners in historic Black communities, and one statistic that we came across in the research is that at the height of historic Black communities, which are communities that were established by formerly enslaved persons, there were 1,200 of these historic Black communities. Today, only 30 exist. And in many of those communities, we hear from the folks on the ground working with the communities that they're getting calls daily, weekly from investors wanting to buy up the properties, and they're vulnerable because of these title issues to this land loss. So it's very important that the amazing work that we'll hear about later continues, and there's more support and innovations to support heirs property owners. And so with that, I would like to transition to talking about some of the amazing solutions that are going on and advocacy for heirs property owners. So Inc., I'm wondering, now that we've kind of talked about the historic context of the taxes and with the heirs property, can you share some about your work and some of the solutions that legal advocates and governments can adopt to help preserve homeownership and support heirs property owners?
Yeah, definitely. And I think just touching up on what you and Andrew have been saying, I think it's important to frame this conversation by starting off with the fact that heirs property and the vulnerabilities that come along with heirs property aren't failures of families, but these are failures of systems, right? And so specifically the exclusion that the histories that have been, that so many of us have been talking about earlier today have resulted in. And so exclusion I'm thinking of in two ways. One is exclusion from the process of getting formal property ownership, and then secondly, exclusion from being able to define what property ownership looks like in this country. And so on the procedural point, that includes, again, some of the history that Andrew was noting, not just the violent land loss that many African-American families experienced over decades in the past century plus, but it also includes a lot of the fraudulent actions that led to folks, when they encountered the legal system, also losing their property. And so we have to keep that in mind so that we understand that this distrust that exists, this retreat from the legal system and from probate system and what have you, that these are all deeply rooted, and so every solution that we talk about has to keep that in mind as well. And then secondly, when I'm talking about the substance of property ownership, what I mean by this is the fact that many black families and other marginalized communities as well, these are family homes. There isn't typically that private form of home ownership. It looks different than it may look for other families, that nephews, nieces, aunts, uncles, grandmas, grandpas, all coming through the home. And so there's a more communal form of home ownership that we have to also acknowledge in our definitions of home ownership and who gets to be able to manage the property, and how do we make it easier for folks who are living in homes with multiple family members, folks with an interest, ownership, or otherwise in the property, allowing them to manage the property. So having said all of that, and really boiling that down to this access to justice issue, and then also these different forms of home ownership, I, at the National Consumer Law Center and others, we published a report earlier this year highlighting the three buckets generally of interventions that exist for addressing heirs property issues. And each of these solutions, they seek to reduce the vulnerabilities that are associated with heirs property, but also make it easier for families to get that sort of access to the legal system, so that if they so choose, they're able to resolve the property, they're able to clear title, consolidate title, and manage their property in a way that allows them to benefit from home ownership in this country. And so the three buckets generally are protecting heirs property from home loss. And so this includes programs that expand access to programs that exist for many other types of homeowners, such as property tax relief programs, disaster relief accessibility, mortgage foreclosure prevention, and the like. And then the second prong, or the second bucket, is title clearing. So increasing the options and the availability of ways to consolidate home ownership. And so here, we include things such as adverse possession laws that make it easier for folks to get the home ownership from other heirs who have not been living in the home for a long time, allowing folks to prove that they've been paying the property taxes in a home and therefore get home ownership as well. And then also, quite simply, funding so that folks are able to clear title in their various places. And I'll talk maybe a little bit more about that, about the many programs, including in Washington, D.C., as I think we heard from a little bit earlier today, that make it easier for families to enter the legal system and then to clear out that title. And then the last bucket, or the last prong, is really preventing heirs property from developing. I think we're all very invested in increasing black homeownership, and one of the best ways to do that is to ensure that when folks get into a home, they're staying into a home. I forgot who said it earlier today, but we're not just interested in home buying, increasing home buying, we're also interested in home ownership. And so by doing that, one of the ways we can do that is by ensuring that folks have easier ways to pass down title from one generation to the next. So whether that is increasing the ways for folks to avoid probate, or simplifying probate, because that is a time-consuming, costly, expensive exclusive process, or if it's by increased outreach to communities and to community organizations to meet people where they're at and help them to start the process of estate or life planning. All of these things have their place in ensuring that we're really preventing heirs property, and again, preventing, more importantly, the problems that are associated with heirs property. And I think we'll probably later on this panel talk a bit more on each of these different types of interventions and get more in detail there.
Great, thank you, and really appreciated your comments around the system versus, the ways that defining home ownership or the family property may look different for folks and the work that you've done. And so, Kevin, I know that in your work with ALTA, you also do advocacy work and supporting heirs property owners and have some collaborations. So, you're willing to share more about your work and how you all have supported heirs, done this policy work?
Sure, absolutely. This is an issue that ALTA and title companies across the country have been dealing with for decades. Advocacy recently, we've found a great partner in NCLC and working on many issues, whether it be at the state level or the federal level. But I just want to take a step back and talk about, how this issue is resolved when you're talking about this resolution piece right here. Talking about the legal fees and the access to legal work, let alone being able to afford it if you can actually access a lawyer. You're talking about these legal deserts. But looking at it from the title perspective, as our members, are intervening with home buyers who are trying to clear titles and untangle these titles across the country, the legal part is one part. The other part is actually tracking down all of these heirs. I mean, the generational aspect of this, you may have dozens of heirs that have a partial claim to one property that you don't even know about. So our members are trying to, when they, are faced with a sale or a refinance with a family who has this piece of property that has no clear title to them, trying to help them clear this title. It is hours upon hours of work of trying to track down these heirs, because everyone the way that most states, everyone has a fractional ownership and has to sign off for good reason. Our members also run into the fact where, and I think Inc. made a reference to this about, speculators who find one spare heir who doesn't have any connection to the family anymore, may not even have known that they had a partial interest in a property, buys them out of that interest, and then forces a sale on the rest of the family. And unfortunately, far too often, that family is forced to sell at pennies on the dollar of what the equity of that home actually is. But sometimes it's not a speculator. It's just someone finds out they have a fractional ownership to this piece of property and just wants money out of it. And it's as simple as that at some points. ALTA did a survey recently of our members about the curative work we do on just a bunch of different refinances and purchase transactions. We looked at the average transaction for our members to clear from order to closing is about 22 hours. But when you're looking at these more difficult cases, including issues of heirs property, you're looking at 44 to 45 hours on average of just title agent work. That's not talking about the lawyers, and that's not talking about, and the average salary in the title industry right now is about $75 an hour. So you're talking about a lot of money to get these issues fixed, to make sure that folks can just stay in their home and protect the equity that their grandparents or great-grandparents or aunts and uncles or whomever, even if it's just their parents, even if it's just one generation down, being able to protect that home ownership. It's hard enough in this country to buy a home. It's worse to have to lose it by no fault of your own. And I think we can talk about, many of the great work that's being done at the state and local level as well as the federal level now, thankfully, to try and address some of these.
Thank you, Kevin. So I think with your last comment, we can segue, thank you, if you're willing to share maybe some of the work that you're doing in DC and some of the other state work that you've been involved with or heard about that have been successful.
Yeah, definitely. So I work partially with Legal Counsel for the Elderly based in DC, which is one of two legal services organizations that is receiving money under a grant from the district to help folks resolve heirs property issues, the other organization being the DC Affordable Law Firm. And so through this work, what we've been doing is working with clients who have probate issues, who need to clear out the estate, and giving and funding their ability to do so. And also not just that, but also expanding the network of attorneys in the District of Columbia who are doing this work, building that capacity, and then also building this network and building these relationships. And so before maybe I continue on a bit more of that, I'm curious how many folks in this room have ever been the personal representative for an estate? Okay, one person. Okay, two. I'm going to guess that it wasn't a particularly enjoyable experience. I'm seeing, yeah, some head shaking. So right, so this is something that is incredibly time-consuming. It's complicated, and it's all the more difficult when you have so many heirs over a period of time. We were actually hearing at NCLC from advocates in North Carolina who had a case where there were, I believe, 120 heirs. So you can imagine, and in many states, you often have to probate the estates of everyone who's passed and who had that ownership interest in order to finally get that title cleared up. So, not fun. So one of the things that NCLC has been really pushing in terms of helping folks to clear title is the use of, for example, heirship affidavits. So allowing folks who live in the home to attest that they have this ownership interest and then use that to be able to manage the property in certain ways. And so you could use an heirship affidavit, for instance, to access disaster relief and recovery funds. For instance, FEMA actually a few years back after Hurricane Maria, where there was so much inability to access disaster funds because of informal title, revised their proof of ownership standard so that folks would be able to use self-declarative affidavit in order to show that they had an ownership interest in the home. Because you can imagine, if you're in the midst of recovering from a disaster, it's too time-consuming and it's too complicated to then seek probate for potentially generations and generations of heirs. Another facet in which this can be incredibly useful is the property tax system. I mentioned it a bit before, and as Andrew was saying, one of the ways in which folks really are losing their property oftentimes is through the property tax sale system. And heirs property owners oftentimes aren't able to get the full exemption for property tax relief that many jurisdictions make available. And so at NCLC, one of the things we've been pushing for is encouraging states and localities to increase the use of these heirship affidavits and allowing that to be a proof of ownership. Because in many cases, if someone's living in the home, they're paying the taxes, there's no reason why they should need to have record title and then also get the agreement of all 30, 40, 50 heirs in order to benefit from the home that they're living in and they're managing. And then one of the other things we've been doing on the prevention side of things is really looking into and encouraging in a lot of places the use of transfer on death deeds, which are a form of avoiding probate. So transfer on death deeds allow folks to essentially designate a beneficiary in the property in their home, and then recording that in the deed records, and then after they pass away, the property then goes directly to the beneficiary that was noted. And so this is a lot less time-consuming than probate often can be, particularly if the main asset you have is just your home. And it allows folks to really enter into this system of transferring property quite more easily. It's not as expensive and not as time-consuming as writing a will and then probating that will might be. But even so, there are some reasons why folks might want to go through probate as well. And so in those instances, we're also encouraging, and we mentioned this in a report, the different types of state laws that make probate simpler and easier for families. So, for example, this can include probate waivers for families who are maybe cash poor, although they may be asset rich. So considering the fact that even if an estate is worth X amount of dollars because the home is worth that amount, that people are not selling their home in order to pay to probate their home. So in making sure that the probate waivers and exemptions, that they keep that in mind. Another aspect as well is maybe increasing the amount of exemptions from traditional formal probate standards. In some states, if you are a surviving spouse, for instance, you're able to use what is called a summary probate process, which is much more simple. So if maybe perhaps you are a family member who's closer, making sure that we're increasing the access points for folks to get into the probate system should they so choose. And then I guess the final thing that I mentioned in terms of the work that we've been doing, both on the NCLC side of things and the LCE side of things, is I think also relates to something that Natasha said about the legal deserts. And I think on that point, the fact is, even in places where there are a lot of lawyers and where there are even well-established legal services organizations, the fact is that not many lawyers are doing this kind of work. there's very much a gap. There are a lot of lawyers who are working on trusts and whatnot for folks who are making $1 million, $2 million, or more and have that much in assets. There aren't as many lawyers who are interested in doing that work, or who have the skill, I should say, or the training or expertise in doing that work for folks who are just trying to pass their home down to another generation. And so making sure that we're building up the reservoir of attorneys who can do this work for low-income families and for marginalized communities is really important as well, because again, there's just so few lawyers who are available to do this work in so many places. And even where they do exist in certain states, again, because there's so few of them, these places, they are overworked and they simply can't help everyone who needs this work. So there's an increasing need for, again, building up the capacity for this, and a lot of, money to fund organizations to build up their capacity for this work. And I think that's why it's really encouraging to see that DC has taken this on and has committed, I believe it's $1 million to organizations who are doing this work and to build up this work in the district. Philadelphia also, I think, has a very vibrant community of folks who are working on heirs property as well. And then there are many others across the country starting to do this work.
Great, thank you for sharing those. And Andrew, on a similar vein, excuse me, in your research findings, were there some recommendations for localities, municipalities to implement to address some of the issues you laid out?
Yeah, there are a variety of, for one, is getting more involved in the local politics and in the matters of sort of who is administering local tax systems. I think there's been a growing awareness in many cities of this long-standing problem of the overtaxation of black and brown neighborhoods that has led to political change. In Chicago, for instance, there was a reform assessor who was elected in 2017. The city of Philadelphia actually just released a report a couple weeks ago, finding that, again, surprise, surprise, there's, black and brown neighborhoods in that city are experiencing overtaxation, and the mayor has committed herself to, taking measures to address it. But at a sort of, policy level, one of the sort of more effective strategies, at least for sort of ensuring that people are not going to be taxed out of their homes or sort of face the kind of problems that we've been discussing here that lead to home and land loss, are things like circuit breakers, which ensure that you're not going to be paying taxes above a certain income level as well. So so these are sort of strategies that are happening at the local level. In addition, I think too, the work of, say, public interest law firms that are working on issues like, say, heirs property. There's a couple in the South that are worth noting. The Center for Heirs Property Preservation, based out of South Carolina. Also the Appleseed Foundation, which has several chapters across. But I think one thing that this really also highlights is how many of the heirs property in particular, and some of the challenges is how that intersects with tax inequities, had long been understood and thought of as a rural problem. And again, for good reason, in the sense that a lot of the land that was lost in the 20th century were in rural areas. But we're really finding just how pervasive this problem is in cities, and how this is now something that is really becoming forced partition sales. This kind of equity theft is really happening in gentrifying urban markets across the country. And so I think this is something where now this needs to be woven into a lot of the housing activism that's happening in cities, and not just simply understood as a problem that was facing black farmers in the 20th century.
Thank you for that. And on a policy vein, Kevin, I know that you've done some work around federal policy, so wondering if there's recommendations, things ongoing and recommendations for
Absolutely. But when you're talking about, before I get to the federal part, when you're talking about partition sales, I think we would be remiss not to mention the Uniform Partition of Heirs Property Act that has thankfully been passed in, I think it's 23 states in the district, am I right?
5?
Is it 25?
I think it's 25.
I'm good with the higher number, that's fine. Let's keep it going. But I think it's a great piece of state legislation that allows some recourse for families that face this issue, to allow them to, a series of simple due process protections, whether it be fair notice that, someone has acquired a fractional ownership and is forcing a sale, a fair appraisal to make sure that if the sale goes through, they have, they are getting the market value for the home and making sure this is not being sold for pennies on a dollar, as I said before, and then making sure that heirs have the right of first refusal to protect them from speculators coming in and buying up their generational home from out from underneath it. So I think there's some great work being done at the state level, and then at the federal level, while, as we all know, housing is mostly done at the state and local level for various good reasons. So the federal level, it's kind of like giving that carrot to states to incentivize them to pass good legislation like the UPHPA. So there are two pieces of legislation that have been introduced this Congress that I'm actually very excited about. The first ties directly to the UPHPA. So Congresswoman Kima Williams from Georgia, along with Lizzie Fletcher from Texas, Emmanuel Cleaver from Missouri, and Byron Donalds from Florida, along with 12 other co-sponsors, but that was the core group that introduced the legislation, introduced the Heirs Estate Inheritance Resolution and Succession Act, the HEIRS Act. It's a lot of words for one acronym. But it incentivizes states to pass the UPHPA or some similar act that protects the consumer. There are some states that didn't, directly adopt the UPHPA model, but adopted something very similar. And what this would do is, to those states that have adopted it, there's two grant programs, and they're kind of going back to Ink's display of, the different ways you can deal with heirs property through the resolution. So it's a $300 million grant program over the next 10 years from HUD to provide states with funds to help people clear their title, whether it's legal fees, finding a lawyer, things like that, things that some people just don't have the access to who need the help. It is grants to the states to then disperse to folks to help facilitate those things. And then as well as another $10 million over 5 years for housing counseling assistance to be able to educate folks about heirs property and about estate planning, making sure that they understand the importance of estate planning if they find themselves with heirs property, how to get out of it. So I think it's a really great two-pronged approach, coming out of the federal government to both incentivize states to pass the UPHPA, but also to put some money behind these efforts, because I think that's something the federal government's really good at doing. So we should, find them a good way to channel that energy towards. And then back to what Ink was saying before about the alternative forms of ownership, whether it be the heirship affidavits or something. You mentioned that FEMA changed their guidelines a few years ago. Well, there's a bill that was just introduced by Lizzie Fletcher and Nikema Williams again that would amend HUD regulations to do something similar for the CDBG, the Community Development Block Grant, both disaster recovery and mitigation loans, to be able to take for folks who find themselves with heirs property who don't have a clear title with their name, to use alternatives to access those funds as well. So I think being able to, as we've talked about, broaden the umbrella of available resources to folks who find themselves with heirs property who haven't yet been able to untangle that title is really important.
Yes, thank you for mentioning those. With the FEMA work, the FEMA changes that you both mentioned, in the very first year that they implemented it, I think the report they gave that $350 million additional were given out with the changes of accepting an affidavit that would have been rejected the year before. So it's just showing that there really is a need for these changes, and I guess we're still waiting to see what happens with these bills that have been introduced. Is that correct?
Yes, they've just been introduced. They are gaining momentum. It was literally earlier this month for homeownership for a month. So they're gaining momentum, but any of you who have colleagues that work in the federal advocacy space, happy to connect with them. We're making a big push to get as many co-sponsors on these bills. As we all know, home ownership is not a partisan issue. These are bills that are going to help people, whether they're Democrats, Republicans, in red states, blue states, in rural or urban. This is an issue that doesn't discriminate, although it disproportionately impacts people of color, of course. So I think, as much awareness around these bills and around these funds to help these families that are impacted by this issue is the better. The more we can do, the better.
Definitely. And then I just want to make one quick comment to lead into my question to you all before I open up to the audience for questions. When you mentioned the UPHPA, it's a great legislation that's been passed, and it's gaining momentum, so we hope to see it passed in as many states as possible. And there's a really great opportunity for the housing sector to collaborate with the legal sector in that space. For example, one of the provisions of the Uniform Partition of Heirs Property Act is the allowance of the heir who wants wants to keep the property to buy out the interest of the other heirs. But I know someone came to me today and said you can buy out 10 heirs with $50,000, I would lose my property. So how many people have the money sitting around to be able to buy out those interests for that property? So is there a way, the question that I think we're hoping to present to the many brilliant minds in this room and anyone we can come across is there a way for housing finance to provide those monies? Is it so unlike a mortgage, in non-technical ways, right? But you're trying to purchase a property. So is there a way that we can think about this in a way of someone purchasing a property to be able to have those buyout fees to then come alongside? And then with the housing counting that you mentioned, and can correct me if I'm saying this incorrectly, but attorneys cannot solicit. Is that I'm saying that accurately? So in some communities, we're seeing where the housing counselors who are embedded in communities are frequent touch points for folks who are looking for assistance to say, oh, you have a title issue, instead of saying, well, you're not eligible for the housing program, saying, actually, here's an attorney you can call. Here's the legal aid that you can access. Here are the steps that you need to take, because they can be referral sources to attorneys who are not able to solicit based on their regulations, guidelines for their profession. So there's so many ways that there can be collaborations to support the ongoing work and to continue to move it forward. So my question to the panelists are, what are some examples of the collaborations that you've had since we're here celebrating 3 years of collaboration? What are some collaborations that you all have had that have been successful, and who do you want to collaborate with? Or who would be helpful to collaborate with? What sectors, which people, which organizations to be able to advance the recommendations and things you put forth?
Well, I can go ahead. So I'll highlight one collaboration that we just finished with a few weeks ago, and we being legal counsel for the Elderly Aid DC affordable law firm. I believe it was Legal Aid DC, and the DC Bar, and a few other organizations as well. So a few weeks back, we put on a community outreach event with hosting with Hill Civic East Association, I believe, an organization based in the district. And they used, so this is a community civic organization that has a lot of contacts, this is a touch point for folks in their neighborhoods. And so they reached out to, I believe it was the affordable law firm, seeing if there was any way they could collaborate, helping folks, getting folks information on foreclosures, reverse mortgages, estate planning, and property taxes. And so as part of this grant that the district had given to LCE and DCALF, we hosted an event at St. Coletta's near the Stadium Armory metro stop. I'm not sure if any of y'all are familiar, in Southeast DC, and had folks come in, and then we had 3 different rooms where we had folks where we were able to give folks information about whether they were behind on their property taxes, whether they were on the title to their deed for their home, whether they, what an estate plan would look like for them, giving them the space to really think about all of these questions and all of these issues in a very, in less of the acute disaster way that many of these issues often come up, such as tax foreclosure or disaster or what have you. And so I mentioned that because I think that was a really good example of us collaborating with a community organization that already has connections, that's already built in the trust and has an earned reputation, and then also bringing in all the legal stakeholders as well, so that folks are able to see that this is where they can go to get information, this is where they can go to receive assistance. And so as part of that event, we also had intakes as well, so that folks could get followed up with by many of these organizations. So that's an example of the way some of this collaboration could work. I'd also mention, I think there's a lot of opportunity for financial institutions, for instance, and legal organizations and advocacy organizations to combine and work together. As you were saying about the buyout, I think there are a lot of things we could brainstorm in terms of products where maybe a partial ownership interest that the person has is enough to secure a loan that's then used to buy out the interests of others for a UPHBA buyout. And so I think there's a lot of opportunity there.
Yeah, I would agree. I think some of the best is like the collaboration to come. I think there's so many conversations that have happened over the last several years. I mean, I remember when I started at Alta and started looking at the issue of heirs property, it was really only a USDA relending program that was available to help people. And while absolutely helping farmers and ranchers is very important, there's so many other people to be impacted by this. So I think if I had to pick out one collaboration, it would be Congresswoman Nikema Williams coming to Alta and saying, this issue, I know has to deal with title. My family is a victim of heirs property, and we have a property that is fall under this. What can Congress do? What can we do? And taking that relending program, using it as a model, but making it not a relending program, making it a grant program to give people who need the access to legal services or just need money to help, whether it be buy out an heir or just understand the process to tangle this title and save their family home, I think is such a great way to use Congress, as slow as it sometimes may be, but they do have a lot of power to be able to make a difference.
Thank you.
Yeah, so I'm an academic, and I'm sort of stepping into new spaces here with the writing of this book, and I think over the last several years, I've really been more soliciting insight and from experts, including folks associated with the organizations here on the stage. I've been talking a lot with over the years with John Rouse, senior attorney at the NCLC, who really who wrote this really excellent report on the tax foreclosure crisis in 2012, and so in a sense, like what I've been really been working a lot on is trying to piece this together and understand some of the sort of the laws and policies that help then inform my own historical contextualization of them. And I think right now, my real interests are taking the history that I've been working on and the issues that I'm sort of laying out here, and now sort of putting them into action in terms of policy changes, in terms of actually historically informed policy proposals that can actually sort of draw upon some of the lessons of the past. And so in a sense, like working with groups like the NCLC, the Center for Community Progress, which has done a lot of work looking at some of the problems of vacant and abandoned property and the ways in which that has sort of created some of these exploitative practices in urban housing markets, as well as some of the folks who are working specifically on state and local taxation here in DC, has been really exciting for me, because too often historians and academics, we sort of identify problems, we write about them, we decry them, but then we don't actually sort of translate that work into actually sort of meaningful change. And I think that's been a source of frustration for me throughout my career, because I feel unsatisfied with just simply kind of identifying problems that are longstanding, but rather sort of doing something about them. And so this has been a real it's been kind of new for me coming into sort of these spaces, but one that I'm really excited to continue to sort of work toward. So
Great, thank you all. Any comments before I open up to the audience for questions? Okay. Well, we have some time for some questions if any folks would have anything or comments, things to share.
Hi, my name is Jordan Harrison from Compass Working Capital. I noticed on the map that a lot of the, I think it was the constant poverty, was kind of centralated towards the south. And I do remember the 1619 project, they did a article and a documentary on like black farmers, and I was just curious about if you noticed any like what professions, like what areas, people who were going through these problems, what were they working with? Was it like agricultural workers and stuff like that?
Thanks for your question. So with a lot of the heirs property research, well, let me pause and say, heirs property research really grew out of, as some of the panelists mentioned, out of noticing the black farm land loss. Our research wanted to supplement that. We're looking at specifically residential properties since we work in the residential space. So there is quite a bit of documentation around the fact that a lot, specifically black farmland, was lost in part due to title issues. In terms of the map I presented here, we did not have access to personal information about the owners of the property for protection reasons, because we don't want data being transferred around that's saying, Natasha Moody, black female, this profession has an heirs property in this location, but so we don't have information about the professions. But in terms of the patterns, part isn't due to the fact that it lines up with any other map around systemic disinvestment. You kind of line them up, you'll see heirs property laid as another layer on top of other maps of systemic disinvestment. But I will note, with our research, part of the findings are due to the data source that we had and the methodology that we used. And so there are some local research on local levels that use, there's no one way to identify heirs property as of 2024. Everyone's working together to try to figure out the best way to do that. And so part of the map is one, just really not shocking in terms of, if you look at persistent poverty maps, redlining maps, food desert maps, they're all going to pretty much line up with heirs property in a lot of ways. But I don't have a professions answer to you at this moment. I'm not sure if any of the panelists have come across.
Great,
yeah.
Great explanation.
Denise.
Hi. First of all, Andrew, I want to congratulate you on the book. I saw the op-ed that you wrote in the New York Times and shared it widely. So I have a question for you. In the work that you've done, I'm just curious what opposition you have seen to the acknowledgement of the black tax, particularly with respect to city assessments, and what justifications have you seen for maintaining it or other resistance to addressing it?
That's a good question. I think it's almost sort of undeniable in the sense of actually, you can't deny the sort of evidence. It's plain as day. I mean, in terms of the actual existence of these assessment inequities, then the question then becomes is what is driving this and then what to do about it. And that's where the sort of debates really begin in terms of, how do we actually sort of, there's a lot of sort of questions as to sort of what are the factors that are explaining what, can these be solved by sort of small, more technical solutions in the assessor's office, or are they systemic and actually sort of problems that are rooted in the sort of fiscal framework of how we tax property and what those property taxes are used for. And so I think in some respects that's where really a lot of the kind of real hard debates that are really that don't actually break down neatly along ideological lines either, because there's folks on the left and on the right who sort of think that there is something to be there's something very important about maintaining local tax systems in their current form, and that the property tax as a local tax, and I think this is something I always strain to make clear and sometimes get readers of, say, like that op-ed who maybe only read the headline, which I think was a little sort of deliberately provocative, and that's what the New York Times wants to do is get clicks, so I understand. But nevertheless, I think it can be misread as me arguing that like the property tax is a inherently bad tax, and in fact nothing could be further from the truth. In fact, it's the only tax on wealth that we have in this country. But the local nature of it then poses all these problems in how it's administered. And that's what I really try to sort of focus on, is like, you need to get beyond just the tax policies themselves and actually look at the administration of tax, of any laws and policies. And that's where you can begin to find some of these problems lurking in the shadows. And I think that's something that I really sort of emphasize and focus on, that, and I don't necessarily think that these can be solved at a local level on themselves, because so many of them are rooted within a broader framework that leads to, say, some cities having ample resources and lots of property and wealth and property, and others utterly bereft of it and are struggling to keep the lights on and the streets clean and the water clean. And I think this is something that, and also one of the downstream effects of these inequities within local tax bases is that it leads cities into these sort of predatory relationships, whether it be with tax buyers, whether it be through kind of reliance on fines and fees and other sort of measures that kind of disproportionately affect black and brown populations. So I think a lot of this is very much, we need to look at the system as a whole and how the structure has been built comprehensively. But also I think that's something where the solutions are going to be tough, and they actually have to require us to think more broadly and comprehensively about how do we sort of raise and spend the public's money ultimately, and how do we ensure that our tax policies are not making the problems that taxes are meant to solve, like building a better, more equal society, making those problems worse, which I think is actually what local tax systems today are doing. They're actually sort of exacerbating the very problems that public dollars should be addressing. So yeah.
Thank you. I think probably time for one more question, if there is one. Okay, well, I would like to thank the panelists for sharing their insights and expertise. Thank you to the Black Homeownership Collaborative for having us. And thank you all for being here for this session at the end of the day. Most greatly appreciated.
Okay, well, we have arrived at the end of a very informative and interesting day, and I think that I'd just like to make sure you diehards that have stuck with us the whole day, I want to give you guys a round of applause, and thank you much for being here. And we now will turn over to our closing remarks from Ms. Lisa Rice.
Let me echo Charles's thanks for those of you who have stayed with us through the end of this really wonderful and well thought out and put together program. I want to thank all of the members of the Black Homeownership Collaborative for your engagement over this past year and for working with us to convene this great event. I want to thank the steering committee for their extra hard work throughout the year, as well as the National Housing Conference and the great staff at the National Housing Conference. David, Charles, everybody, thank you so much because you went above and beyond the call of duty, both facilitating and hosting this great event. So thank you all so much. And I want to thank our sponsors. We wouldn't be able to have this convening without the support of our sponsors, the Federal Home Loan Bank of San Francisco, Bank of America, Rocket Mortgage, JP Morgan Chase, Wells Fargo, Airbnb, Habitat for Humanity, and Fannie Mae. Thank you again for your support. We really appreciate you. And with that, I bid you all adieu, and I will see you next year.